It reads as follows. Riziki Limited is considering a project with the following details. Initial cost 40 million. Residual value 2.5 million. Selling price per unit is 1.1. Variable cost per unit 500. I meant 1,100, pardon me. Then variable cost per unit is 500. Fixed cost per year is 5 million. Additional information, annual number of units sold is 30,000. The project has a useful life of 5 years. The company uses a weighted average cost of capital or WACC of 12%. Required, A, compute the base net present value. B, carry out a sensitivity analysis of NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. C, prepare an appropriate chart to indicate the different NPVs for each scenario in B above. Note, adverse variances in this case means a decrease in cash inflows or an increase in cash outflows. So what we're going to do, ladies and gentlemen, you can see towards the right of the screen over here that we've developed inputs: the initial cost, the residual value, the selling price, the variable cost per unit, and the fixed cost per year, and the project life there. So what we're going to do then, we're going to now identify the inputs, or the major inputs towards the right. Like for example, what I mean is this. We're going to now talk about the base. Here we're going to talk about the base case, input based on the input. So base. That. And then towards the right, we're going to include a 5% initial cost, or positive value of 5% initial cost. So we're going to have plus 5% initial cost, like that. And then we will now then have the adverse scenario where we have negative 5% annual unit sales. So negative, I'm going to do like that, negative 5% annual unit sales. So with that, we proceed on to get or to also identify now the 5% selling price. So negative 5% selling price. Then we continue building on the model itself. Right here we have variable cost. Now, increase in variable cost. 5% variable, 5%. I'll explain variable cost. And then we're just following these components right over here. So we began with the initial cost, then we went to the annual unit sales, then the selling price, then you're going to the variable cost over here of 5% variable cost, and then residual value. There, so negative 5%, negative 5%, residual fixed cost. I think I forgot fixed cost. So positive 5%. Apologies for that. Positive 5%. 5% fixed cost. And then we're talking about residual value right here. Residual value. %, residual value. Value. That. So with that, we are saying that we are told to compute the NPV. So the inputs, then we just follow the inputs based on whatever we've been given. So the residual value right over here, we can come to the initial cost. You can see the initial cost is 40 million over here. So it's 40 million. We're just doing the base case scenario over here. So what I can do, I can put this perhaps on that side like that. So that now, and maybe perhaps I can, with your permission, I can just compress it a bit over here like that so that you can be able to fill out this part. So the initial cost right here, you can see is 40 million like that. So 40 million. And we come down there. So we want the comma format, guys. The comma format. So we highlight everything, put a comma, then just like that. So here the initial cost plus that value there. Then we have the residual value going down. The residual value is given to us over there. That value there. Because we're talking about the base case. And then the annual unit sales. The annual unit sales you can see is right here. Additional information number 1. So 30,000. So just put and plus 30,000. Because this is in words, it's not separated from the words. So it's in figures combined with the words. So just put 30,000 there. We have the selling price per unit given to us. The selling price per unit, you can see, is given to us on the right here. So enter that. The variable cost per unit as well, given to us there. Enter. Then the fixed costs per year have also been given to us there. So plus. Enter there. The project life in years. We have been told in note number 2 that the project has a useful life of 5 years. So we just indicate here 5. That. So what happens then when we have an increase on initial cost? So the increase in initial cost will be, we can put 5% over here because we're saying it's going to be 5% increase over here. So you put just 5%, and we increase. So this will all require this to have a percentage. So allow me to do this. To do the following, to put this as percentage over here, comma format here, that. So don't worry about this. These are just the marks that are being allocated towards the entire question. So you can see it's 30 marks over here. So with the permission, then I can just do away with that, or rather I can just put them beside the questions over there. However, we can just do away with them for now. So with 5% increase, we just come over here plus that value times a factor of 1 plus, we're increasing it by 5%. That's what it gives us. 42 million. With 42 million, we are saying the residual value remains as the way it is over here. Because we're saying that the residual value will remain as 2.5 million all through, whether there is going to be an adverse effect or so on and so forth like that. So here is 2.2 million like that. We proceed on. And even the number of units, this will be the same. The annual unit sales will be the same, 30,000. Here we are saying it's going to be 1,100 like that. So I can just copy these values as the way they are towards the right there, with your permission. Because we are saying that the initial cost is the one that is only increasing. So here you see copy, paste special values. And I say okay, like that. So if that's the case, what happens when we have a decrease in unit sales? 5% decrease in unit sales, because we're seeing from the question right here that carry out a sensitivity analysis for the NPV assuming adverse variance of 5% for all the inputs except the project life and weighted average cost of capital there. So we are saying that now we want to put adverse effects over here. So we are going to have negative 5% like that. You can see it's even indicated to us over here. So here we are saying is going to come back to this, because we're saying we increased it from this to this based on the 5%, but now it's going to come down. And so I'll increase now each of these items moving towards the right there. The annual unit sales, the selling price, the variable cost, and so on and so forth. So that now right down over here we can now do the workings effectively. So you can say plus that value times 1 plus it should be because we're decreasing this value over here 1 no so I think this is the formula. It's plus that value. We're decreasing it by 5%, so it should be delete plus this value, and then we're multiplying it by, open the brackets, 1. Decreasing it means, so it's going to be, we're subtracting it from 0.05. So 1 minus 0.05, that. It shouldn't give us 1 minus 0. We're talking about 5% adverse effect, because we're saying from here, if we increase this one by 5%, so then decreasing it should be able to give us it should be able to give us take us back to where we actually were before, or there. So it should be just 40 million. That. And with 40 million, then we are saying that we can move ahead and say that variable cost is going to now also selling price the variable cost is going to decrease over here. So we put negative 5% in terms of selling price, sorry. So negative 5%. So we put that, and it remains the same. Over here I'll explain that. If you're talking about the variable cost itself, also it also remains the same like that. So it's going to remain including the residual value like that. But what we're saying is that here we will need then to put 5%, because we're saying it's 5% variable cost, 5%, then negative 5%. Because it's positive there. So we are saying what? That in terms of the initial cost, if it's going to increase, it's going to increase by 5%. If the unit sales decrease by 5%, then it's from this increase, it's supposed to decrease to 40 million back again. Then what about the residual value? The residual value should remain the same, with the exception of the very final residual value down over here. So it should remain the same here. So we just maintain it like so, up to there. But you're saying that the very final one over here is going to, this residual value is going to be plus that value times, open the brackets, 1 plus should be that value there. The residual value represents an inflow of money when you sell the asset. So we are saying that at this point over here, the residual value, a 5% decrease in residual value will cause it to be over there. That. So that's what we have. We proceed on to discuss the next item, talk about the annual unit sales. The annual unit sales will affect what? Will affect this component right over here, this column over here, the annual unit sales. So here we are saying it's going to decrease, so plus that one times, open the brackets, 1 plus that 5%, negative 5%, 28,500. But the rest remain the way they are. These other values remain the way they are. So 30,000. So plus sorry, pardon me for that. Undo, so it should remain 30,000. That should remain the same. Control R. It's only the unit sales. Why? Because we are saying that the unit sales are the ones which are being affected. The sales, we are dealing with unit sales. So this annual unit sales component should actually change. Next item is the selling price per unit. So what would change? So selling price per unit, this is what is going to change. That part there is going to change, pardon me. That one is the one that's going to change. So here we are saying it remains at 1100. So here we are saying it's just going to be that, because it has already changed. This one remains the same, but the selling price changes based on that component there. So we're saying the selling price is going to be plus that one times, open the brackets, 1 plus selling price comes to 1045, but the rest remain the way they are. How about the variable cost per unit? Variable cost per unit remains the same with the exception of the variable cost component. So here we expect it to remain the same. So we drag it up to there. But that value times, open the brackets, 1 plus the variable cost is increasing. 525, then the others remain the way they are. The fixed cost per year. The fixed cost per year, we are saying is going to be 5 million with the exception of the fixed cost component. Or just put it like so, up to there, Control R. So this one is just going to change plus that value times, open the brackets, 1 plus that value, and we enter. Then we remain with enter. We have it like that. How about the project years? The project years remain the same. We've been told it's 5 years, so it goes without saying that it's going to be remain 5 years. just leave it like that. And with that, now those are the inputs that we've worked out. We now want to proceed to work out the solution. So the unit sales, we start by identifying the unit sales over here. Unit sales, over here we have, and of course here we have the base case given to us there. This one should be slightly above here because we do not fill in. So base case. That. Then here we are saying we're going to now put in the figures. The unit sales, 30,000. So we have them there. And then we copy these components towards the right here. Copy. Towards just the right here. Base, just the same way. Then we have the initial cost is going to be how much? We're just going to copy and pick it from there. So the initial cost in terms of the unit sales is just going to be the same. You can see that because we're talking about the initial cost here. So when you're talking about the initial cost, we're just going to copy it like that. So enter. So the initial cost, we just pick it over there, just from above over here, because the initial cost is going to be an increase. So then the annual unit sold. So we just then autofill, Control R, with the exception of this one, where we're saying the annual unit sales changes over here. Remember how we did it over here? Is what we're saying actually changes there. The next component is the selling price. Selling price. So we move like so. Selling price. Price. And the selling price or SP is given as plus that value. Enter it like that. Remember where it changes. It changes at the point where we have the selling price component there. So if it picks from above there, so just put it like so. You can see the selling price changes at that point here. Next component, next item is the total sales. Total sales. And you're saying the total sales is going to be given as we multiply you're just going to pick the values here given to us over here. Total sales plus, from the question, just to clarify over here, one second, I get it. It's just going to be this value of here, selling price, times that value. That's what we're getting. Sorry. And once we have that, we proceed on to identify the next component there. And with that, we're saying we'll just be able to just pick the values, dragging them over here. Sorry, I was just having a bit of a small hitch. Sorry for that. So Control R. And you can see what happens there. we just pick the selling price and then we multiply with the unit sales. So what happens then now with the next component? So those are total sales. Once we have the total sales, we pick the variable cost per unit. Variable cost per unit. Sorry. Per unit. And the variable cost per unit given to us there is just going to be 500. You can clearly see it, it's just given to us over here, 500. So we just pick it. Remember, we're just picking the values the way they are over in the base case. Enter. And you remember the variable cost component changed at this point. You remember it changed at this point here where the variable cost was actually increasing at 5%. So it changed to 525. So we just move towards the right and then Control R. How about the total variable cost? So here, with your permission, I'll just move this a bit towards the right. For here, I can say variable cost, total variable cost. Total variable cost. And the total variable cost will be given as variable cost in terms of shillings times the units. Put towards the right, Control R, and it picks. Once we have the total variable cost, we can be able to pick now the sales in terms of the variable costs, the sales variable costs, so sales. Variable cost. Sales variable cost. And we can see that it is just going to be the total sales and then we add the total variable cost. That's what we're going to do. So it's going to be the sales, which is there. Then we add that value. But there's one thing. The variable cost is a cost. Please note. So what we're supposed to do is that we're supposed to put this in form of a negative sign there. So apologies for that. Put a negative. Put it like that. Then I move it towards the right there. So that now we can be able to indicate or be to show that it is actually indeed a cost. And so you can see the sales variable cost actually changes there. So now what is left is for me now to just drag it like so. Please note one thing, that the unit sales were given to us there. The selling price was also given to us there. The total sales is just the unit selling price times the unit sales. The variable cost per unit, we had already computed it right above over here. And we say that this variable cost component over here is going to change by an increase of 5% increase variable cost. The sales variable cost right over here is just given to us as the total sales minus variable cost. So the sales less variable cost gives us this value here. How about the fixed costs? The fixed cost is given to us there as as follows: 5 million. It's right here. So we enter, and because we're saying it's a cost itself, so let's put a negative sign there to show that it's a cost. Then we move towards the right like that. Remember, the component of fixed cost over here changed, 5 million from 250. So we're putting it a negative over here just to indicate that it's a cost. And with that, we can be able to then identify the cash flows. Cash flows. So the cash flows we have over here are just going to be 18 million, and then we subtract 5 million. Or we add. Why I'm adding is because we need to, is because we're going to subtract. Please note. So we're going to add. If I subtract, it's going to be 18 minus minus, which comes to plus. So I should be able to just add it right there. So get 13,000. 13 million, pardon me. So 13 million. Control R. Move towards the right. And those are the cash flows. But remember one thing, that there was a residual value over here that we didn't factor in. So we just put it in there. So the residual value year 5, so we can put it year 5 is a cash inflow. So how much? We pick those residual values from up above here, please. There. Then, because there's a change in residual value over here of 2.375, we need to factor that in. So Control R, but we do not subtract it. It's a cash inflow. So then we are going to, or we'll need then to get the present value interest factor. So down over here we'll have PVIF, present value interest factor, year 1 times cash flow. Times cash flow. Which cash flow? These ones here. So we'll do the same, PVIF year 2 times cash flow up to year 5. So year 1, year 2, so I'll just change this. It's going to be easier to change that. Year 3, year 4, then year 5. Cash flow there. And how do we get the present value interest factor? We're just getting the present value interest factor. Could put the interest rate right above over here. So interest rate, it's at 12%, all through 12%. So here we put that, and we 12%. So it's going to be plus the cash flow and then we discount, we are discounting it, discount it against open the brackets 1 plus that value, close the brackets, power 1 times, not times the cash flow, it's already been multiplied like that. So we enter. So once we have that, we shift control R, that is year 1. Notice what I've done over here, you can see even the formula is power 1. So here I'll do power 2, power 3, power 4, and so on and so forth like that. So because I want the cash flow, so it's going to be plus that value over 1 plus that one power 2 that. Then you do the same thing. One plus R power 3 like that. So here is going to be this power 3. Yes, power 3. So power 4. Sorry, I was just having some trouble with the mouse. Sorry. So plus the cash flow over, open the brackets, 1 plus power 4 that. Then finally we have power 5, but we will also need to work out the residual value right here. So the residual value, then the cash flow is going to be plus that value over 1 plus power 5. Enter. Control R. Then we have what is called the residual value. Residual value. So you can say PVIF, value interest factor, year 5 times cash flow. That's what you do. So this is residual value. I should change this to enter, just to do that. And we're saying that the residual value was what value? Residual value was that one over 1 plus that value power 5. Please note it's power 5 because there's a cash inflow that is coming in at the end of period 5. Just to confirm that it's okay. Yes, that's okay. So from there, we get the total PV. And I can just be able to indicate it using a bottom border, thick border, the bottom, thick border at the bottom there. You can say that we're getting the total present value. Present values is going to be those ones there like that up to there. Then I just drag it towards the right, Control R, it gets the total, and I bold that. Control B, as well as this one, I Control B, like that, to show that that's the total present values. But remember, part A is requiring us to get the net present value. You can see here, compute the base net present value. So we need to deduct the initial cash outlays. So initial cost, you're saying plus, should I say plus or should I say minus? So say minus that value. The initial cost is there. So 40 million. Remember, the initial cost over here will change. This value here will change based on whatever we calculated over here. You can see it's 42 million. So we'll just change Control R, that, you get the NPV. Put it. Control B, then you put a top and bottom border. Plus then it may not be very clear, so I put that thick border there, and then I put also this other border here with your permission. It's just presentation, good for presentation, characteristics of good financial models there. So with that, then we have the scenarios. Part B, carry out a sensitivity analysis for NPV assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital there. So the base case we'll have, so part B, I can do it just down over here. So the base, we just almost like sort of copying this. Down over here. Then we have the NPVs down here, because we have the NPVs given to us over here, and net present values. NPV. NPVs. So just pick those ones. Then once you pick one, then you just drag it. With that, we can then just, now we've done that, carry out a sensitivity analysis, we've already done the sensitivity analysis, prepare an appropriate chart to indicate the different NPVs. So part A was to compute the base case NPV. We have already done that. The base case NPV is this. Then from there, we are told part B to carry out a sensitivity analysis of NPV, assuming adverse variance of 5% for all inputs except project life and weighted average cost of capital. Adverse effect. So the initial cost, was given to us over here as 40 million. So we've done an adverse, the opposite, the adverse, by increasing it of, or rather, by increasing it by 5%. So we've increased it by 5%. Here we've reduced the unit sales by 5%. The selling price we've reduced by 5%. So we're trying to answer part B, carrying out a sensitivity analysis assuming adverse variance of 5% for all inputs except project life, weighted average cost of capital. There. So we cannot have an adverse effect for the initial cost. We cannot, unless the cost is an adverse effect, means that the initial cost increases in value. That's what we mean. It cannot reduce. If the initial cost reduces, it means it's an advantage to us because we are spending less. You get the point? So the unit sales is now when you're getting a negative value over here. The unit sales decrease. The selling price also decreases here. The variable cost, because it's a cost, the only way a cost can be an adverse effect is if it increases. That's what you're saying. A fixed cost is, because it's a cost, if it increases is when it becomes an adverse effect. For residual value, becomes an effect when the value actually decreases. And that's why we are putting these values differently there. I hope that point is driven home. So with that, then I'll just go to part C here. So we've done a sensitivity analysis for the adverse effects of initial cost, selling price, fixed cost, variable cost, and residual value. And then we are told to prepare an appropriate chart to indicate the different NPVs, each scenario in B above. So what we'll do, we just go towards the right here. Towards the right. And we come and we move on to insert. Once we go to insert, we can come to recommended charts. Click on recommended charts. And you can see whichever chart pleases you, you can be able to recite it, so long as it yields whatever we actually need. So this one, maybe perhaps select this value here, this one. And we say, okay. So the different NPVs that, or the different sets of, or the adverse effects of those values, base case, are actually indicated to us over here. And this means that at the base case, we are actually over there. The initial cost sensitivity plus 5%, because it's a cost. Any cost should be, an adverse effect should actually increase or get a positive value. But any positive value or selling price or what we are selling should actually be indicated by a negative sign if it is going to be an adverse effect. So these are the NPVs based on the initial cost, the annual sales, selling price, the variable cost, and the fixed cost, as well as the residual value. So this, ladies and gentlemen, brings us to the end of question 22, business and data analytics. We hope that you have enjoyed being with Manifested Publishers. Thank you and God bless you.
Greetings to you all and welcome to the revision session of the financial accounting paper that was done by CPA and CFA candidates on Monday, 4th of April 2022. This was a morning paper. The candidates were expected to answer 5 questions in a time period of 3 hours. And in this session, I'll be tackling a question at a time. In this first session, I'll answer question number 1. In the next session, I'll answer question number 2 until we complete the 5 questions. It's my hope that you are ready to revise. I also hope that you attended the class lectures where we took you through all the topics as per the 2021 Kasneb revised syllabus. Welcome to the lesson. Question 1 of the financial accounting paper that was done in April 2022 reads as follows. Part A, highlight 5 elements of financial statements, 5 marks. I'll first answer that one. Elements of financial statements. So candidates, what are financial statements? Financial statements are also known as the final accounts, and the main financial statements are the statement of income, or what we call the trading profit and loss account. The second one is the statement of financial position, also known as the balance sheet. The examiner required candidates to highlight 5 elements. The candidates who understand English did not have any problem answering this question, because if you know the meaning of elements, what is an element, then it becomes very easy for you to answer such a question. An element is a segment. An element is a constituent of something. An element is a section. The candidate required, the examiner required candidates to highlight 5 elements of financial statements. 5 elements of financial statements. This is financial accounting. We are revising the paper that was done in April 2022. Question number 1. A, elements of financial statements. I've said the main financial statements are the income statement and the balance sheet. So what are the sections in a statement that is known as the profit and loss account, the trading profit and loss account? So if you are to look at an income statement or a statement of financial position, you'll find elements like revenues. And in a short while, we are going to be preparing a statement of profit and loss account. When preparing a statement of profit and loss account, which is a financial statement, the first section, the first element, the first segment is revenues. The second element in a statement of profit and loss account is what we call expenses. So these are the main elements in a statement of profit or loss account. Then the main elements in a statement of financial position, the main elements, we have assets. We have number 4, liabilities. Number 5, what we call equity. So these are the main elements of financial statements. Revenues. Now, what are revenues? Revenues are increases in assets or decreases in liabilities. What are expenses? Expenses are decreases in assets or increases in liabilities. When liabilities increase, then that is as a result of the expenses. Then there is assets. What are assets? Assets, or an asset, is a present economic resource that is controlled by an entity as a result of past events. What are liabilities? Liabilities, or a liability, is a present obligation of the entity to transfer an economic resource as a result of past events. How about equity? Equity, learners, is the residue interest in the asset of an entity after deducting all its liabilities. We know from the balance sheet equation that assets equal liabilities and equity. So if you are to make equity the subject of that formula, then equity will be equal to assets minus liabilities. So these are the main elements of financial statements. Example of Revenues are things like sales, right? Revenues are items like discount received, commissions, and so on. Expenses are like airtime, telephone expenses, transport expenses, insurance expenses. You can name them, all right? Assets are like land. Land is an asset. Buildings are assets, all right? Prepayments, prepaid expenses are assets. Inventories is an asset. Then liabilities, accounts payable. Loans, those are liabilities. Okay? Equity, we're talking about here, capital. Reserves. Premium, share premium, and so on. So this would earn you how many marks? 5 marks. Identifying the elements will earn 5 marks. 1, 2, 3, 4, 5 marks. Let's now move on to answer part B. I read, Fatuma Ali commenced business as a result as a retail chemist. Fatuma Ali commenced business as a retail chemist on 1st January 2021 with an initial capital of 30 million shillings, which she paid into her business bank account. She hired a shop manager at an annual salary of 2 million shillings. In addition, the shop manager is to receive a commission of 10% of the gross profit. During the year ended 31st December 2021, Fatuma Ali did not maintain proper books of account. After an examination of the available records, the following information was extracted. The bank statement for the year ended 31st December is as follows. We have the receipts and the payments. Then below the bank statement, additional information number 1, I read, all sales were for cash and sales are banked. All sales were for what? Were for cash and sales are banked daily, subject to the retention of a cash float of 100,000 shillings. The following payments are made out of cash sales. We have the manager's salary, drawings, payments to suppliers, general expenses. Note number 2, I read, as at 31st December 2021, checks sent to suppliers amounted to 2.5 million had been presented to the bank for payment. Number 3, as at 31st December 2021, invoices from suppliers amounting to 8.6 million had not been paid. Number 4, as at 31st December 2021, inventory was valued at 36.5 million shillings. Number 5, depreciation per annum is to be provided on material vehicle at the rate of 25% on cost and on the shop fittings and equipment at 10% on cost. Note 6, during the year ended 31st December 2021, Fatuma Ali took goods which cost 100,000 shillings for her personal use. Required 1, statement of profit or loss for the year ended 31st December 2021. How many marks? 8 marks. 2, statement of financial position as at 31st December 2021. How many marks? 7 marks. 7 marks. This is part B. Statement of profit or loss. The name of the business, Fatuma Ali. Fatuma Ali. Fatuma Ali. Fatuma Ali. We are preparing statement of profit or loss as at what? For the year ended, the period is 31st December 2021. 31st December 2021. This is a statement of profit or loss. And in part A, we said that the elements of a profit or loss include revenues. So we're going to begin here with the revenues. The revenues are in millions. Fatuma Ali revenues. So the first revenue here is the sales. Sales. for us to calculate sales, we need a working because the sales are not provided clearly in the question. Why? Because Fatuma Ali did not maintain proper books of accounts. If Fatuma Ali prepared proper books of account, then these sales we need to pick it from the trial balance. But here there is no trial balance, therefore we are going to use the information provided to determine the sales. So working number 1 will have sales. Working 1. And from the receipts, from the bank statement, we can see we have sales amounting to 123,720 shillings. In addition, information number 1, we read that all sales were for cash and sales are banked daily. All sales are what? Were for cash. That means the customers were not allowed to pay by check. It was just by cash. And sales were banked daily, subject to retention of 100,000 shillings float. So the payments that were made out of cash sales, we have manager's salary, drawings, payments to suppliers, and general expenses. That means that when Fatuma Ali received cash from the customers, that cash was used to make cash transactions, and they are listed. So when preparing the sales account, these are the items to include in the sales account. Working 1, these are workings. 1 sales account. Sales account working 1. Now in note number 1, candidates, we read that all sales were for cash and sales are banked daily, subject to retention of a cash float of 100,000 shillings. So all sales were for cash. What does that mean? That means that Fatuma Ali sold on cash basis. The customers paid in cash, and all the cash was banked. So if we check the bank statement, you can see the second item on the debit side of the bank statement reads sales 123,720. So that's the first item to recommend to record in this account, bank 123,720. So out of the cash that was received, 123,720 was banked. But we read in note number 1 that not all the cash that was received was banked. Part of that money was spent, and we've given the items here. So we're going to prepare another account, which I'll call cash account. The cash account, because some of the sales that were received were paid out of cash. And the first item there is manager's salary. The manager's salary was paid out of cash, because when you pay salaries, you credit the cash account and debit the salaries account. So here we have 1.98 million. 1.98 million. The second item, drawings, 4 million. The third item, payment to suppliers. Suppliers were paid how much? 1390. General expenses. General expenses amounting to 840 was also paid from cash. Then there is also the float, retention of 100,000, float of 100,000. So these are the payments that were made out of the cash sales. So I'm going to have the total 1980 plus 4 million plus 1390 plus 840 plus 100 is 100, which gives me here 8,310,000. 8,310,000. So the balancing figure, we need to balance this account by transferring all these amounts, which is a total of 8,310,000. This amount we transfer to the sales account. Sales account. So this amount is transferred from cash account to the sales account. So we record here cash 8310. 8310. So these two will constitute the sales for the year. So there are sales that were banked and sales that the amounts that are used to pay these expenses, 8,310,000. I'm going to get the total 123,720. The amount that will be transferred to the statement of profit and loss is 132,030. 132,030. 132,030 is the figure for sales, working number 1. 132,030,000. 132,030,000. That is sales for the accounting period ending 31st December 2021. So what is the cost of these sales? Cost of sales. We read from this question that Fatuma Ali commenced business as a retail chemist on 1st January 2021. That automatically tells you that Fatuma Ali did not have opening inventory because it's only been in operation for 1 year. So there is no opening inventory, but we have purchases. Purchases. Again, purchases are not provided directly from the question because the businesswoman did not maintain proper books of accounts, because if proper books of account was prepared, then we could simply pick the purchases from the trial balance. Therefore, we must have a working for purchases. Purchases account. This is working number 2. Purchases account. We'll go through the question and identify all the items that are to be effected or to be transferred to the purchases account. And I want you to look at the bank statement first of all. The bank statement, we have payment to suppliers of 112,360,000. Payment to suppliers. You can see the bank statement is credited. Therefore, the purchases account will be debited with the bank. The amount there is payment to suppliers 112,360. 112,360. Then additional information. We read in note number 2 that as at 31st December, checks sent to suppliers amounting to 2.5 million had not been presented to the bank. So suppliers were paid there. We have checks amounting to 2.5 million. 2.5 million. Those are checks. Note number 2. In note number 3, as at 31st December, invoices from suppliers amounting to 8.6 had not been paid. So these are invoices. Invoices amounting to 860. This is 8.6 million. 8.6 million had not been paid, so we debit the purchases account with 8.6 million. Then depreciation, note number 6, we read, during the year ended 31st December 2021, Fatuma Ali took goods which cost 100,000 for her personal use. That is an amount that we'll have to have it here as drawings. Drawings, we'll have drawings there. Then we see in note number 1, payment to suppliers. That is payment to suppliers, cash payment to suppliers. Out of the sales that were received, suppliers were paid. As we saw here, suppliers were paid. These are purchases, 1390. So these are the items that will enable us determine the purchases for the year. Purchases for the year. We are going to get the aggregate. Aggregate, we add 360 plus 2.5 plus 86 plus 1390. The total 124, 850. So this is what will be transferred to the statement of profit or loss. 124, 850. 124, 850. 124, 850 is the value for purchases. This is 124, 850. 124, 850. Then there is the drawings of, that is the last note. During the year, Fatuma Ali took goods which cost 100,000 for her personal use. These are drawings of 100,000 shillings. Drawings, 100,000 shillings. The drawings reduce the reduction in the goods that are available. Then do you have closing inventory? Closing inventory. The closing inventory note number 4 was valued at 36.5 million. Closing inventory. Closing inventory note number 4, 36.5 million. So that will be the cost of sales. We're going to add 124, 850 minus 100 minus 36.5. Cost of sales 88, 250. Deduct cost of sales from sales of 132, 030. The gross profit 43,780,000. This is the gross profit. I hope you are also confirming candidates, the figures, the gross profit. Are you arriving at 43,780,000? Yes. Then the second element in the statement of profit or loss is what we call expenses. What are the expenses? We again run through the question, identify the expenses. First of all, let's look at the bank statement. Are there expenses from the bank statement? Yes, we have interest on bank loan. Interest is an expense. Interest is an expense, 1 million. Then there is the general expenses. general expenses, we'll have a working for general expenses. Why? Because general expenses were paid through the bank. Then there were also that were paid out of cash. General expenses were paid out of cash. General expenses will be equal to the amounts that were paid through the bank of 83.35. So we have 83.35 plus the amounts that were paid from cash note number 1, general expenses 840. These two will give the total value for general expenses 83.5 plus 840. General expenses 91.75. 91.75. That's the value for general expenses. Then from the bank statement, rent was paid. Rent is an expense. Rent is an expense, 37.50. 37.50 is the value for rent. Now let's check from additional information. Do we have any expense? Manager's salary. Manager's salary is an expense. Manager's salary, that is an expense. Manager's salary is an expense. And you recall, candidates, that in sentence 2 of the question, that Fatuma Ali hired a shop manager at an annual salary of 2 million. In addition, the shop manager is to receive a commission of 10% of the gross profit. And from the trial balance, from the bank statement, there is no payment for the manager's salary, neither the commission. But in note number 1, you can see that the manager was paid 1,980,000, meaning that this manager, there is salary owing. The business owes the manager some amount, because the amount ought to be 2 million. But for the purposes of preparing the statement of profit or loss account, we need to indicate the total value, whether the money was paid or not. So the manager is paid 2 million. Are you clear on that? 2 million. That means that out of this 2 million, only 1,980,000 was paid, but 20,000 is due. That's outstanding manager salary. Then below here, we need to indicate the commission. This manager we read is also paid commission of 10% on gross profit. So 10% of gross profit, the gross profit 43,780. 10% of 43,780,000 is equal to 43,78. So 10% of 43,780,000 is equal to 4,378,000. That is the commission. Is there any other expense? Yes. Look at note number 5. Depreciation per annum is to be provided on motor vehicle at the rate of 25%. Depreciation is an expense. Depreciation. This depreciation should the rate should be applied on motor vehicle, one motor vehicle. The rate for motor vehicle is 25% on cost. So this is 25% times the cost. The cost is to be found in the bank statement. That is item number 3 on the credit side of the bank statement. Motor vehicle 2740. 2,740,000. So 25% of that is 2740, which is equal to 685,000. That is depreciation, motor vehicle depreciation. Another asset that is depreciated is fixtures and equipment. Fixtures and equipment is to be depreciated at the rate of 10% on the cost. So let's identify the cost of fittings and equipment. Fittings and equipment is the second item on the bank statement. That is 8,800,000. 8,800,000. 10% of 8,800,000 is 880,000. So candidates, what else do we have here? Going through the question again, I don't see any other expense. We have salaries. That is manager's salary. We've identified it and recorded it. These are the only expenses. So you're going to get the total expenditure, then deduct from the gross profit. Total expenditure 1 million plus 9175 plus 3750 plus 2 million plus 4378 plus 685 plus 880. Total expenditure 21,868, deduct from gross profit of 43,780 is equal to 21,912. That's the net profit. Net profit. 21,912,000. We've answered part B. Let's answer part C. That is part. This is B1, then B2, the statement of financial position for Fatuma Ali. Fatuma Ali, statement of financial position as at 31st December. Statement of financial position. What are the elements of a statement of financial position? Assets. The first element. We're going to record the non-current assets first. Non-current assets. So we're going to have here the cost, net book value, the depreciation, and the cost in thousands. The first asset is leasehold premises. Leasehold premises, 20 million, zero depreciation, 20 million book value. The next one is fittings and equipment. Fittings and equipment, cost 8.8 million. Depreciation on fittings. These are fittings and equipment depreciation, 880. 880. Net book value is a difference between the cost and the depreciation, 800 minus 880. Net book value 7920. Motor vehicle cost of motor vehicle 2740. Depreciation on motor vehicle is 685. Net book value is the difference between the cost and the accumulated depreciation. The difference 2740 minus 685, and net book value 2,055,000. These are the non-current assets. Going to total here and close, total there and close, total but don't close. Then we move on to the current assets. Current assets. The first current asset here is inventory. Closing inventory note number 4, 36.5 million. 36.5 million. The next one is bank. That is a balance carried forward. That is balance carried forward or balance carried down. 16,735. 16,735. What else? I draw attention to note number 1. All sales were for cash and sales are bank daily subject to retention of a cash float. So that is a cash, which is a current asset, 100,000. So we get the total. We'll add to the non-current assets. I'm moving on to calculate the liabilities. This will give us the total assets. Let me get the total assets. Total assets, I'm adding here the net book values, 20 million plus 79, 20 plus 2055, 29, 975. Going to add the current assets, 36.5 million, 36.5 million plus 167.35 plus 100, 53,335. Total assets plus 29,975. Total assets 83,310. So these total assets are financed by, first of all, we have capital. From the first statement, we read that Fatuma Ali commenced business with the initial capital of 30 million. So capital here, 30 million. Then there is, we add the net profit for the year, 21,912, 21,912, 21,912, and then before I get the total here, I'm going to deduct the drawings. Drawings from the cash account, we saw that Fatuma Ali withdrew 4 million. 4 million, that is from cash. When you check the last additional information, we read that Ali took goods. Fatuma Ali took goods worth 100,000. These are drawings in form of goods. So we add to the cash, giving a total of 4.1 million. This we deduct. Drawings reduce the capital. So we are going to add the 30 million plus profit 21,912 minus 4.1. So here we have capital of 47,812. Then these total assets were also financed by non-current liabilities, non-current liabilities. We have one non-current liability known as bank loan. The loan is a non-current liability because Fatuma Ali is expected to repay this loan for a period of more than 12 months. So there is a bank loan on the debit side of the bank statement, 20 million. 20 million. We are going to add current liabilities. Current liabilities. The first current liability is accounts payable. Accounts payable. Candidates, accounts payable, you can see in note number 2, checks sent to suppliers amounted to 2.5. Had not been presented to the bank. Okay? 2.5. Then in note number 1, we read that payments were made to suppliers. So we are going to add, as at 31st December 2021, checks sent to suppliers amounted to 2.5 had not been presented to the bank. That means that these suppliers had not been paid, because for the suppliers to be paid, the checks must be presented to the bank. They must be presented to the bank. That means the amount was not deducted from Fatuma Ali's account. So that still remains a liability. But in note number 1, we have those suppliers that were paid. 1.39 million was paid from cash, and therefore the accounts payable will be equal to 2.5 million plus note number 3, invoices from suppliers amounting to 8.6 had not been paid. These are invoices to suppliers that had not been paid. Suppliers had supplied the goods, but they had not been paid. So if they had not been paid, then that's a liability, 8.6 million, 8,600. So we're going to add 2.5, 2,500 plus 86. So total current liability for this account payable, 11,100,000. Then another item here under current liabilities, remember the manager's salary. The manager's salary. The manager salary is 2 million per year. From the bank statement, we read that the manager was only paid, that is from the cash, manager was only paid 1,980,000, meaning that there is accrued salary. Or let me write salary due, the same thing, or salary outstanding, salary, manager's salary due, 20 million. The manager was expected to be paid 2 million, but he was only paid 1,980,000, meaning 20,000 is due. Then from the records provided, there is no account where the manager's commission is to be paid. We read that the shop manager is to receive a commission of 10% of the gross profit. From the bank statement and the cash payment, no commission was paid. So therefore, that commission is also a liability, commission due. We had calculated the commission due here, 43.78. 43.78. So these are the liabilities. We have the long-term liability, 20 million. Then the short-term liabilities, I'm going to add the short-term liabilities, 111.00 plus 20 plus 43.78. 15.49.8 plus 20 million plus 47.812. So I'm getting here 83,310,000. This is total equity or capital and liabilities. The total equity total equity plus liabilities should always be equal to the total assets. You can see here the total assets 83,310,000. 83,310,000. So that marks the end of the question. We've done part A of the question, 5 marks. Part B, Roman 1 of the question, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. All these marks give a total of 8 marks. All the ticks will earn 8 marks. Then we have the net book values here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. The 16 ticks will earn you 8 marks. These are they 8? These are 7 marks. 7 marks. So, learners, this is a question that tested the candidate's knowledge in preparation of the financial statements from incomplete records. Fatuma Ali did not prepare complete records, did not maintain proper books of accounts. So I want you to expose yourself to various scenarios of improper records. This question can come in various ways. We covered this one in the normal video lectures. We've done several past paper questions in relation to preparation of statement of financial position based on incomplete records or improper books of accounts. And if you have any question, please feel free to send it. Below this video, there is a comment section where you can post your questions, and all your questions will be answered. In our next session, we're going to answer question number 3. I urge you to go through question number 3, attempt it. It's a question testing you on the area of not-for-profit making organizations. This is the financial statements of the organizations that whose objective is not to make profit. Thank you. God bless you. Bye-bye.
Yes, welcome to our revision series. Last we were looking at question 2, the whole of it. And as I said earlier, we emphasize the areas which is still retained in the syllabus. And for that matter, question 3, the 2 sections, we are not going to deal with them because question 3A, dealing with simulation and modeling, is not there in the syllabus. Question 3B is the solution printout from the computer softwares, which is dealing mainly with sensitivity analysis on linear programming. We are supposed to get the basic of actual working of simplex. So that one also we omit. Instead, we look at question 4A, which reads, enumerate 8 applications of quantitative analysis in business. Enumerate 8 applications of quantitative analysis in business. Now, first of all, that is question 4A. Quantitative analysis is a process of collecting and evaluating measurable data such as revenue, wages, stock shares, etc., in order to determine their behavior in the long run. So that is the ideal reason why we have it's a process collecting and evaluating. So you see, measurable means we are talking about numerical values, and that is what we have. So the first case that we look about here is we talk about the process here in project management. We are supposed to enumerate, so I can write them down and then explain. When we talk about a project comprises of series of activities. For example, you want to put up a factory. You want to put up a machine, even a posho mill. You have to evaluate what is the likely return from this my posho mill. That is, from the start, you have what we call capital investment. How much is the machine or posho mill costing, and so on. So the project management is that, in this case, what's the likely returns for my posho mill first year, second year, and so on. That is what we'll be calling project management. Even if you talk about putting up a rental building, you must have first incurring the capital cost there. What's the likely return for my business? How do I reschedule whatever I have that I have now to put up a building? Instead, maybe posho mill. What can I do? Posho mill might give me quick return, or that. That is, in terms of computation, we apply quantitative analysis for that. That is one aspect where we can apply the quantitative analysis in business, because even if you have plots and the rest, these are business entities which will generate income for an individual, so they are helpful in business. Number two, we have this one in the production management is one area. You know, production means that we have to talk of the so-called the inputs and the output. The raw materials, how many bales of cotton lint are needed for this case to produce an output of a given kind of shirts, which are cotton or what. So that is what we call production management, because for every production, there is always what we call input and then output. Therefore, in quantitative analysis, we have that particular topic which is referred to as input-output analysis, so that you can find how much raw materials are required to produce a specific output. That is production management, and we are deploying the skills of quantitative analysis, raw data and the output, raw data and the result. Remember, there is also the cost, because for you to have raw data, you acquire them from another sector. Therefore, this input-output analysis purely deals with the inter-sector relationship. How much do I depend on the other for me to produce? That is production management. Next, we have marketing. Now, in marketing, you have to purely handle the area of taste. You have heard several times whereby we have people have to go and advertise. The purpose of advertising is simply to find how much is the advertising impacting on actual sales. For example, if I talk about putting an advert for a sale of, say, cooking oil, how much do I have to spend on this particular item, and how much do I actually realize at the sale? The major idea here is to employ the idea of correlation. So the correlation will tell you whether you are spending more on the advert and also the actual sales are also more. That will show you that there is positive correlation. If there is no positive correlation, then it is pointless to do extensive advert, because at the end of it, you may not do or realize your expenditure in terms of income. So what I'm saying is that under quantitative analysis, we have various sections that will be useful to analyze and apply to various sectors, because now for the marketing, you need to know how much is the advert affecting the actual sales. How much, for economists, is the savings connected to income, so that you can see how is the economy stable or what. That is still under correlation, and if by extension you can now talk about regression. All these are now for focusing purposes. But remember, we are talking about marketing. How much do people prefer our bank? As you are a bank manager, we have marketing department, any other, Safaricom, the service industries, all those are related. So we have marketing also deploying the skills of quantitative analysis. The fourth one we have here is what we call finance. You know, finance sometimes is difficult to that. So accountants use different quantitative methods to do forecasting, because if you talk about projection in the companies, then you have acquired an asset. So the accountants can use the techniques like the rates of interest to do discounting. Discounting will actually help you to determine the actual return of this particular kind of project. Just remember, we talked about production and the other side project, but the discounting factor, the knowledge of discounting factor, rates of interest that is actually available, should be able to assist the finance or accountant in determining the viability, because we have the viability will be having that what we call net present values and the rest. These are out of discounting factors, and therefore they are quantitative in nature for their computation. They'll have the finance section, and therefore we say that quantitative analysis is applicable to finance section and can be used from the particular area of discounting in terms of returns of investment. Therefore, finance utilizes the quantitative analysis techniques. The fifth one would be for personnel. management. This one is where we talk, currently we don't talk about personnel officers, but we talk about HR, human resources managers or officers. They need to know how much do we need to retain, how much people, how many employees, the staffing for that matter. Now, if you look at the quantitative analysis, areas such as Markov analysis, Markov will show that how much do you have as exit. You know, in employment, we have exit and entry. How much do we have as exit? How much do we need to retain as a stable staff size? So that for every exit, due to maybe retirement, dismissal, sickness, and the rest, how much do we need to employ? Therefore, under the skills of Markov analysis, the HR people department can determine the stable size of staffing and, if possible, even upward mobility by training them or what we call capacity building. Therefore, it is important to note that even personnel management, which is particular human resource management, employs or applies quantitative analysis technique. It may not be all that simple, but in general, we know that, for example, right now, the government is not employing, or in particular, if say Teacher Service Commission, each and every year there's always a fixed number advertised for a teachers, secondary school and primary school. In effect, the size of labor force TSC remains the same, round off around 300,000. So which means, what's the plan for the exit and what's the plan for the entry? That is, in particular, area of Markov analysis, that is quantitative analysis coming in. Now, the other one I can talk about is agriculture. Remember, they are using tools which are mainly quantitative in nature. So, when we talk about agriculture, the farmers can use decision theory in that we can now see what are the prevailing conditions. We are here in the month of September. What is the prevailing condition? In this case, as a farmer, do we have adequate rain? And if so, with that assumption of the flow of adequate rain, the farmers can adequately determine the kind or the right crop to plant, given the fact that if you're in short rain season, there are certain plants that may require only short rains or little rain, for that matter, to mature up. So the knowledge of decision theory, and in particular maybe the states prevailing long rain, unfortunately because of the climatic changes which are experienced all over the world, it has become very difficult to predict how much rain we expect particular point. But what we are saying, in a normal circumstance, if farmers would be able to determine the prevailing condition, they can predict and focus the kind of crop to put up based on prevailing conditions, weather, as well as their ability, which is the strategies as how do I need labor force or farm machinery, all that they can help. Finally, we have this, this is not final, but I have this 7. I can have this area, what we call the purchase and inventory. This would be under what we call inventory planning and management, purchase and inventory. Now you see, in the operations of production, there is always the acquisition of raw material. There is the time, the lease, or whatever we need. Now, with the knowledge of quantitative analysis, I think the farms can be able to determine how much to stock, how much to acquire, or how much to order, and how much it will cost. So all those management control and inventory control, they'll be utilizing the techniques of quantitative analysis, and for that matter, it is important that inventory control or purchase or procurement, they require the knowledge of quantitative analysis. And the last one is, we call it research. We call it research and development. Research and development. Now, what are you saying? That managers can use mathematical techniques to determine eventual profitability in certain inputs, or what we call managers can actually determine the profitability of new products, may say in the market, in terms of probability of their success or failure. So with this, you can now see how much can we now develop for this kind of product, because if we talk about maybe a new kind of maybe like the consumer industry, we have various kind of goods, be it in the cosmetics, be it in the cooking area, be it in the textiles. All these, with the probability of success, the research can be conducted and predict what kind of item you can engage it. And therefore, with this, among others, remember the various techniques, even regression, correlation, and linear programming, they are all these, because in linear programming, we talk about personnel management under what we call the assignment problems, and those ones, those not in the new syllabus, but then they are all coming, personnel management still under Markov, and even assignment, they're all under the quantitative analysis areas. So for that matter, these are the summary of various areas in which we can apply the quantitative analysis. And that is all we have. Thank you very much. As I said, we are handling only that question 4A. Question 4B, we are not looking into it because dealing with game theory. And question 4C is dealing with the queuing problem. The 2B and C are not actually retained with the current syllabus. For that matter, we are not going to do those questions. We only have to handle question 4A, which was enumerate 8 applications of quantitative analysis in business, and that is 8 marks. So we stop there for that question and move on to the next, if there is any other that will still be retained in the current syllabus. Thank you very much.
Hello learners, and welcome to Manifested Publishers online revision classes. My name is Nicholas Sikali. We want to continue the revision by going to question 4 of financial reporting, August 2022. Now, the question had 2 parts. There was part A and there was also part B. We are going to start with part A, then we'll proceed to part B. So the question reads, on 1st January 2019, Breakwood Limited entered into a contract to lease an item of plant and equipment from a supplier for a 3-year period. The terms of the lease were that Breakwood Limited was to pay 500,000 shillings each year, with payments commencing on 31st December 2019. Initial direct costs incurred on the lease amounted to 30,000 shillings and were paid for by Breakwood Limited. The plant and equipment had a remaining economic useful life of 5 years at the inception of the lease. The lease contract did not contain any purchase option for the leasee. Breakwood Limited can borrow at a rate of 10% per year. Required, analyze the accounting treatment of the above lease transaction from inception for the 3-year period of the lease contract. So this question is concerning IFRS 16, which talks about leases, Remember, this was transited from IS 17, which also used to talk about leases, but now, according to the subsequent or the amendment that were done, now we'll be following the requirements or the requirements of IFRS 16, that is leases. Now, to account for this lease from inception, that means that we are supposed to, 1, compute the lease liability, and 2, we are supposed to compute the value of the right of use asset. Remember, according to the provisions of IFRS 16, a lease will be accounted for as a finance lease unless the lease is of low value. So if the lease is of low value, then it will be accounted for as an operating lease. But otherwise, all leases will be accounted for as finance leases. So workings, and our first working, we want to get the lease liability, which have not been given here. Lease liability here will be the annual lease payments, that is the lease payments times the present value interest factor of annuity R% n periods. That means you take the annual lease payments and discount them back to the present by using the present value of annuity. Remember, we are using the annuity because the lease payments are made at shillings 500, which is constant per annum. So we are going to use the present value interest of annuity. The annual payments, the lease payments were 500. That is to be multiplied by the present value interest factor of annuity. We were given the discounting factor or the borrowing rate, which is 10%. So that will be computed by taking 1 minus 1 plus 0.1 raised to power negative 3, because a period of 3 years. Then we divide that with the R, which is 0.1. This will give us the lease liability, and the lease liability will amount to the following, and that is 500,000 times 1.1 raised power negative 3, 1.1 raised power negative 3, 1 minus answer, divided by 0.1, which is 2.48685. Can use with 85. That will give you a lease liability of 500,000 times answer 1,243,425 425.995. So that is the lease liability at inception, which follows up with the computation of the right of use asset. So how do you get the right of use asset? Right of use asset. So with the right of use asset, this will be the computation for the right of use asset. Now we start with the lease liability. And the lease liability amounted to 1,243,425.995. Add, from that we want to add the initial direct cost, and the initial direct cost amounted to 30,000. So 30,000. Before we get the total, you are supposed to deduct any lease incentive less any lease incentive if given. Any lease incentive, this one is nil, so we are not given any lease incentive, then this will be the right of use asset. The cost of the right of use asset will be what will be given here. Right of use asset. Right of use asset. Now the right of use asset will be what you have plus 30,000, and your right of use asset is 1,273,425.995. That is the value of our right of use asset. So once we have the right of use asset and you also have the lease liability, our next option is to see how they are accounted for at inception. So we want to see how they are accounted for at inception. Accounting treatment at inception. Accounting treatment at inception. Accounting treatment at inception. That's accounting treatment at inception, which means that we will be debiting a few things and crediting others. So with the right of use asset, of course, you debit the amount, debit right of use asset of use asset. We are debiting the right of use asset, and the amount that you are debiting that is maybe we are debiting it with 1 million, or because of space it has come up with a more clearer way. So debit and credit. So we have right of use asset, right of use asset. We are debiting 1,273,425.995. You debit the right of use asset with that amount. Then what are we crediting? We are crediting one, bank. There's amount that was paid in bank. The initial direct cost of 30,000. The initial direct cost of 30,000 will be credited. Then we also credit the lease liability. Lease liability. The lease liability amounted to 1,243,425.995. So that is also to be credited there. So if you, at inception, that is the first thing that they did, they debited the right of use with this amount. Then they credited bank because they paid initial direct cost of 30,000. Then you also credit the lease liability of 1,243,425.995. If you add these two, of course, this journal will balance. That is accounting treatment at inception. Accounting treatment at inception. What follows is subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent measurement. And according to what the IFRS presents or provides, after the initial treatment at inception, then the second thing is that the right of use asset will be depreciated annually, of course, on the straight-line method here. Then another thing that will be happening subsequent to the initial measurement is that the lease liability will have to be amortized. So we'll be doing the amortization schedule so that you can see how the lease liability will be amortized. But before that, let us calculate depreciation. Depreciation per annum is going to be as follows. We have the right of use asset amounting to 1,273,425.995. 0.995. Just divide that with 3 to get your depreciation charges per year. That will give you some answer. That is 273,425.995 divided by 3. Depreciation per annum is 424,475.33. That is 0.33. 475.33. That is depreciation per annum. So that is 1273,425.995 divided by 3. It's 424,475.33, and perhaps 17 at the end, but it can stop there for that thing. That is depreciation that will be provided annually. When we have the amortization schedule, we also want to do the amortization schedule. Amortization schedule, because we said subsequent to the initial measurement, the asset will be depreciated, then the lease liability will be amortized. So the lease liability will be amortized. So this will be this way, and we have a long schedule here, very long schedule for 3 years. So here 1, 2, 3. So we have 3 years. Perhaps should have that for 3 years. 3 years. So here, opening obligation. Opening obligation. Opening obligation. We have finance cost. Finance cost. We have installment, the annual installments paid. We have principal. And finally, we have closing obligation. Closing obligation. So we have closing obligation, we have principal, we have installment, we have finance cost, and we have opening obligation. For installment, this one has been given as 500 through 500,000, 500,000, and 500,000. That is constant for installment. The beginning obligation of the lease liability, is 1,243,425.995. So finance cost is at 10%. So 1,243,425.995 times 0.1. That is 124,342.59, and principal will be 500,000 times answer. 500,000 times answer that you have here, 375, 657.4005, that is 0.4005. The closing balance is the opening balance, of course, minus the closing balance, minus the principal. So that is 1243,425.995 minus the answer, 867, 768.59, 768.59. So that will be 867, 768.59, of course the other one is 45 on the other side, times 0.1, which is 10%, 86, 776.859, then 500,000 minus that answer, 413, 223.14. So 413, 223.14. Then we are going to take 867, 768.59 minus that answer. You get 454, 545, 545.44, 44 cos 95, so 454, 545.44, it is 95 on the other side, 4495 times 0.1, we get 45, 454.54, it is 0.54495, I've abbreviated that. So 500,000 minus the answer to get the principal, which is 454, 545.45, 454, 545.45. And looking at what we have here to get the principal, that is usually opening obligation minus principal to get the closing obligation. If you minus this with this, the answer will be 0. That is 454, 545.45. If I round this one off, it will be 0.45 minus answer, it is 0, and the answer here will be 0. So that's how we run amortization schedule for a loan where the payments were being made in arrears. Remember here, the payments were being made in arrears and not in advance. According to what we had in the question, the payment occurred, or the first payment occurred on 31st December 2019. Remember, the financial year started on 1st January 2019 when the lease started, but the first payment was done on 31st December. That is payment being done in arrears. If payment are being done in advance, that will be a different story. The amortization schedule will change slightly if the payments are being made in advance. Once you've amortized, we now want to move to our financial statement extracts for the 3 years. So the financial statement extract for the 3 years, that will be Breakwood Limited, Breakwood Limited, Breakwood Limited, financial statement extracts, or statement of profit or loss extract. Statement of profit or loss extract for the 3 years, that is 2019, 2020, and 2021. The financial statement extract for those 3 years. The first thing will be depreciation. And of course, the other thing that they will present will be finance cost. Depreciation and finance cost. So we have depreciation and finance cost. Looking at our schedule, we have finance cost. Looking at our depreciation computation, we can bring in 424, 475, 475.33, that will be constant, or can just use 424, 424, 475.33, again 424, 475.33. That will be our depreciation for the 3 years, 2019, 2020, and 2021. That means we'll be debiting depreciation, of course, and we'll be crediting the asset or accumulated depreciation. Finance cost from our amortization schedule, this is 124, 342.59 for the first year. For the second year, which is 2019, that is 86, 776.85. Remember, second year represents 2020, first year represents 2019. The last one is 45, 454.54. So that will be what will be presented to the statement of profit or loss for those specific years. Since it's an extract, there will really be no need of summing them up. That is, if a summation is required, then you just sum them up and get the totals. Breakwood, again, Breakwood Limited, statement of financial position. Statement of financial position extract. Statement of financial position extract, again for 2019, 2020, and 2021. That is the statement of financial position extract. We could differentiate the two. So we go to the statement of financial position extract. The first thing is non-current asset. The non-current asset, we have the right of use asset. Right of use asset. Under the right of use asset, we computed the value for the right of use asset in our workings there to be 1273, 425.995. That will be the same through. This is 1273, 425.995. Same thing to the far end. Maybe I should round them off so that they can fit on them on my board, or 1,273,425.995. So that will be for my 2021. Accumulated depreciation. Accumulated depreciation. We have calculated depreciations here for 475.33, and for the second year it will be 475.33 times 2. This is 848, 950.66. What if we multiply with 3? It is 1,273,425.99. So that will be depreciation, accumulated depreciation, which will be deducted. This is 0. That one should be 0. This is 425 or 424. 475.33. Of course, this one will be 848, 950.66. So we are deducting from what we have below here. This will give you your net book value for the right of use asset. So this will be net book value. Net book value for those right of use assets. Once you have the net book values for the right of use assets, We move to non-current liability. Non-current liability. And we also move to current liability. Current liability. Current liability. Of course, we have the lease obligation. Lease obligation. And we also have the lease obligation. Under each, of course, the lease obligation at the end is divided into the non-current liability portion and also the current liability portion. Now, looking at our amortization schedule, the liability for 2019, the lease liability for 2019, the total lease liability for 2019, which is year 1, amounted to 867,768.59. That is the lease liability for 2019. If you are presenting it as one figure, obligation just for one figure, that means we'll be using 867,768. But it's usually a very good practice to separate this obligation at the end of 2019 into two portions. That is the current liability portion and also the non-current liability portion. Now for the current or non-current liability portion, the 867,768.59 is made up of two portions, the non-current portion and the current portion. This figure is made up of the principal here of 2020 and the closing balance here of 2020. That means when you take this and you add to this, you'll be getting the 867, which is the obligation for the year 2019. So if you want the non-current portion, you move a year down, and if you want the current portion, you also move a year down, which means that you are going to use 454, 545, 545.44. The current portion will be 413, 223, point, I believe that one was 0.4 as well. That one was 0.4. If I'm not wrong, that was 0.4. If you add these two, you are going to get the obligation. That was 0.45. 0.45. You are going to get the obligation up here of 867,768. The same case for 2020. The total obligation for 2020 is 454,545.44. That is for 2020. They presented by year 2 here. 454,545.44. That is the total obligation, which is divided into two portions, the current portion and the non-current portion. So the current portion is the principal, while the non-current portion is the closing obligation. So we don't have the non-current portion because it's 0, while the current portion is now 545.45. Can see, if you add this plus this, you get the obligation for the year 2020, which was the total of 545. Now there are those who will present as one figure. That's just a lease obligation as one figure, and if that is the case, then it means for 2019 you bring a lease obligation of one figure of 867. For 2020, one obligation for lease liability of 545. Then for 2021 there will be no lease obligation since you have 0. But it's a good practice to always separate them into the current portion and the non-current portion. For 2021 there will be no lease obligation. As you can see, it is 0, and therefore it means that there will be no lease obligation, whether non-current or current, in the 2021 year. So that is how part A of the question was supposed to be handled, and we've shown the accounting treatment at inception. Then we've shown for the 3 years the subsequent measurement in terms of depreciation and amortization schedule, how that is going to be reflected in the financial statements for Breakwood Limited, who was a lessee for that matter. We'll now be proceeding to the second part of the question.
Welcome to our today's session. Today we are looking at question number 3, Management Accounting, April 2022. Question number 3 reads, discuss 4 challenges that you are likely to encounter when installing a cost management system. So what are the challenges that one can encounter when installing a cost accounting system? Remember, you need to understand the qualities of the cost accounting management system for you to know the challenges that are likely to be incurred. But I'll go straight to answer the question. This is question number 3, part A. Challenges to be encountered. 1, you may have lack of support from the top management. 2, lack of cooperation from the staff. 3, we have changing environment. And number 4, we may have difference in lines of authority. So we were required to discuss 4, but I can give 5. Lack of clarity of objectives. So the main motive or intention of a cost management accounting system is it must be relevant and therefore be able to provide relevant information which the management can use for decision making. But when the installment process begins, there are some times when that process may have challenges, and some of the challenges is we may have lack of support from the top management. It is the top management that can facilitate or ensure that the installation of that system is done in the proper way, and again their support will ensure that the other staff also cooperate so that the system is installed effectively. So if we have lack of support from the top management, it may be a challenge during that process. The Roman 2, lack of cooperation from the staff. Sometimes if that installation of the system is something that maybe is to bring some changes, some staff may resist that change, and when they resist that change, they will not cooperate, and therefore, like when it comes to training, they may not be ready for the training, and it will drag the process of installation. Then changing environment. Sometimes we may have technological changes within the economy. Sometimes we have some systems that may become obsolete after a very short period of time. And because of that, when we are installing the system, you may not be able to detect, like it's a factor that is beyond the control of the installer to know whether we'll have future technological changes or not, which is a challenge. Then number 4, difference in lines of authority. This happens where we have people that are engaging in the process, but they have to report, or reporting is to different authority or authoritative people who have to ensure that ABC is done, And if you do not know your line of authority or where you are to report to, or maybe we have long procedures, then they may delay installation of that system. Then finally, we have lack of clarity of the objectives. What is that system meant for? You need to understand that for you to ensure that you make that system to match with the main objective of the business. So if there are no, if there is no clarity, then you may not be able to tell if that system will be a proper one. Then part B of the question, you are told that the following information is derived in relation to Baridi Co Limited. The annual demand of its product, branded D, is 30,000 units. The ordering cost per order is 2,500 shillings. The holding cost is expressed as a percentage of the purchase price at 20%. The following price ranges are given with their respective quantities. So you've been given a table showing the range, the quantities, and the price. And the question is, advise the company on the quantity to purchase. So again, to answer this question, we have different approaches that we use to advise the management that wants to buy a quantity that is above the economic order quantity. And therefore, when you look at this question, it is simply referring to a multiple price approach. So it is not a one price approach, but it is a multiple price approach. And therefore, how do we advise the management where we use multiple price approach? The first step is calculate the economic order quantity at the current situation of that farm. So we need to calculate the economic order quantity of that farm before we incorporate any quantity. So how do we calculate economic order quantity? Simply the square root of 2DC naught over CC, where D is the annual demand. So this will be equal to the square root of 2 times. D is referring to the annual demand, and we are told that the annual demand of its product is 30,000. So multiply that by 30,000. CO is referring to the ordering cost per order. You are told that the ordering cost per order is 2,500. Then divide by. CC is referring to the carrying or holding cost. And you are told that the holding cost is expressed as a percentage of the purchase price at 20%. So we are to get 20% of the purchase price, but you've not been given the purchase price. But if you look at that table, we have range 1, quantities 1 to 3,000, and the price is 21. So where no discount is given, it means that the goods will be purchased at the original price, and therefore to know the purchase price is from that range where the firm is buying between 1 to 3,000 units, and that is 21 shillings. Then simply solve it. When you solve this, you'll get 5,976 units. So this is the current economic order quantity at which the firm is placing orders. Then you also need to calculate the total cost. How do we calculate the total cost? Total cost equals annual demand. It is annual demand, so I'll give the formula D over Q times CO plus Q over 2 times CC plus PQ. So D is referring to the annual demand, Q is referring to the order quantity. For our case, the order quantity is the economic order quantity, and then CO is the ordering cost per order. So when you take this, is the same as number of orders times the ordering costs per order plus Q is referring to the order quantity divided by 2, which gives us the average stock times the holding cost per unit per annum, then plus the purchase cost. And the purchase cost is simply the cost of acquiring the product, which is simply the price per unit times the quantity. So to substitute this with figures, we'll have 30,000 units divided by the EOQ, which is 5976 units, times the ordering cost of 2,500 shillings plus Q is the order quantity of 5976 units divided by 2 times the holding cost, which was 20% of the purchase price. So this is 20% of 21. Plus the purchase cost is annual demand, which is 30,000 units. We multiply by the price per unit, and the original price is 2021. Then we solve that. This is 12,550 plus 12,550 plus plus 630,000. So the total cost will therefore be 655,100. So that means that if the firm is to buy without considering any discount, then this is the total cost that it incurs when it is buying 5,976 units. So that's the first step to consider. Then the second step is consider the lower class boundary. Looking at that table, you've been given the quantities which is in units, 1 to 3,000, we have 3,000 and so on. So our intention is to ensure we advise the management. The firm is already buying 5,976 units. So meaning we are to disregard all the other quantities that are falling below 5,976 units. And I'm saying that we consider that by looking at the lower class boundary. So meaning the other quantities will remain with is range 4 and range 5. This is at 7,001 and at 9,001. Those are the quantities that are above the current EOQ, and those are the ones we want to base on, so that we are disregarding all the ranges from number 1 to number 3. So once you have identified the ranges, we are to calculate the total cost at range 7,001 and at range 9,001. So beginning with at 7,001, total cost will be equal to, the same formula is applying. We have D over Q times CO plus Q over 2 times CC plus PQ. And so the annual demand, according to the assumptions, is it remains constant. So it is 30,000 units. Divided by the order quantity in this case is 7,001 times the ordering cost, which remains constant, plus order quantity In this case, which is 7,001 divided by 2, carrying costs are 20% of the purchase price. So when you look at that range, the purchase price is not 21, but it will be 20% of 15.5 plus the purchase cost, which will be now 30,000 times the purchase price of 15.5. Then you calculate. We have 10,713 plus, these are shillings plus. So this will give us 10,852 plus 465,000. Therefore, the total cost at that point will be equal to the total 486,565. So at 7,001, that's the total cost. We do again for 9,001. The quantity is remaining, that's 30,000 over 9,001. These are units. Plus plus 9,001 divided by 2 times 20% of the purchase price. At that point, the purchase price is 13 shillings. 13. Then plus the purchase cost, which is 30,000 multiplied by 13 shillings. Again, you get the total. This will give us 8,332 plus 11,701 plus 390,000. Therefore, the total cost will equal 410 and 33. So we want to advise the management. So which advice do we give? The advice is the firm should buy. We are comparing the total cost at the current situation, the total cost at order quantity 7,001 and the total cost at order quantity 9,001. Where are the minimal costs? So we advise the firm to purchase the order quantity that will enable them to make a saving. And according to this, the lowest cost is at order quantity 9,001. And therefore we give advice. Advice is the firm should purchase the order quantity, 9,001 to 10,000 units. So this will enable the firm to save. How much will it save? The difference between the cost, the current total cost, and that which we are advising it to. So that is 655,100 minus 410. It will be able to save 245,067. So that's the advice we give. Then we proceed on to part C of the same question. You are told that SICK Plastics Limited manufactures plastic components for water pumps. The following budgeted information is available for 3 of their key plastic components. So you've been given the selling price, direct materials, direct labor, we have units produced, and then additional information. Note number 1, the total number of units of each of the 3 products for the period are as follows. We have product X, W, X, and Y, number of purchase requisitions, and then we have number of setups. Then note 2, overhead costs have been analyzed as follows. Receiving, inspecting quality assurance, the amount is given. Production scheduling stroke machine setup is also given. Then required, determine the budgeted profit per unit of each of the 3 products using activity-based costing, or the ABC method. ABC method is where we believe that we have activities in an organization that causes costs to be incurred, and therefore we identify the activities causing costs to be incurred, we group them together into what we refer to as cost drivers. And then any activity that is causing that cost, the costs that are being incurred are now put together into what we refer to as cost pools. And so we are to use what we refer to as cost driver rates rather than the absorption rates that we use in the traditional method. So the method we are required to use is the activity base. How do we go about that? Step number 1, we are to calculate the cost driver rates. How do we calculate cost driver rates? This is simply equal to overhead cost, and we divide by the cost driver. So remember, the cost driver is an activity that is causing the cost to be incurred. So we have the cost drivers that have been given. Number 1 is number of purchase requisitions. So we have number of purchase requisitions. To calculate that, note number 2, we have overhead cost. So you will simply take 1,400,000 and you divide by the number of purchase requisitions, and remember you compile for all the products. So we'll have 1,200 plus 1,800 plus 2,000. This will give us the cost driver rate. This is 280. That is per requisition. 280 shillings per requisition. The second one is number of setups. This will be equal to 1,200,000. Divide that by the total of the number of setups for all the products. And this is 1,500 per setup. That's step number 1, calculate the cost driver rates. So once we have calculated the cost driver rates, we now calculate the total cost. And we are calculating the total cost based on the ABC costing system. So we calculate the total cost. We have product W, X, and then Y. So we begin with the direct materials. Direct materials. Direct materials the unit cost is 50 and the units that were produced were 10,000. We have direct materials. This is 50 shillings times 10,000. This will give us 500,000. This is for W, we have for X and for Y. For W, we have 15,000. This is still on direct materials. 15 times 15,000 units. This will give us 525,000. And for Y, we are taking, this should be 40 and not 50. X is 40 times 15,000. 40 shillings times 15,000, which is 600,000. And then Y is 35 multiplied by 18,000, which will give us 630,000. Then we move on to direct labor. Direct labor. So for direct labor, W is 30. We take 30 shillings. We multiply by 10,000. Which will give us 300,000. For X, we have 35 multiplied by 15,000. This is 525,000. For Y, we have 30 multiplied by 18,000. And this is 540,000. Then we get the prime cost. Show the prime cost. This will be 800,000. Then we get the totals for X. 1,125,000. Then for Y, 1,170,000. From there, we now calculate the production overheads or cost. So according to the question, we are using ABC. I can use production overheads. So the production overheads that we have are based on the number of requisitions. Number of requisitions. I'll just write requisitions. It's based on requisitions. And number of setups. So we are beginning with the requisitions. For W, the requisitions were 1,200 and the cost per requisition is 280. So to get the amount for product W, we are simply getting the cost per unit or per requisition times the number of requisitions, which was 1,200, and this will give us 336,000. Do the same for Y. Cost per requisition, 280 times number of requisitions, which is 1,800. This is 504,000. For Y, 280 multiplied by 2,000 requisitions. This is 560,000. Then we have setups. So the cost per setup was 1,500, and for W, we had 240 setups. So you take 1,500 times 240, which will give us 360,000. For X, 1,500 times 260, which is 390,000. And then the last one, X, is 1,500 times 300, which is 450,000. From there, we now get the total cost. We get the total cost. This is 1,496,000. This is 2,019,000. 2,180,000. The question required us to calculate the profit per unit of each of the three products. So once we have this, we have to show the profit and then the selling price. So we are to determine the profit, but we have not been given either the margin or the markup, though we have the selling price. So remember, profit is simply selling price minus total cost. And so we are calculating the total, the selling price. Once we get the selling price, we will use that to get the profit. We were given the selling price, we know the number of units that were produced. So for W, the selling price was 200 shillings per unit, and the number of units produced was 10,000. So this will give us 2 million. And for X, the selling price is 183 times 15,000, which is 2,745,000. For Y, selling price is 175 times 18,000, and this will be 3,150,000. So from there, we can calculate the profit. Profit is now the selling price minus the total cost. So we have 2 million minus 1,496,000, which will give us 504,000. Then for W, we have 2,745,000 minus 2,019,000, which gives 726,000. And then Y, 970,000. And that is how this question was to be calculated. So thank you, bye-bye. Let's meet in the next session.
Greetings to you all candidates. Today I'm going to answer question number 3, Advanced Financial Management. The sitting is November 2020. Question 3A, I read, explain the differences between the following terms as applied in mortgage and financial markets. Roman 1, primary mortgage market and secondary mortgage market, 2 marks. Roman 2, fixed rate mortgage and adjustable rate mortgage, 2 marks. Roman 3, lien and recourse, 2 marks. We'll first give the difference between primary mortgage market and secondary mortgage market. Candidates, the primary mortgage market is where prospective homeowners connect with primary lenders to secure mortgages for both owner-occupant and investment properties. Whereas secondary mortgage market is an expansive arena in which financial institutions and investors buy and sell mortgages. and the goal is to provide a reliable source of money that alleviates some of the risks associated with owning mortgages. That's the difference between primary mortgage market and secondary mortgage market. Roman 2, fixed rate mortgage and adjustable rate mortgage. A fixed rate mortgage is a mortgage loan for which the interest rate remains constant throughout the term of the loan or the term of the mortgage. Whereas the adjustable rate mortgage is a loan with an interest that changes. Lenders normally charge lower initial interest for the adjustable rate mortgage than the fixed rate mortgages. So candidates with the adjustable rate mortgages, the interest rate and the monthly payments change monthly. They may also change quarterly. They may change yearly, and so on. So that's the difference between fixed rate mortgage and adjustable rate mortgage. Roman 3, lien and recourse. Now, a lien, candidates, gives an individual or an entity a claim to a property until a debt is paid off. And if the debt goes unpaid, they have the right to take it back. Recourse, on the other hand, in a recourse, candidates, the lender can foreclose the secured asset and also has recourse to the borrower himself, which means that the lender can collect the debt from the borrower's unsecured personal assets and from his future income. That's the difference between lien and recourse. 2 marks. I'll now move to answer part B, which I read. The shareholders of Mali Investment Holdings have for the last 2 years managed to save an accumulated fund of 15 million shillings available for investment. A financial analyst they hired to appraise some possible projects they can invest in has availed the following information. There's a column for project, then another column for initial outlay, there is a column for expected return, then a column for standard deviation. The projects are PQRS. PQRS are the projects, and the initial cash outlay 9 million, 7 million, 6 million, 8 million respectively. Expected return is 12%, 21%, 16%, and 14% respectively. Standard deviation 2.5%, 1.8%, 2.3%, 1.6% respectively. The covariances between various projects' contribution are as follows. Project pairing PQ, the covariance negative 3.1, PR 1.3, PS negative 4.1, QR 1.5, QS 1.7, RS 2.7. Additional information. Number 1. The management is planning to invest by pairing the projects. Number 2, the maximum capital that can be invested is the accumulated fund as shown above. Number 3, any paired project is mutually exclusive and none of the projects is divisible. Required for each possible project, required, I repeat, required, Roman 1, for each possible project pair combination, calculate the expected return, correlation coefficient, and standard deviation. How many marks? 12 marks. Roman 2, advise the shareholders of Mali Invested Holdings on the optimal project pair based on the mean variance criterion. How many marks? 2 marks. That's question 3B, November 2020, Advanced Financial Management. We are going to take, first of all, question B Roman 1. For each possible project pair combination, for each possible project pair combination, calculate expected return, calculate correlation coefficient, calculate standard deviation. First of all, candidates, we need to first of all get the possible project combination. Possible project combinations. Okay? The question does not give this project combination. We are told that the management is planning to invest by pairing. And this company has a limit on capital as indicated in additional information number 2, that the maximum capital that can be invested is the accumulated fund. And the accumulated fund, we read in the first sentence that the accumulated fund of 15 million shillings is available for investment. So the company has 15 million shillings, and the company can invest this money by pairing the projects. Like you can see project 1, which is project P, the initial cash outlay is 9 million. Project Q requires initial cash outlay of 7 million. That means project P and Q, combination of project P and Q is not possible because the total amount required to invest in project P and Q is 16 million, yet the maximum, the limit that the company has is 15 million. So project P and Q, combination project P and Q is not possible. But if you check project P and R, candidates, you can see project P requires 9 million, project R requires 6 million, which is equal to 15, this is equal to 15 million. Another combination is project P. There's no another combination with project P other than this R. The next one will be project Q and project R. Project Q and project R. The total initial cash outlay will be 7 million plus 6 million, which is equal to 13 million. Another combination is project Q and project S. The total initial cash outlay will be equal to 7 million, 8 million, 15 million. Then lastly, candidates, we can combine project R and project A. 6 million plus 8 million is equal to 14 million. That's the possible projects pair combination. Possible project pair combination. We have it right there. Now that's the starting point. It's on the basis of this possible project combination that we can now go ahead and calculate the expected return. The expected return. We'll first start with the expected return for the first possible project combination, PR. And to make our work easier, we will also calculate the correlation coefficient for project combination PR. We also calculate the standard deviation for project combination PR, and so on. So, what is the expected return for project combination PR? We'll have a small table here. First column is project project. This project is PR, P and R. Then another column is the initial capital. Initial capital, project P, 9 million. Project R, 6 million. Then you'll have the weight. The weight is going to be 9 million plus 6 million, 15 million. The weight for project P will take 9 million divide 16 million. That will be the weight. 9 million divide 15 million. 0.6, that's the weight. Then 0.4, that's the weight for the second project. Then the other column is the expected return. We have expected return. Yes, in the question, expected return project P is 12%. Project R, expected return 16%. Therefore, candidates, another column is now the, we are going to calculate, we are going to multiply the weight, this weight, by the expected return to get the expected return for project PR. Expected return for project PR. We multiply and then add. We multiply this weight, 0.6 times 12% plus 0.4 times 16%. We get the total there. That will be the answer for expected return for project P, combination PR. So candidates, we have 0.6 times 12, 7.2%. Then 0.4 times 0.16 is 0.064. We'll add the 2 plus 7.2. This is equal to 7. Let me take it again. 0.4 times 16. This 6.4. 6.4 plus 7.2. 13.6% is the expected return. This is the expected return for project PR, combination project PR. Then the question required candidates to compute the correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Correlation coefficient. Now the correlation coefficient, candidates, will be equal to the covariance of project PR divide the standard deviation of P times standard deviation of R. Covariance of PR, covariance of PR, which we have in that question, candidates. We have the covariance of PR. PR is 1.3. It's 1.3. The standard deviations are also given in the question. For project P, standard deviation project P is 2.5 times standard deviation for project R. R is 2.3. 2.3. That will be equal to 1.3 divide by 2.5 times 2.3. This is equal to 0.23. 0.23 is the coefficient, correlation coefficient. Then we are required to compute the standard deviation. This is the standard deviation for the portfolio. We have the standard deviation for the individual projects. Here we'll compute the standard deviation for the portfolio. These are two projects. Standard deviation will be equal to, this is standard deviation for project P R candidates. The formula is that this is equal to this square root. We're going to get the square root of weight of this, we're going to square the weight. We're going to square the weight of P, okay, weight of P, then we square the standard deviation of P, okay, square the weight of project P times the standard deviation of project P, then we add the square of the standard, the square of project, we square the weight of project R, then we square the, we multiply, we are going to multiply the standard deviation, the square, this is just the variance, the variance of project R, all right, then candidates, we add 2 times weight of project P times weight of project R, then we multiply by the covariance. This is the covariance of PR, covariance of PR. So candidates, square the weight of P, square the weight of P, 0.6 squared times the square of the standard deviation of P, standard deviation P from the question, standard deviation 2.5 square plus 0.4 square times standard deviation R 2.3 square plus 2 times 0.4 times covariance of PR, covariance PR from the question, covariance PR 1.3. The rest is the work of the machine. We multiply 0.6 square times 2.5 square plus 0.4 square times 2.3 square plus 2 times 0.6 times 0.4 times 1.3. This is equal to, then I need to before I need to get the square root, 1.93. 1.93 is the standard deviation of the portfolio PR. We will do the same for combination QR. We will first calculate expected return. The expected return for combination QR. We'll have QR, this is the projects. Let me have columns, projects. Then we have initial investment. Then we have the weights. Then we have the expected return. Then we multiply the weight expected return. So project Q required initial investment of 7 million. Project R require initial investment of 6 million, total 13 million. So the weight will be, is going to be 7 divided by 13, 7 divide 13, 0.5, then 6 divide 13, 0.464. Expected return. The expected return from the question we have project Q, 21%, project R, 16%. Therefore, the expected return for this portfolio is going to be 0.54 times 21 plus 0.46 times 16%. 0.54 times 21, 11.34, 0.46 times 16, 7.36. We add 11.34 goes to 18.7%. This is the expected return of the portfolio QR. Then the next requirement is the correlation coefficient. Correlation coefficient QR. Correlation coefficient QR is equal to the covariance of QR over the standard deviation of Q times standard deviation of R. Okay? Covariance of QR provided in the question is 1.5. Standard deviation of Q 1.8 times standard deviation R 2.3. That's simple. 1.5 divide 1.8 times 2.3 is equal to 0.36. Then lastly, we are going to compute the standard deviation of the portfolio QR, standard deviation of the portfolio QR, which will be determined by getting the square root of the weight, square the weight of Q times standard deviation of Q plus weight of R times standard deviation squared, square of R. Then we are going to add 2 times the weight of Q times the weight of R. This is times the covariance QR. Covariance QR. This will be equal to the square root of 0.54 squared, square the standard deviation 1.8 square plus 0.46 square times standard deviation of 2.3 squared plus 2 times 0.54 times 0.46 times the covariance of QR. The covariance of QR 1.5. That will be this is 0.54 times 0.54 squared, 4 squared times 1.8 square plus 0.46 square times 2.3 square plus 2 times 0.54 times 0.46 times 1.5. Then we get a square root. This is equal to 1.68. 1.68 is the standard deviation. We do the same for portfolio QS candidates. We'll begin with the expected return for portfolio QS. I need space. Let me use this space. Expected return portfolio QS. For portfolio QS, we begin with the project Q, project S. Project Q requires initial investment of 7 million. S required initial outlay of 8 million. 8 million. Total 15 million. The weights will be 7 divided by 15. 7 divide 15, 0.4. 8 divide 15, this is 5.3. This is 0.47. Those are the weights. Then we'll calculate we have the expected return given in the question for project Q. Expected return, project Q, 21%. Project S, expected return, 14%. So the expected return for the portfolio, QS will be 0.47 times 21 plus 0.53 times 14%. Okay, the expected return for the portfolio QS will be 0.47 times 21% plus 0.53 times 14%. 14%. Therefore, 0.47 times 21% is 9.87%. 0.53 times 14 is equal to 7.42% plus 9.87%, 17.29% is the expected return for the portfolio QS. Then we compute correlation coefficient for the same correlation coefficient for the portfolio QS. We know this is equal to the covariance of QS divided by the standard deviation of Q times standard deviation of S. Covariance of QS is provided, candidates, where it is written that the covariances between the various project combinations are as shown. Covariance for project QS, the second last, 1.7 divide standard deviation also given in the question for Q, 1.8 times the standard deviation is 1.6. Therefore, the correlation coefficient portfolio QS will be 1.7 divide 1.8 times 1.6. This is equal to 0.59 is the correlation coefficient for the portfolio QS. The next requirement is the standard deviation of this combination or portfolio. The standard deviation of portfolio QS will be equal to the square root of the square of weight of Q times the square or the variance of Q plus the weight of the square of the weight of S times the standard deviation squared of this is S. Then we are going to add 2 times weight of Q times weight of S times the covariance of QS. Covariance of QS. So this is equal to, this will be equal to the weight, we have it 0.47 squared. Standard deviation, we have it 1.8 squared plus weight 0.53 squared times standard deviation 1.6 squared plus 2 times 0.47 times 0.53 times covariance of QS, the covariance of QS 1.7. This will be 0.47 square times 1.8 square plus 0.53 square times 1.6 square plus 2, this is times, okay, 2 times 0.53 times 0.47 times 1.7. Then we get a square root. The answer here is 1.51. 1.51 is the standard deviation of portfolio QS. A portfolio is an investment or is a combination of investments, a set of investment, a group of investment. This company had an option of investing in project Q and S combination. This is combination QS. So the standard deviation of this portfolio is 1.51. Then we will again compute the expected return for combination RS, project RS, combination RS, combination RS. Okay, so I'm going to have here the expected return for RS. So we'll begin with the project R and project S. Project R required the initial outlay of 6 million. Project S required initial outlay of 8 million. So we do the weights. This is 14 million. Therefore, the weight will be 6 divide 14 to get 0.42. Then we have 8 divide 14 to get 0.57. When we round off here, we have 3. Then there is the expected return for individual projects given in the question. For project R is 16%, project S 14%. Therefore, candidates, the expected return for the portfolio RS will be equal to 0.43 times 16% plus 0.57 times 14%. So 0.43 times 16%, 0.43 times 16% is equal to 6.88%. Then 0.57%, 5.7 weight times 14% is 7.98%. The total is 6.88 plus 7.98, total 14.866%. That is the expected return for the portfolio RS. Now, candidates, I'm going to rub here so that I can compute the correlation coefficient for the portfolio RS. Then I also compute the standard deviation for RS. But before I rub, candidates, I will need to have this somewhere. This is the expected return of the first combination. This one here, 13.6. I'll need this 13.6% in the second requirement, Roman 2, where we are told to advise the shareholders of Mali investment on the optimal project paired on the mean variance. To calculate the mean variance, candidates, we divide standard deviation by the mean. In this case, the mean is the expected return of the portfolio. So I will rub here. Rub that. So candidate 13.6% is the, this 13.6% is the expected 13.6%. This is the expected return of portfolio, the first combination PR. First combination was PR. PR, expected return, first combination PR, this is equal to 13.6%. I'll need that when computing the coefficient of variation, or the mean variance, Let's continue. We've done the expected return for portfolio RS. We are now going to compute the correlation coefficient RS, project RS. That will be equal to the covariance of RS divide the standard deviation of R times standard deviation of S. Covariance of project RS, portfolio RS, covariance RS 2.7 divide the standard deviation of R 2.3 times 1.6 times 1.6. So candidates, that will be the correlation coefficient, which is equal to 2.7 divide 2.3 times 1.6. This is equal to 0.73. Then lastly, standard deviation of the portfolio RS is equal to the square root of W squared R, standard deviation squared R, plus W squared S times standard deviation squared S, plus 2 into WR times WS, okay, times covariance RS. This is equal to the weight, we have it 0.43 squared. The standard deviation, we have it 2.3 squared, plus weight 0.57 squared, standard deviation 1.6 squared, plus 2 weight 0.43 times weight 0.57 times covariance, we have it 2.7. The rest is the work of the machine, the calculator. 0.43 square times 2.3 square plus 0.57 square times 1.6 square plus 2 times 0.43 times 0.57 times 2.7. Then we get the square root. The answer is 1.77. That's the standard deviation. Candidates, we've answered Roman 1, which read, for each possible project pair combination, calculate the expected return, number 1. Number 2, correlation coefficient. Number 3, standard deviation. That's what we've been doing for each project combination. For example, the project combination for QS, we've done the correlation coefficient. We've done the expected, firstly the expected return. We did the expected return, then we've done the correlation coefficient, we've calculated the standard deviation for the portfolio, we've QS, that is QS, candidates, that is QS. For each project we have done the expected return, correlation coefficient, and standard deviation. For project RS, we've calculated the expected return, we've calculated the correlation coefficient, we've calculated the standard deviation. We did the same for project PR, we did the same for project QR. So we are going to move to answer the second part of this question. Advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance. Based on the mean variance. The mean variance is also known as the coefficient of variation. So I'm going to rub this bit, but maintain. I'm going to maintain. This is QR. This one here is the expected return QR. We want to calculate the coefficient of variation or the mean variance. How to calculate the mean variance? Mean variance, candidates, mean variance is equal to the standard deviation over mean. So mean variance is equal to standard deviation divided by the mean. In our case, the mean is the expected return. The expected return is the mean. We have done the standard deviation for each portfolio, all right? For each combination of projects, we've calculated the expected return for each portfolio. So we want to determine the mean variance for each portfolio. And this one here, candidates, 18.7% is the expected return for QR. 18.7%. I'm writing it down there because I want to use this space. So I have combinations. Then I'll have the first combination is PR. We are going to calculate the mean variance for PR, and I've said is equal to mean divided by, the standard deviation divided by the mean. The standard deviation for PR, we calculated it 1.93. We divide the expected return for combination PR. Expected return here is 13.6. The next combination is combination QR. The standard deviation QR is 1. We calculated it 1.68 divided by the expected return QR 18.7. Then the next combination is combination QS. Combination QS. The standard deviation combination QS is 1.51. QS 1.51 divided by the expected return QS. QS is QS, we calculated it. QS expected return QS here is 17.29. Then lastly, combination RS, the standard deviation combination RS, we have it here, 1.77, divide the expected return RS, expected return RS 14.86. These are the possible combinations and the mean variances. So begin with the PR 1.93 divide 13.6 is equal to 0.14. When converted into percentage, this is 14%. Next is 0.089. Next, 1.51 divided by 17.29. 1.51 divide 17.29. 0.087. Then lastly, RS 1.77 divide 14.86, 0.119. Now when converted into percentages, this is 8.9%, this is equal to 8.7%, is equal to 11.9%. So those are the mean variances. These are the mean variances. Then based on these mean variances, we are to advise this company. The question reads, advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion. Now, the most ideal combination or optimal project pair advice the most ideal project pair, as you can see, candidates is QS, and why? Because it has the least mean variance or coefficient of variation of 8.7%. That means the project the risk is lower risk. It has a lower risk. Okay, 8.7. So we've answered that question, candidates, and I hope you take time to go through it. I hope you've also seen that the question is simple to the extent that candidates required to just have the formula. If you have the formula for these requirements, like the correlation of coefficient, then you put down the formula, then check from the question if the inputs are provided in the question. Like candidates, you see correlation of coefficient is equal to the covariance of RS. The covariance of RS is given in the question. The standard deviation is also given in the question. That would earn you marks. All right. And before calculation of the relation of coefficients, it was important in this question for the candidate to first of all identify the possible project combination. Because we read in the question that this company had a limit of 15 million shillings to invest in various projects that we were provided the initial capital outlay. So it needed simple mathematics, like in project P required 9 million, project Q required 7 million. So combination of P and Q was not possible because 7 million plus 7 million, 9 million plus 7 million exceeds the limit of 15 million. That's why we didn't have that combination in our working. So you see, that was the initial starting point. First of all, identify the possible projects combination. And this is what now guided the student on how to calculate these other aspects, the correlation coefficient, the expected return, the standard deviation. So it's important, candidates, you practice. Look at, these questions are just the same, but they are varied slightly. So if you get the concept, then it becomes easier for you to answer any question that may be tested in the exams. Thank you for attending today's revision session. In our next session, we are going to answer question number 4 that was tested in November 2020. Then we will again answer question 5. We are dedicated to providing all solutions for the CPA students appearing in the Advanced Financial Management paper. Thank you. God bless you. Bye-bye.
We resume from where we had stopped in our previous session. That is question 3, Economics, April 2024. Question 3, A, Roman 1, explain the term monetary policy. Explain the term monetary policy. Explain the term monetary policy. When you talk about monetary policy, we're basically saying that these are instruments that are used by the government through the central bank to regulate money supply. What are these instruments that are basically used by the government through the central bank to regulate money supply? One of it is the interest rate, the bank rate. How do we use it basically to regulate money supply in the economy? We basically say that when there's a lot of money in circulation, what basically the government through the central bank does is that they raise the level of interest rate, and by raising the interest rate, they ensure that there's not much circulation of money in the economy, and in so doing, they reduce what you call inflation. The second instrument, monetary instrument, policy instrument, we call it open market operation. This is buying and selling of security by the government through the central bank. We also say that, for example, when there's a lot of money in circulation, the government basically will be selling security to the public. And by so doing, what they basically are doing is that they make sure that more money goes to the central bank, and in so doing, they reduce the level of inflation. And when they buy security from the public, they increase deflation. The opposite of reducing inflation, they enhance the opposite of reducing inflation. That is what basically we mean by monetary policy. So we put it down. This refers to the instrument. This refers to the instruments, instrument used by the government through the central bank, central bank to regulate money supply, to regulate money supply. Examples, to say examples. Examples examples include interest rate, comma, open market operation, open market operation, cash ratio, etc. Again, just to emphasize for the learners, because that was simply on definition, giving what monetary policy means, an example, just to illustrate one of it, just to emphasize what I'd say, that one of the instruments is a bank rate. How does the government uses the bank rate to control the level of money supply in the economy? I've said when there's inflation, to imply then that there's a lot of money in circulation, the government basically is going to raise the level of interest rate, meaning that not much money is available in the society for circulation. And in so doing, I've said that what it does is that it reduces the supply of money in the economy. The second one, I have said, open market operation, buying and selling of securities by the government. And to say that when there's a lot of money in circulation, that is during inflation, the government will sell security to the public. And so doing, they reduce the money that is basically in circulation to the public. That is how we approach that. And very important, you need to also check on other factors like selective credit control as also one factor, reserve requirements as also some of the monetary policies. That is how we go about that very question. We pick it on the next question, that is question 3, A Roman 2. We read the question. Identify 4 objectives of fiscal policy. We put it down. That is 3 Roman, A Roman 2. Explain, identify. We say identify 4 objectives. 4 objectives of fiscal policy. 4 objectives of fiscal policy. Very important in answering any question in economics is to understand what we basically mean by what we call fiscal policy. Fiscal policy basically talks about revenue and expenditure. And when you talk about revenue, that touches on taxes and expenditure, how we basically uses the taxes, which is the revenue, and expenditure to control the economy. That is what we mean by the fiscal policy. So key at the back of every learner is to understand that whenever we talk about fiscal policy, we touch on what we call governmental expenditure and revenue stroke the taxes. What are the objectives of fiscal policy? 1 is to achieve desirable price level. 2, we can talk about achieve a desirable consumption level. Number 3, we can talk about raise the employment level. We can use the taxes to raise the employment level. We can also use the taxes and expenditure also to maintain economic stability, So we can put them down. Number 1, we say achieve desirable price level. Number 2, we call it achieve desirable consumption. What we call desirable consumption level. Achieve desirable consumption level. Number 3, we call it maintain. We have it as maintain economic. What we call maintain economic stability. Maintain economic stability. We have 4, raise the employment. Raise the employment level. Then we can have lastly, maybe for the sake of additional, what we call achieve equitable distribution of income. Achieve equitable distribution achieve the equitable distribution of income. Achieve the equitable distribution of income. Achieve the equitable distribution of income. That is the last objective. So on the fiscal policy, you need to understand how these fiscal tools work. How does the taxes work to control the economy? How does expenditure, how does the budget work to control the economy? Very important for learners to understand. And that is how we particularly handle that question 3A Roman 2. We pick it on the next question, that is question 3 Roman B. We'll read the question. The following information relate to a given economy. We're being told that the marginal propensity to save, MPS, is equals to 0.2. Then autonomous consumption, that is independent of the national income, Y, is 400. So required, formulate consumption function. And number 2, determine the change in national income if government expenditure was increased by 50%. We write the question, that is B. So we're being told the following, be the following information relates, the following information relates to a given economy. The following information relates to a given economy. So we have one that is marginal propensity to save. To save is we put it into bracket, MPS is equals to 0.2. Marginal propensity to save is 0.2. Then we have what we call autonomous consumption. That gives us 400. Then we have required. We start with the required. Required, Roman 1, that is B Roman 1, formulate consumption function. Formulate consumption function. Formulate consumption function. We pick it. The two consumption function. For us to formulate consumption function, we know that consumption function should be equivalent to, we have A, which is plus B, Y. So B is autonomous, A is autonomous consumption, that is independent of Y. And B is marginal, what you call marginal propensity, what you call the marginal propensity to consume. That is what you call the marginal propensity to consume. So we basically say that MPS, which is the marginal propensity to save, plus the MPC, that is marginal propensity to consume, that should be equivalent to 1. We are given the marginal propensity to save, that is 0.2, plus MPS that we don't know, MPC that we don't know, that is equivalent to 1. So the MPC, the marginal propensity to consume, that will be equivalent to 1 minus 0.2. So we have it as 0.8. So the MPC should be equivalent to 0.8. That is the marginal propensity to consume. Get back just to put it in the question. So consumption function should be equivalent to 400 plus 0.8y. This is what you call the consumption function. This is what you call the consumption function. We pick it on Roman B. We have our Roman B down here. Determine the change. Determine the change We say determine the change. Determine the change. Determine the change in national income. In national income. Determine the change in national income. If government expenditure, if the government expenditure, if the government expenditure was increased by 50%, was increased by 50%. If the government expenditure was basically increased by 50%. We need to understand the concept of multiplier. A multiplier, which is K. What is multiplier? If you understand multiplier, this question would be a little bit much easier for learners to understand. So what is a multiplier? We say is the number of times in which an increase in investment and other exogenous spending should be multiplied to arrive at the change in national income. So multiplier is basically, we call it, refers to the number of times in which an increase in investment or other exogenous variables such as the government expenditure should be multiplied in order to arrive at the change in national income. So we've been asked the change in national income. So what we need to multiply with the exogenous factor which we have as the government expenditure, we need to get the multiplier. We said that multiplier, which we've defined, is equals to 1 over 1 minus MPC. And we say that 1, i.e. 1 minus MPC, that should be equals to MPS. That should be basically be equals to MPS. So we have the multiplier, which is K. Being equal to K is going to be equals to 1 over 1 minus 0.8. That is to say 1 over 0.2. So K should be 5. So what is the change in national income? That should be the multiplier times the exogenous factor. Multipliers. So change in national income, change in national income, change in the national income, change in the national income should be equals to the multiplier, which is 5, times the exogenous factor, which is 50%. So the change should be equals to 250%. The change should basically be equals to 250%. That is how we particularly approach that question 3 Roman B. We pick it on question 3 Roman C. Using appropriate diagram, explain 4 properties of indifference curve. Using appropriate diagram, explain the 4 properties of indifference curve. Using appropriate, what you call appropriate diagram, explain the 4, what you call the 4 properties, of indifference curve. The 4 properties of indifference curve. The 4 properties of indifference curve. So we can start with the first property. We say that the higher, number 1, the higher the indifference curve, the higher the indifference curve, the higher the utility. The higher the indifference curve, the higher the utility. We draw the diagram so that we can depict that in a diagram. The higher the indifference curve, the higher the utility. So IC1, IC2, IC3, IC4. So this is good Y. We call it good Y. We call this one good X. So we're saying that the higher the indifference curve, the higher the utility. IC4, highest highest level of satisfaction, highest level of satisfaction. Then we have IC1, we call it the lowest level of satisfaction, the lowest level of satisfaction at that very point, the lowest level of satisfaction at that very point. The second property, we say the indifference curve are dense. Indifference curve are dense. Indifference curves are dense. What do you mean by dense? They are everywhere. They are everywhere. They are everywhere. That is what you call dense. They are particularly everywhere. When you call that, they are everywhere. So we draw it so that we depict that. They are everywhere. They are everywhere. We have the diagram as we say that they are everywhere. So we have it here. So this is good X. This is good Y. So we have it. They're everywhere. Indifference curve are basically everywhere. That is IC1, IC2, IC3, IC4, IC5, IC6, IC7. We can have IC8. So indifference curves are basically everywhere. Number three, we call it they are asymptotic. They are asymptotic. That is to say that they do not touch. They do not touch the axis. They do not touch the axis. When you say they are asymptotic, they never touch the axis. So if you're to draw that, we basically have this at this point. At this point, we have good Y. We have good X. So we can see that this IC don't touch the axis. You can see that they never touch the axis. Indifference curve are asymptotic. They do not touch the axis. They do not touch the axis. They never intersect. Lastly, number 4, we say that they do not. Lastly, we say they do not intersect. They do not intersect. They do not intersect. We have our diagram here. We have our diagram here showing that they do not intersect. Intersect. That is number 4. If we had an indifference curve, that is good X. This is good Y. Showing that they do not intersect. If we had that, they do not cross each other. They do not intersect. If you had that, if you had IC1 and IC2, they do not intersect. We say they do not cross each other. They do not intersect. They do not intersect. They do not intersect. They do not cross one another. But apart from that, we can also talk about what we call they are convex to the origin. They are convex to the origin. They are sloping downwards. They're sloping downwards from left to right. But we also say that they do not cross each other. That's basically implying that it is not possible for IC1 and IC2 to cross each other. So we say the last point, the last property is that they do not intersect. Those are the 4 properties and the ones that we've mentioned of the indifference curve. That is how we approach that very question. The last question in question 3, that is question C, 3C. That marks the end of that question. We'll see one another in the next session. welcome to Manifested Publishers. My name is Mr. Dongo, a PFT, Public Finance and Taxation lecturer. Today, we will be going through August 2024 paper. And we start with question 1. Question 1A, explain the following terms used in public finance management. 1 is the consolidated fund services, and 2 is what we call division of revenue bill. So we come, put the question. So question 1, so A, explain the following terms. Explain the following terms as used in public finance management. As used in the public finance management. So 1 is what A is consolidated, what we call consolidated fund services. So basically, when you talk about a consolidated fund, that all government revenue are basically kept in account called a consolidated fund, except the ones that are not approved by the Act of the Parliament. So basically, when you say consolidated fund services, we basically mean, we say services. Services means the expenses, we say the expenses means the expenses of which is charged, the expenses of which is charged directly, we say directly against, we say directly against the, against, and you say and payable from the consolidated fund, from the consolidated, we say the consolidated fund, we say under the virtue, we call it under the virtue of the Constitution, under the virtue of the Constitution, or any act, we say any act of the Parliament, any act of the Parliament, other than, we say other than appropriation, other than the appropriation. So that is what we call consolidated fund services. So services basically means expenses which is charged directly against and payable from the consolidated fund under the virtue of the Constitution or any act of Parliament other than the appropriation. So then we have the second, what we call division of revenue bill. Division of revenue bill. When you talk about division of the revenue bill, we're basically talking about how revenue is divided at the 2 levels of government. That is the national government and the county government. So this refers to it's a bill that aim at. It's a bill, we say it's a bill that aims at equitable, what do you call equitable? Equitable allocation of funds between 2 allocation stock distribution of fund between two levels of the government. Between two levels of the government. Equitable allocation, or equitable, just say the word distribution. Equitable distribution. Equitable distribution of funds between two levels of government, i.e. national and county government. National and the county government. So when you talk about division of the revenue bill, we are basically talking about how revenue is equitably distributed of funds between two levels of government. That is basically the national government and the county government. The national government and the county government. That is how basically we tackle that question 1A. We'll pick it on the next question. We say outline 5 purposes for which national government should borrow money according to the provisions of section 192 of the Public Finance Management Regulation 2015. So we put it down. That is B, question 1B. We say outline 5 purposes. Outline 5 purposes for which the national government should borrow money, for which the national government should borrow money according to the provisions of section 192 we say of the public financial management regulation. We call it Regulation 2015. So basically we are being asked by the examiner the 5 purposes to which national government should borrow money according to the provision of the section 192 of the Public Financial Management Regulation of the Public Financial Regulation of 2015. So basically, national government would borrow money for various purposes. One of it is to overcome budget deficit. One of the very common things about these developing countries, Kenya being one of it altogether, that is majority of the budget, most of the budget cannot be covered by the revenue. So one of the reasons is that they borrow to overcome a deficit. We also have another reason that we can talk about in case of emergency, so we can put them down. We have one, what we call financing the national, what we call the national deficit, financing what we call the national deficit. Deficit when expected expenditure is more than the expected revenue. The second is borrowing for the purpose, what we call borrowing for the purpose of the cash management, borrowing for the purpose of the cash management, borrowing for the purpose of the cash management, borrowing for the purpose of the cash management. Then we talk about honoring. Sometimes you find that the national government would borrow to pay back loans that are due. So we say honoring, what we call honoring, obligations, honoring obligations under outstanding, what we call outstanding, under outstanding national government, honoring obligations under outstanding national government guarantees. Then we can talk about the next, what we call refinancing. What we call outstanding debt. Refinancing what we call outstanding debt, or repaying what we call repaying a loan, to its date of repayment. Refinancing outstanding debt or repaying a loan to its dates of repayment. So they can also borrow. We can talk about lastly borrow in case of emergencies. They can decide to borrow in case of emergency. These are basically unforeseen events. So basically, this is the reasons that the national government will probably borrow in relation to the provisions of Section 192 of the Financial Management Regulation 2015. That is how we basically tackle that question. We'll pick it on the next question. We're being told Section 194 of the Public Finance Management Act of 2012 specify the functions undertaken by the Public Sector Accounting Standards Board. That is PSSB, Public Sector Accounting Standards Board. So with reference to the above statement, describe six functions. We put it down on the board. So that is C. So we talk about section, we say Section 194. Section 194 of public, what we call the public financial management of the Public Financial Management Act 2012, of the Public Financial Management Act of 2012. We say comma, specifies, we say specifies the functions, specifies the functions to be undertaken, we say to be undertaken by public sector, what we call the public sector accounting standards board. Public sector's accounting standards board. Into bracket, that is the PSSB, public sector's accounting standards board. So then you say with reference to the above statement, with the reference to the above statement, describe, we say describe functions of PSSB. Describe the functions of the PSSB, Public Sector Accounting Standards Board. So number one is to understand what you mean by public standard accounting standard boards, and basically their role. We need to understand that this basically comes from topic 3, that is oversight of the public finance. One public sector accounting standard board is one of the areas of oversight one of the areas of oversight. That is basically one of the areas of oversight when you look at the Public Sector Accounting Standards Board. And basically, in going through these questions, in going through this particular question, it's very important that one of the roles of this Public Sector Accounting Standards Board is basically to set what we call accepted accounting and financial standards. One of it as a role in the bid for oversight, we call it set. We say set. Generally, what we call generally accepted. Set what we call generally accepted. Set what we call generally accepted. Accounting and financial standards. The word is to set. The word is to set. Implementation is not the role, but basically is to set generally accepted accounting and the financial standards. The next we can talk about prescribing an audit procedure which basically comply with the PFM. What is the Public Financial Management Act? We say prescribe, 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 prescribe. Internal audit procedures, internal audit procedure, internal audit procedure, basically to prescribe internal audit procedure, which comply with PFM Act. So basically, it prescribe internal audit that basically will comply with what you call Public Financial Management Act. So we can proceed to the next. That is the third point on that. We say that they set this standard. They don't implement, but basically they set the standard. So the next we can talk about prescribe the minimum standard. What you call prescribe the minimum. We say the minimum. What you call the minimum standard. What you call the minimum standard. Prescribe the minimum standard of what you call maintenance, minimum standard of maintenance of what you call proper books of account, of maintenance of proper books of account, minimum standards of maintenance of the proper books of account as the next role. Remember, they do the oversight role. And four, we can talk about what you call publish, what you call publish and publicize, publish and publicize, publish and basically publicize, and you say publicize the accounting, what do you call the accounting, and financial standards, and the financial, what do you call the financial standards, and the financial standards, publish and publicize the accounting and the financial standards, and any directives, and any, what do you call, any directives, directive, and directives, and guidelines, and the guidelines prescribed by the board. Prescribed by the board. What do you call prescribed by the board? So basically, publish and publicize the accounting and the financial standards and any other directive that is basically prescribed by the board. So we have the next, perform. We can say that is 5, that you say perform any other function. Perform any other function. function, we say function related, any other function related to advancing, what do you call advancing, related to advancing, prescribe any other function related to advancing, financial, taking it higher, financial, and accounting, we say financial and accounting, perform, this is say perform, we just rub it and write it clearly, perform, any other function, this is say any other function related to advancing financial and accounting system, management, and reporting in the public sector, and the reporting basically done in the public sector. So perform any other function related to what you call advancing financial and accounting system, management, and reporting in the public sector. And lastly, we say in consultation, with the cabinet, secretary, in consultation with the cabinet secretary on the effective, what do you call effective, on the effective dates of the implementation, in consultation with the cabinet secretary on the effective dates, that is cabinet secretary of finance, on the effective dates of implementation of the standards, we have not said they implement, but they consult on the effective dates of the implementation of the standards, and you say comma, gazette, the dates, we say gazette the dates, for application, gazette the dates for the application of standards, and guideline. Again, very important for us to get to understand that when you talk about public sector accounting standard board, that's an oversight. So there are also various levels of oversight, that we basically have in relation to oversight. Also, various areas of oversight, apart from the public standards accounting boards, we have the internal audit as also an oversight. That's an area that can also be examined. So as you look at this, it's also very important to look at other levels of oversight. And I've talked about one as internal audit. And what is the role of internal audit? That is how we basically tackle that very question. We'll pick it up on the next question. That is question 1, Roman D, the last question on 1. So the question says, in relation to the public procurement and asset disposal regulation 2020, outline 5 methods that accounting officer or procuring entity or procuring entity may use to dispose the asset. So we have the question on the board. We say that is D. We say in relation to the public, what do you call the public? In relation to the public procurement, in relation to the public procurement and asset disposal, and Asset Disposal Regulation 2020, Regulation 2020, outline 5, we say outline 5 methods, outline 5 methods that an accounting officer can, we say, use. 5 methods that accounting officer can use, that an accounting officer of we say of a procuring entity may use to procure, may use to dispose asset. May use to dispose asset. So when you talk about disposal, is how we do away with the asset. And when you look at this topic, that is basically topic 4 on procurement. So we are basically being asked that in relation to what you call the public procurement and disposal regulation, that is of 2020, what are the methods that that accounting officer of a procuring entity may use to dispose? To dispose basically is to do away with the asset. What are some of the methods that would basically be used to do away with the asset? One is, we call it a trade-in. We call it trade-in. What do you call trade-in? You know, you can have a new asset and you do away with the older asset. We call it trade-in. That is the first method that we dispose of an asset. So we move to the next. We move to the next. As we wrap this to the end. As we wrap this at the end. As we wrap this to the end. As we wrap this to the end. The next method that a procuring accounting officer of a procuring entity can use to dispose an asset, can basically use to dispose an asset. We talk about sell by public. What do you call sell by public tender? What do you call sell by public tender as another method that can be used to dispose an asset. Then you can also call number 3. What do you call sell? We say sell by public auction. What do you call the public auction? Sell by what you call public auction. Sell by the public auction. We also have what you call transfer. Another way for disposal, we say transfer. We can call it transfer to another, what do you call another public entity. Transfer to another public entity, or part, what do you call part of public entity, part of the public entity, with or without financial adjustments, with or without financial adjustment, with or without financial adjustment. We've talked about transferring to another public entity or part of public entity with or without what you call a financial adjustment. And lastly, what you call waste disposal management. What you call waste disposal management. Lastly, what you call waste disposal management. Waste disposal management. Very important for learners to understand that this is also a very crucial topic in the public finance. We need to understand even the role of IFMIS under this, the roles of a number of things. For example, IFMIS in relation to procurement. What are the benefits of electronic procurement as opposed to a procurement that was basically being done physically? What is the role? Pre-qualification of tender. What are some of the pre-qualifications that are required for tender, for the ones that are basically picked for tenders? Basically still touching on procurement. But particularly for this, we were basically talking about a number of ways that an accounting officer in a procure entity may dispose an asset. We've talked about trade-in. We've also talked about sale by public tender. We've talked about sale by public auction, transfer to another public entity or part of public entity with or without financial adjustment. And lastly, we've talked about what we call waste disposal management. That is how we particularly handle that last question. And that marks the end of the question 1. See you in the next class. Welcome to Manifested Publishers. We proceed on economics paper. That is April 2024. The last question, question 1. Explain the term producer equilibrium as used in economics. Explain the term. That is 7 Roman A Roman 1. Explain the term producer equilibrium as used in economics. I just want to draw a diagram before I explain that. Basically explain that producer equilibrium. We can have this. This is an ISO cost. That is basically an ISO cost. So we have capital, and we have labor, and we have labor. This is an ISO cost. So AB is an ISO cost line. Then we draw an ISO quant, not in difference curve, but ISO quant. And then we have Q. We can say Q is 3. So the point that ISO quant line forms a tangent with an ISO quant, that is where we get the producer equilibrium. So we have equilibrium quantity of capital, that is KE, and equilibrium quantity of labor, that is LE. So we can say that this is 3,000. So we basically need to understand that 3,000 in this particular, 3,000 units is the level of output, is the level of output, is basically the level of output, is the level of output that gives, that basically gives the firm the maximum. We call it the maximum profit. Gives the firm basically the maximum profit. So what is producer's equilibrium? Refers to the level of output. Basically we say producer equilibrium is therefore the firm, we say the firm's, is therefore the firm's level of output, is the firm's level of output, Producer equilibrium is therefore the firm's level of output, which gives the maximum, what we call the maximum profit, which gives the maximum profit. And as you can see from the diagram, this is an ISO cost. AB is an ISO cost line, and then we have Q as an ISO quant. So 3,000 is the level of output that will give the maximum profit. So a firm is said to be, just a continuation, a firm is said to be at producer equilibrium, A firm is basically said to be at producer equilibrium at producer equilibrium, if there is no scope, if scope is intention, if there is no scope of increasing, we say scope of increasing, the scope of increasing the profit, or reducing the scope of increasing profit or reducing the loss, the scope of increasing the profit or reducing the loss, or reducing the loss, or reducing the loss by changing, we say by changing the output, by changing the quantity, by changing the quantity of output, by changing the quantity of output, by changing the quantity of the output. So if you look at that question, that's question particularly tackling 2 marks, but it's expounded fully. That is the diagram. So at 3,000, that is where we have producer equilibrium. So 3,000 units is the level of output that gives the maximum profit. But you say producer equilibrium is therefore the farm's level of output which gives the maximum profit, that basically gives the maximum profit. And we say that when a farm is basically at a producer equilibrium, the farm has no scope of either increasing profit or reducing the loss by changing the quantity of output, by changing the quantity of the output. That is how we particularly go through that question. We pick it on the next question, that is question 7, A, Roman B. So the question says, highlight assumptions of the producer surplus. Highlight assumption, that is Roman 2. Highlight the assumptions, what do you call the assumptions of a producer surplus. Highlight the assumptions of a producer surplus. So before we highlight assumptions of a producer surplus, it is very important to understand what we basically mean by a producer surplus. When you talk about a producer surplus, we basically say that there is a difference between the amount the producer is willing to supply good for and the amount that they actually receive when they make the trade, which in most cases we say is an additional benefit, because you realize that what they receive is more than the minimum that they're willing to supply the goods for. So that is actually a benefit. So if you're to draw, that is not of essence, but you can particularly have questions that will tell you to define a producer surplus and draw the diagram. But for this particular question, it has simply asked on highlight 5 assumptions of the producer surplus. When you look at those assumptions, one, we talk about producer is assumed to be rational. Basically, a consumer is aiming to maximize profit, and we know that we maximize profit where MR is equals to MC. So we say number 1, producer. One, we say producer is assumed to be rational, i.e. we say aim to maximize the profit, We know i.e. at the point, MR is equals to MC. That is basically where the consumer basically aims to maximize the profit. The second assumption is that there is perfect competition. There's a perfect competition market. Number 2, we say there is a perfect competitive. There is a perfect competitive. We call it a perfect competitive. There is a perfect competitive perfect competition market. There is a perfect competition market. We know how a perfect competition basically work, and we say that assumed to be perfect, perfectly competitive. Assumed to be perfectly, we say perfectly competitive. Consumer is basically assumed to be perfectly competitive. Then you say that there is free entry and exit. There is, on the next assumption, there is what you call free entry and exit, i.e. there is free entry and exit, i.e. that is to say that producer can freely enter and exit, can freely enter and exit as the third assumption. The fourth assumption, basically, we say there is no externalities. There is no externalities. There is no externalities as the next assumption. Basically, we say that there is no externality. That is saying external cost and benefits, external cost or benefit. No external, what you call external costs and benefits. No external cost and benefits. And lastly, assumptions, we say constant return to scale. The fifth assumption, we say constant return. We call it constant return to scale. What do you basically mean by constant return to scale? We know that average cost of production remains constant. Average, that is to say average cost of the production, average cost of the production remains constant. Average cost of production basically remains constant as quantity produces increases, as quantity produces, as quantity produces increases, as quantity produces basically increases, as quantity produces basically increases, as the quantity produced basically increases. Again, I said at the beginning of that particular question, I said you can be asked what a producer supply as a major area, and you can also be told to illustrate using a diagram how producer supplies basically come. And that is how we particularly handle that question. That is question 7A, Roman 2. That is how we go about that question. We pick it on the next question, that is question 7, Roman B. With the help of a well-labeled diagram, explain the stages of law of diminishing return. We put that question down. With a 8, we say with a 8, with a 8, we call it with a 8, with the aid of a diagram. With the aid of a diagram, we say explain the stages, of the law of diminishing return, So when you talk about the law of diminishing return, we also call it the law of variable proportion. What does the law of variable proportion basically talks about? We say that when a variable factor of production, that is labor, is added to fixed factor of production, and that is land, we say that total output increases, but at a decreasing rate. The total output increases, but at a decreasing rate. We can illustrate, first of all, come up with the diagram. We proceed to this at the end because this end is a bit small, so we have our diagram on this end. And you talk about those stages. Basically, this law of diminishing return or the law of variable proportion, we have it here. So this is what we call total product at that end. We have the total product. We have this as average product. We have it as average product. Then up here, we have what we call the marginal product. So on this other end, we have total product, marginal product, and average product. And down there, we have quantity. We have the quantity. We illustrate on that point. At that point, we'll illustrate. So we have what we call stage 1 on this stage 1. We have stage 2. And finally, we have stage 3 on this other end. We have stage 1. This is stage 2. And this is stage 3. So basically, when you talk about the law of variable proportion, the diagram is this, and the diagram is basically divided into 3. So we have the first stage, we call it increasing, what we call increasing returns. Increasing returns. So on basically increasing return, we're saying that when a variable factor is added, and the variable factor is labor, is added to a fixed factor production, which is land, total product increase but at a decreasing rate. So what essentially happens in this part is that when that happens, when you talk about TP, we talk about MR, and you talk about AR, are all increasing, are all increasing. All of them are increasing. All of them are basically increasing. That is at increasing return, which is stage 1. Stage 1. Stage 1, as it is. That is stage 1. That is what happens in the stage 1. That TP, MR, and AR are all increasing when a variable factor is added to a fixed factor of production, which is land. We have the TP, we have the MR, and AR all increasing. Stage 2, we call it a constant return. So basically we are saying that when we basically had a variable factor, which in this case is labor, to a fixed factor of production, which is land, we will see that at this particular stage, in as much as probably you can have the total product increasing, we'll see the marginal product. At this point, we'll find the marginal product. If you look at the marginal product remaining constant. Marginal product will have the marginal product basically remaining marginal product at a particular point, marginal product remaining constant. So you'll have a marginal product at one point. Maybe you have between quantities, quantity. You can have maybe a quantity that follows, maybe between 4 and 5. You're having a marginal product, which is MP. This is P, average product, and that. This is average product. Sorry for that. This is marginal product. So we have the total product in the first stage, marginal product, and AP all increasing. The second stage, we are saying that it's called a constant return. What we call a constant return. So on the constant return, we'll have the TP increasing, but you find at that particular stage, MR remain constant at a particular stage. Maybe a unit of 4 to 5, you find MP. That is the MP, which is the marginal product, remaining constant. So we can have the total product increasing, but you'll find MP remain constant, maybe at 4 and 5. So that is what you call constant return. And then we have the third stage. The third stage, we have what we call decreasing stage. So on the decreasing stage, look at the decreasing stage, which is stage 3. This was stage 2. This was stage 2. This is stage 3. This is basically stage 3. So decreasing stage, we can see the total product. We can see the average product, and we can see the marginal product are all decreasing. In fact, the marginal product is negative. So we see TP, AP, and MP are decreasing. So when we add a variable factor, which is labor, to a fixed factor of production, which is land, total product, average product, and marginal product are all decreasing. But we can see also that at that particular point, MP is even getting MP gets negative. Initiating inefficient MP is negative even at that stage. So for the diagram, that question is 6 marks. The diagram will constitute a huge number of marks, if it's 6 marks, the diagram will particularly take a huge mark. The diagram could take even 3 or 4 marks. Then the explanations that we have summarized on this particular point, those will take the remaining marks, which is either 2 or 1 maybe there. But the diagram will basically constitute a lot of the marks in that particular question. The diagram will constitute a lot of marks in that particular question. And that is how we particularly go about that very question. But even on this, we have assumptions of the law of variable proportion or the law of diminishing returns, the law of variable proportion or the law of diminishing return. You can have the assumptions. You can be asked the assumption. You can also be asked. You can also be asked on shortcomings or limitations of the law of diminishing return. That is how we particularly handle that specific question. We proceed from the next question. That is question 7, Roman C. Explain 4 monetary policies that the central bank of a country might apply to control inflation. That the central bank of any country might apply to control inflation. So when you look at this particular question on a yearly basis, this is a question that keeps on repeating itself. Even on the 2020, even on the other exams, you find particularly questions that touches on monetary policy is always there. So we put down the question, then we go through the question. So that is to say, explain, one you call explain, 7 Roman C, explain, 4, say 4 monetary policies, that a central bank of a country, might apply to control inflation. So I explained 4 monetary policies that a central bank of a country might apply to control inflation. Number 1 is to understand what you call monetary policy. Whenever we talk about monetary policy, we basically call it, these are instruments that are basically used by the government through the central bank to regulate the supply of money. Either the supply of money is high or low. How do you use these instruments to basically control inflation? The first one we talk about is what you call the bank rate. Where the first one you call it the bank rate stroke what you call the interest rate. The bank rate stroke what you call the interest rate. So when you talk about the bank rate stroke the interest rate, we know that when the supply of money is high, the interest rate is usually raised to reduce the money supply altogether, or to reduce inflation, and vice versa. So we say that during inflation stroke high supply of money, interest rates are raised. Hence this will control inflation. Hence this will control inflation. Stroke reduces the supply, high supply of money. So the second one, we can talk about what you call open market operation. Open market operation. So when you talk about open market operation, this is buying, what you call buying and selling of the government security. Buying and selling of the government security. And particularly when you talk about the buying and selling of the government security, we're talking about T-bonds and treasury bills and bonds. So we basically know that when there's a high supply of money, that is when there's inflation, the government will basically sell security to the public to reduce the flow of money. So say that during inflation, comma, the government, we say that the government will sell securities to the public in order to reduce inflation stroke high circulation of money. High circulation of money. So we have number 3, what we call compulsory deposit. Deposit stroke reserve requirement. What we call reserve requirement. Compulsory deposit stroke what we call the reserve requirement. Whenever we talk about the reserve requirement stroke the compulsory deposit, we basically mean that all the commercial banks must hold a reserve with the central bank of any country. And we're basically saying that when there is inflation or when there is high circulation of money in the economy, what the banks or the government in relation to the central bank basically do is that they increase the compulsory ratio or the reserve requirement to make sure that most of the money are with the CBK. So we need to say that during inflation, the government through the CBK or the central bank of any country will increase the reserve stroke what you call the compulsory ratio, compulsory deposit, not ratio but compulsory deposit to ensure there is no high circulation. There's no high circulation of money to the public. There's no high circulation of money to the public. There's basically no high circulation of money to the public. And there's no high circulation of money to the public. There's no high circulation. And lastly, we can talk about selective, what we call selective credit control. Selective credit control. One of the reasons why we have inflation being high is that when there's a lot of money in circulation, when there's credit available to all sectors of the economy, then we know that that can lead to inflation because there will be money all over. There will definitely be money all over, and that leads to what you call inflation. But basically, during inflation, the government through the CBK will do what you call selective credit control, where credit will only be given to a selective sector of an economy, to a selective sector of economy. And that will be basically a productive sector. We can talk about productive only to a productive sector. We can talk about a productive sector. So when that happens, when you have the credit being selectively given only to a productive sector, this reduces, we'll say that this controls The inflation, this controls the inflation, stroke circulation, stroke high circulation, high circulation of money, high circulation of money to the public. That basically controls high circulation of money to the public. And lastly, as an additional, as a bonus one, just to understand this deeper, we can talk about what we call the cash ratio. I just explained it, cash ratio. So we know that particularly when there is high circulation, of money in the economy, what basically the CBK, the government through the CBK does is that they increase the cash ratio. That will reduce circulation of money. And hence, by doing that, they reduce inflation. But again, also of essence, of importance is to understand that questions will not only be touching on this. We can have questions that will basically touch on even fiscal policy. So it's important to understand what a fiscal policy is altogether. Apart from the monetary, it is also very important to understand what we basically mean by a fiscal policy. That is how we particularly handle that question. We'll pick it on the last question. That is last question, April 2024, economics, the last question, that is 7 Roman D. Outline 3 measures that developing countries might use to promote agricultural production. Outline, that is D. Outline what we call 3 measures that developing what we call developing countries might use to promote agricultural production, promote agricultural production. So when you talk about this particular question, again, it's also more of a general question. When you talk about factors that foster or promote or encourage agricultural production, we know that the basis, one of the major backbone of an economy in this developing country is agriculture. Still, majority lies on agriculture, not much of the industrialization. So again, I say that this is a very much open question. When you ask such a question, we can say one of it is reduce taxes on agriculture, reduces the taxes on agricultural input. So you make agricultural input, and this encourages production. Then you say adopting an irrigation scheme, adopting irrigation schemes to overcome adverse weather condition like drought. Adverse weather, to basically overcome adverse weather conditions. Adoption of irrigation scheme to overcome what you call adverse weather conditions. And you can talk about developing infrastructure, what you call developing infrastructures in the developing countries. I explain particularly this. Why is infrastructure very important? Some of the challenges and why we have not spurred agricultural production in developing countries because of infrastructure. You find the roads, particularly the roads from the industry to the markets, are not very poor. So with that, there are delays in terms of exportation and that. So when you develop infrastructure, that in turn promotes what you call agricultural production. But I say that this is more of a general question. We can talk about a number of things. We talk about investing in research so that you can come up with better quality of products, investing in research. Again, we can also give loans to entrepreneurs, loans to entrepreneurs for those that actually wants to engage in farming massively. The government can offer loans to such. But again, also research is also very important into coming up with better qualities of products in order to invest in. That is how we particularly touch on that very question. That is question 7D, and that marks the end of that paper. Goodbye. We see one another in the next session.
Hello learners, welcome to Manifested Publishers e-learning portal. My name is Celestine Wandabusi. In our today's session, we are looking at a revision of Management Accounting April 2022. I just urge you to follow closely. Make sure you have your calculator with you so that we move together. Welcome. So I'm beginning with question number 1, part A. The question reads, cost accounting uses information provided by financial accounting together with other details of internal operations of an organization. With the reference to the above statement, describe 3 similarities between cost accounting and financial accounting. So we want to look at what are the similarities between cost accounting and management accounting. Number 1, we have periodicity of reporting. 2, accuracy is maintained in both systems. 3, the results of the business is revealed in both systems. 4, vouchers and we have vouchers and invoices forms the basis for recording of transactions, for recording business transactions. Number 5, we have fundamental principles of double entry is maintained in both systems. So these are some of the similarities between cost accounting and financial accounting. We have periodicity of reporting. In cost accounting, periodicity is more frequent than in financial accounting, where in financial accounting we have reporting done either semi-annually or yearly. But in cost accounting, it may be done weekly, monthly, or on yearly basis. But in both systems, we have that periodicity of reporting. Then we have accuracy of accounts being maintained. In both systems, we ensure that there is no biasness, there are no mistakes, errors, or omissions. So accuracy is maintained in both systems. Then number 3, we have results of the business revealed. The intention is simply to know whether there is any profit or loss being made, or to know the financial position of the business. And therefore, in both systems, we have results of the business being revealed. Note number 4, vouchers and invoices form the basis for recording of business transactions. They form as part of the books of books of subsidiary entries, which help in like creation of any other account. So we apply that in both systems. Number 5, we have fundamental principles of double entry. Whenever we are passing entries in both systems, double entry principle must be applied. So those are the similarities in the 2 systems. We move on to part B of the question. We are told that Rengo Limited has provided the following data for the financial year 2022. Number 1, we have budgeted output for the year, which was 9,800 units. Note 2, we have standard details for 1 unit. Under that, we have direct materials, we have direct labor costs, we've been given variable overheads and fixed overheads. So required, prepare a standard cost statement of unit cost showing prime cost, Roman 2, variable production cost, Roman number 3, total cost, and Roman number 4, selling price per unit at a notion profit of 15% on cost. For you to be able to answer this question, you need to understand what you need to consider, especially pertaining the data that you've been provided with. The question requires you to compute the total cost, but in that total cost, you need to show the subtitles. Prime cost, show the variable production cost, the total cost, and the latter show the selling price. So the best way of answering this question is simply preparing what we refer to as the cost sheet, which will enable you to show all the costs incurred, get the total cost, and then show the selling price. So this will be computed as follows. This is Rengo Limited. Note number 2, we are told that standard details for 1 unit direct materials is 4 square meters at 530. So to know the amount for that particular, for the raw materials, we are simply taking that quantity and then you multiply by the price. So we'll have 40 meters times the price, which is 250, which gives us 10,000. Then we have direct labor. We are told this was incurred in 2 departments, so we have bonding cost center. The quantity is 48 hours. You multiply by the price per hour, which is 250. Sorry, this should be 530, not 250, 530. So we calculate this. This should be 21,200. This is 12,000. Still under direct labor, we also had another department which is finishing cost center. The hours used were 30 hours and the price per hour is 190. So you simply multiply 30 hours times 190, which will give us 5,700. So add this. This is 17,700. In our part 1, we were required to show the prime cost. You now show the prime cost. Prime cost is simply the total of direct materials, direct labor, and direct expenses. So since we do not have direct expenses, the total prime cost will simply be direct materials plus direct labor. So this will amount to 38,900. So you've already answered part 1. In Roman number 2, you are told to calculate the variable production cost. So we now calculate variable production cost. When you look at note number 3, we are told that budgeted costs and hours per annum. Variable overhead, you've been given hours, and then we have shillings. So we have bonding cost center. Hours were 500,000 and the amount is 3,750,000. So we have not been given the cost per unit. For you to calculate the cost per unit, we do what we refer to as calculation of an absorption rate, which is simply based on the cost that is given divided by the number of hours that have been given, and that will give you the cost per unit. And therefore, in the bonding cost center, to calculate the cost per unit, you are simply taking 3,750,000. Then you divide that by 500 hours. You divide that by 500,000 hours. And then we were told that it is related to direct labor. So the direct labor hours that were incurred in the bonding cost center were 48 hours. So once you get the cost per unit, you now multiply by the number of hours that were incurred in that particular department. And this will give us the cost per unit for that center. So when you calculate you'll get 360. You do the same for finishing cost center. For cost finishing, we have 1,500,000 shillings. We are dividing by 300 hours to get the cost per unit. Then you multiply by the number of hours that were incurred in the finishing department, which was 30 hours. This will give us 150. Then you get the total. And this is 510. And that's part 2 or Roman 2 of that question, variable production cost. Then we move on to Roman 3. We are to compute the total cost. Still on that note number 3, we were given fixed overheads. So we are to calculate the fixed overheads. And under the fixed overheads, we've been given the amount for production. And remember, in note number 1, we were told that budgeted output for the year was 9,800 units. So to get the cost per unit, you are to take the production amount of 39,200,000. Divide this by the number of units that were produced, which is 9,800 units. Then multiply that. Sorry, we don't need to multiply, and get the cost per unit. So calculate that. This will give us 4,000 shillings. We also have selling and distribution, fixed overheads, and the amount is 19,600,000. Divide this by the number of units that were produced, which is 9,800 units. Then divide that. So this will give us 2,000. And then lastly, we have administration. Administration overheads, the amount is 9,800,000 divided by the units of output to get the cost per unit. And this will give us 1,000. Then get the total, which will give us the total cost. So we are adding from 38,900 plus 510 plus 4 plus 5,000 plus 5,000, which will give us 44,410. So that is the total cost. In Roman number 4, the question requires us to calculate the selling price per unit at a notion profit of 15% of cost. 15% of cost. So we already have the total cost of 44,410. We need to calculate profit, which we are told it is 15% of the cost. So calculate 15% of 44,410, which will give you 6,662. And then from there we now get the selling price, which is now the total of the cost plus the profit. And this will give us 51,071.5. This will be the selling price. So that's how you are to answer part B of question number 1. We proceed on to to part C of the same question. We are told that Jumbo Limited manufactures bracelets for export trade. The sales revenue is dependent on level of advertising expenditure per month. The company has recorded the following sales information for the past 6 months. So we've been given the information about advertising expenditure and sales revenue. And then we are told that the following has been calculated. So you don't need to calculate, the figures have already been given. Then required, estimate fixed and variable elements of the sales revenue using the least square regression analysis. To use least square regression analysis, you need to know how to determine the values of A and B. And therefore we have a formula which we use to calculate the values of A and B. So the regression formula is as follows. Sum of y equals NA plus B sum of x, and sum of xy equals A sum of x plus B sum of x squared. So these are simultaneous equations which must be solved together, and the intention is simply to find the values of A and B. So we have already been given information. We are told in that question that sales revenue is dependent on the level of advertising. Whenever you are answering this question, always be able to identify the independent and dependent variable. So the question has already interpreted for you what is the dependent variable and what is the independent variable. We have advertising expenditure and sales revenue. You've been told that sales revenue is dependent, meaning the sales revenue is our y variable, which is the dependent variable, and advertisement is the x variable, which is the independent variable. Under that table, you've been given the values. So what we need is sum of y. Remember, we are saying that sales revenue is the dependent variable, and dependent variable is abbreviated by y. So sum of sales revenue is given as 192,000. So just reduce the zeros based on the table that we've been given above. So we'll have 192 shillings equal to, N is referring to the number of observations or items that we have, which are already listed, and there are 6. So we have 6A plus sum of x. What is the sum of x? X is referring to independent variable, which is advertisement. You are given sum of advertising expenditure, which is 13.5. 13.5b. So this will become our first equation. Then we move on to equation number 2. We have xy, which is referring to advertising expenditure times the sales revenue, which again we've already been given. So this is 147,000.25 equals sum of x, that is sum of advertisement, is 13.5a plus sum of x squared, that is advertisement expenditure squared, which is 32.125b, and this will become our second equation. So from there we solve the equation simultaneously. We want to eliminate a. So to eliminate a, we must make values at a equal. To make equal, simply cross multiply. We have line 1 being multiplied by 13.5, multiply line 2 by 6. And remember that 6 and 13.5 is affecting all other values. So you multiply 192 times 13.5, which will give us 2,592. These are shillings, equals 6 multiplied by 13.5. This is 81a plus 13.5 squared. This is 182.25b. Do the same for the second line. We are multiplying all the figures by 6. So 147.25 times 6. This is 883.5, which will equal to 13.5 times 6 will give us 81a plus times 6. So this times this will give us 192.75b. Then you subtract. We are using elimination method. Subtract the values. So we are using elimination method. This should be 447, not 147. So 447.25 multiplied by 6 gives us 2,684. So we then subtract the figures. 2592 minus 2684. This will give us negative 92, which will be equal to, this is a 0. Then 182.25 minus 192.75 will give us negative 10.5b. From there, our intention is to find the value of b. So we divide both sides by negative 10.5. Divide both sides by negative 10.5. So b will be equal to it will be equal to 8.76. 8.76. So once we find the value of b, we now use that to calculate the value of a. So regression analysis equation is in the form of y equals a plus bx. And so for us to find this a, we are to use the first equation because it has smaller figures. So we'll have 192 equals 6A plus 13.5. We already have the value of B. Replace that with 8.76. Then you solve it. So we have 192 minus 118.25 equals 6A. So 73.74 equals 6A. Then we divide both sides by 6. Therefore, A will be equal to 12.29. And that is the value of A. So the question simply required us to find the value of fixed and variable elements of the sales revenue. So what are the fixed? In this equation, y equals a plus bx. A is referring to the constant, which is the fixed cost, and b is the variable cost. So we've already calculated the value of a and the value of b. So b is the variable cost and a is the b is the variable cost per unit and a is the fixed cost. And that is what was required in that question. Thank you and bye-bye.
Part B of the question reads as follows. S and M are advocates operating under the name SM Advocates. The firm's trial balance for the year ended 30th June 2022 is as shown below. They are talking of costs charged to clients through to capital. Of course, the trial balance has been given and it is balancing at 1,518,000 and also 1,518,000. Additional information. It's estimated that debts amounting to 16,500 are uncollectible and should be written off. Depreciation, that is number 2, depreciation should be provided at the rate of 20% per annum on the book value of the furniture, fittings, and library books. The uncompleted work on 30th June 2022 was valued at 70,500,000. Required statement of profit or loss for the year ended 30th June 2022 and the statement of financial position as at 30th June 2022. So this question was under preparation of financial statements from other entities, and more specifically it's about professional firms, and this is a firm for advocates. So we'll go straight to the first part of the required, that is Roman 1. SM Advocates. SM Advocates. Statement of profit or loss. Statement of profit or loss. Statement of profit or loss for the year ended. For the year ended 30th June. For the year ended 30th June 2022. Great. So shillings. Cost charged to clients. Cost charged to clients, that is the same as professional fees. So we are going to use as it is. Costs charged to clients costs charged to clients, same as professional fees, 750,000. 750,000. Add work in progress. Work in progress. Work in progress carried down. A work in progress carried down is the same as additional information number 3. And completed work, that is 7,500. 7,500. Less work in progress brought down. Work in progress brought down is the same as the work in progress balance brought down on the trial balance, 110,400. So this one is going to be deducted. So that is 750,000 plus 7,500 minus 110,400, 710,100, 710,100. That is like total income. Total professional fees for that period, less expenses. Less expenses. The first expense is office expenses. Office expenses. The office expenses amounted to 25,500. 25,500. Postage, telephone and internet. Postage, telephone and internet. So postage, telephone and internet amounted to 54,600. 54,600. Printing and stationery. Printing and stationery amounted to 105,000. Printing and stationery. Rent and rates. Rent and rates, 180,000. That has been given us 180,000. Salaries to staff. Salaries to staff, 216,000. Salaries to staff is 216,000. And finally, the expenses on the trial balance have been exhausted. We move to the additional information number 1. There is irrecoverable debts. Irrecoverable debts. Irrecoverable debts amounted to 16,500. And finally, depreciation, which is being provided on furniture and fittings, and depreciation is at the rate of 20% per annum on book value. 20% per annum on book value. So we have the figure of furniture, which is of course at book value. So that is 20% times the value of furniture is 135,000. 135,000. That will give us 135,000 times 20%, 27,000. 27,000. Once you have the expenses there, it is 25,500 plus 54,600, 54,600 plus 105,000 plus 180,000 plus 216,000 plus 16,500 plus 27,000. This is 624,600. 624,600. 600, and profit for the year. Profit for the year. The profit for the year is 710, 100 minus the answer 85, 500. 85, 500. So that was the statement of profit or loss for that professional firm during that particular period. That takes us to the statement of financial position. SM Advocates. SM Advocates. Statement of financial position. Financial position as at 30th June. 30th June 2022. As at 30th June 2022. So we have assets. Or before assets, we can bring in the two columns. And non-current assets. Under non-current assets, we have furniture, fittings, and library books. Furniture, fittings, and library books. Furniture, fitting, and library books. Now let us compute the book value for the same. The cost is 135,000. Remember, the cost was 135,000 minus depreciation, which we've computed as 27 minus 27,000. That is the depreciation that we even computed in the statement of profit or loss. The book value is 108,000. 108,000, and that is the only non-current assets. Current assets. Current assets. We have the first one being work in progress, carried down, work in progress at the end of the year. The work in progress at the end of the year, in additional information number 3, was 7,500. We have receivables. Receivables amounted to 234,000. 234,000. Cash at bank. Cash at bank. Or before we record cash at bank, receivables is to be affected because there was irrecoverable debts. There was some irrecoverable debts, so this one is going to be reduced. So that is 234,000 minus the recoverable debts of 16,500. 16,500. So that is 234,000 minus 16,500 to 17,500. 17,500. Then there is cash at bank divided into 2. There is client and there is office account. Client account and office account. Client account is 74,400. Office account is 167,100. 167,100. Any other current asset here? We have disbursement on behalf of clients. 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 36,000. 36,000. Disbursement on behalf of clients. 36,000. So the total assets, total current assets, 7,500 plus 217, 500 plus 74, 400 plus 167, 100 plus 36,000, 565, 500, 565, 500, 565, 500. Total assets, total assets plus 108,000, 673, 500, 673, 500. From that point, we move to capital and liabilities. Capital and liabilities. And we have capital. The capital account stood at a balance of 612,000. Add profit. Profit for the year. The profit for the year was 85,500. Less drawings. Drawings amounted to 180,000. Drawings amounted to 180,000 and they are to be subtracted. So that is 612,000 plus 85,500 minus 180,000, 517,500. Non-current liabilities. Non-current liabilities, and non-current liabilities were not there, so it's going to be nil. Current liabilities. Current liabilities were given as follows. We have clients for monies held on their behalf. So clients for monies, clients for monies held, of course, on their behalf, for monies held on their behalf, amounted to 74,400. 74,400. Creditors, 81,600. Creditors, 81,600. Total is 74,400 plus 81,600, 156,000, which gives us the total capital and liabilities. Total capital and liabilities, which is 517,500 plus 156,000, you get 673,500. 673,500. 673,500. So, learners, that is how the question was supposed to be handled. That is for financial reporting August 2022 question 4, which combined lease accounting IFRS 16 and also professional firms in financial statement of other entities, and more specifically professional firms. See you again in our other subsequent revisions. My name is Nicholas Sikali.
Welcome to Manifested Publishers. My name is Mr. Bernard Mariga. I'll be teaching you advanced management accounting, and today we will go to a question on December 2024. December 2024. 4C. Let's go to question 4C. Should be question 4C. Though we will need to use information on 4B. 4C is saying Lambda Investment Enterprise Limited is contemplating acquiring perfect information from an investment research firm about the viability of the investment opportunities. The investment research firm is willing to provide perfect information about the investment project at a cost of 30 million. Required. Using suitable computations, advise Lambda Investment on whether or not to acquire the perfect information from the investment research firm. All right. Now, so what we need to do is we determine our value of perfect information by getting the expected monetary value with perfect information minus the expected monetary value without perfect what? Information. So, as to do that, we need to prepare our a payoff table. So let's have the states of nature, or states of nature, and in this case your states of nature were what and what? Remember, your states of nature, we've said they are those events that cannot be controlled by management, and they should have prior probabilities if you're dealing with risk. And this was your economic conditions. This is your economic conditions, which was optimistic with a probability of 0.3, most likely with a probability of 0.4, and pessimistic with a probability of 0.3. Your decision alternative was here, or will be here. You can either invest in corporate, shopping mall, and lastly, residential area. And then we now represent our payoffs. Let's represent our payoffs. 100,000, 70,000, 130,000, shopping mall, 110,000, 90,000, 90,000, residential, 90,000 is your payoff. 120,000 and 70,000. 170 what? 1,000. Now that we have drawn our what? Payoff table, let's determine our expected monetary value with perfect information. Your expected monetary value with perfect information will require that you select the highest payoff for each state of what? Nature. For optimistic, that is your highest payoff. For most likely, that is your highest payoff. For pessimistic, that is your highest payoff. Then these highest payoffs here, you multiply by your probabilities. Why? If you knew under optimistic that the shopping mall is the best decision you could make, there is the most likely chance, or the best decision is to choose what? Shopping mall. If under most likely you knew that the residential results in the most payoffs or the highest payoff, you're going to select what? Residential. In pessimistic, if you had enough information and knew that the corporate is the one with the highest what? Payoff, you would have selected what? Corporate. And that is why we say this expected monetary value with perfect information, which is your maximum payoffs of each what? State of nature. Then you multiply by your who? Probabilities. Remember, expected, you must multiply with your probabilities. And how will that be? You're going to say it is 110,000 with a probability of 0.3 plus 120,000 with a probability of who? 0.4 plus 130,000 with a probability of 0.3 with a probability of 0.3. 110 by 0.3 plus 120 by 0.4 plus 130 by 0.3. So expect how much? That your expected monetary value with perfect information will be how much? Will be 120,000. The next thing I want us to do is to determine your expected monetary value without perfect information. Expected monetary value without perfect information. And the expected monetary value without perfect information is simply your EMV, your maximum expected monetary value. And how did we get your expected monetary value? You simply take your payoffs by the probability. For example, corporate. We have done this previously. Corporate, you're going to take 100,000 by who? By 0.3 plus 70,000 by who? 0.4 plus 130,000 by 0.3. Then shopping mall, 110,000 by 0.3 plus 90,000 by 0.4 plus 90,000 by 0.3. Residential area, 90,000 by 0.3 plus 120,000 by 0.4 plus 70,000 by 0.3 by 0.3. 100 times 0.3 plus 70 times 0.4 plus 130 times 0.3. This should be 97,000. Shopping mall, 110 times 0.3 plus 90 times 0.4 plus 90 times 0.3. That should be 96,000. 90 times 0.3 plus 120 times 0.4 plus 70 times 0.3. 96. But remember, using the expected monetary value approach, you normally select the one with the highest. So this is what? 97. This is your EMV. 97, 96, and 96. So you select the highest. That is the highest. Okay? So therefore, the expected monetary value of perfect information will be your expected monetary value with perfect information of how much? 120,000 minus your expected monetary value without perfect information, which is the highest EMV, which is 97,000. So 120 minus 97, which is how much? 23,000. 23,000. 23 what? 1,000. That is the value that you expect to obtain when you acquire perfect information. When we say acquire perfect information, is where you can hire a company. Then when you hire that company, the value they will give you is worth how much? 23,000. But part C of that question, they are asking advice on whether or not to acquire perfect information. So here what you will do, you will simply now compare the value of perfect information and the cost of acquiring that perfect information. The cost of acquiring perfect information is how much? 30 million, so 30,000. So when you acquire perfect information, it will be worth how much? 23. But how much do you expect to incur for it? 30. So therefore, what will you advise them? You will advise them, do not acquire perfect information. Why? Because it is more expensive to acquire than the cost you're going, than the value you're going to obtain, So you're going to advise them not to acquire perfect information because it is far much expensive. The cost outweighs the value you obtain. That is how you deal with expected value of perfect information, but using what? Payoff table. Using payoff what? Table. So remember, it is simply the difference between expected monetary value with perfect information minus expected monetary value without perfect information. And we've said the expected monetary value without perfect information, simply you must determine your EMV, expected monetary value, then the maximum. I hope that is clear.
Welcome to Manifested Publishers. My name is Mr. Dongo, Public Finance and Taxation Lecturer. Today we are going to handle public finance paper that is August 2024, question 4. August 2024, question 4. August 2024, question 4. August 2024, question 4. So the first question, that is question A, explain the following terms as used in taxation. Explain the following terms as used in taxation. One is what you call duty drawback. Question 4A, Roman 1, is what you call duty drawback. What you call the duty drawback. So when you talk about duty drawback, we're saying means a refund. This basically means, we say means a refund of all or part, or we say or part, refund of all or part of any import, duty paid in respect, we say in respect of goods, exported, in respect of goods exported, or used, we say used in a manner, or for the purpose, exported or used in a manner, or for purpose, prescribed, we say prescribed, purpose prescribed as a condition, we say as a condition for granting duty drawback, So very important, we say that when you talk about duty drawback, we basically mean a refund of all or part of duty or part of any duty of any import duty paid in respect of goods exported or used in a manner or for the purpose prescribed as condition for granting duty drawback. So the key word is refund of all or part of any import duty paid in respect to goods exported. So that is what you call a drawback. The second that is A Roman 2, we have what we call sufferance, what we call sufferance WAF, what we call the sufferance WAF, what we call the sufferance WAF, sufferance WAF. So when you talk about sufferance WAF, it basically means any place, we say means any place, other than, any place other than, unapproved, what do you call unapproved, any place other than approved, approved place of loading, we say loading, or offloading, or offloading, loading or unloading, or offloading or unloading, any other than approved. So it means a place other than approved, a place other than the approved. Approved basically means the one that is recognized for loading and unloading, at which a commissioner, may allow, any good to be loaded, or unloaded, to basically be loaded or unloaded. So then we have Roman 3. What we call import declaration fee. Import declaration fee. So when you talk about import declaration fee, this is basically paid to goods that are imported into the country, basically for home use. Goods that are imported into the country, basically for home use. So we can put it down and say that it is a fee. It is a fee on all goods imported into the country for home use. Into the country, basically for home use. So we know that the amount payable is about 3.5% of the goods that are imported. But the keyword is basically when you talk about import declaration fee, it is a fee that is paid on all goods imported into the country for home use. So we can pick the next question, that is B, a calculation question that is on partnership. A calculation question on partnership, that is B. So the first thing we're being told that there is a Waka and Baraka started a partnership business in the year 2022, sharing profit and losses in the ratio of 5:3. So we have two partners, that is Waka, and we have Baraka, and Baraka. So Waka and Baraka, the ratio is 5:3. Then this should be ratio of 8:5. Then this should be 3:8. That is the sharing ratio. That is basically the sharing ratio. So we're being told that the following is the statement of profit or loss for partnership in the year ended December 2023. So we are looking at sales. We know that sales, that should be a taxable, income. General bad debts recovery, that is a non-taxable income. We have anticipated foreign exchange gain. When you talk about anticipated, those are not realized, so that's also non-taxable income. We have capital gain on the sale of land. Again, that is a non-taxable income. Then you have insurance recovery on stolen vehicle. When you talk about insurance recovery, basically on a stolen vehicle, that is also basically what you call a non-taxable. That is what we also basically called a non-taxable income. Then release of liability. When you talk about release of liability, then that is a taxable income. Release of a liability is a taxable income. Then you have interest from Ulinzi Sacco. When you talk about interest from Ulinzi Sacco, that is an investment income. So that is a non-taxable income in relation to the business. And we know that interest from SACCOs, we call them qualifying interest, where we're saying that the 15% withholding tax is final, and therefore we do not subject them to further taxation. Then we proceed to the expenses part. When you talk about the expenses part, we have the purchases. We have purchases, which is an allowable deduction, allowable expense or allowable deduction. Then you have purchase of computers. We call purchase of computers as non-allowable. Purchase of fixed assets are not expenses in taxation, so that is a non-allowable expense. We have repairs expenses. When you talk about repairs expenses, those should be allowable expenses. We have legal and professional fee. So on the legal and professional fee, we basically say that legal and professional fee can be allowable, and at the same time it can be non-allowable. However, if an examiner brings a question on legal and professional fee and there's not an additional information, then that legal and professional fee should be allowable expense. The next is what we call rent and rates. Rent and rate, that should be allowed. We can look at the additional information. General expense is allowable expense provided there's no additional information saying something contrary. Motor vehicle expenses, that should also be allowable expenses provided there's no additional information saying something contrary. Then we have the insurance, that should also be allowable expense provided there's no additional information relating to anything. Then we have what we call welfare expenses. Welfare, basically if you have welfare for employees, that should be allowable. Then we have audit and accounting fee. Audit and accounting fee, that should also be allowable expense. Then we have computer softwares and programs. That is a capital expenditure. So capital expenditure, those should be non-allowable expense. Then lastly, we have traveling expense, a figure of 64, that should be allowable expense. So if you look at the totals and we minus from the incomes, the accountant basically got a net loss of 2,750,000, and this needs to be adjusted as a tax person when now we talk about in terms of tax. So additional information. We have legal and professional fee. Total was 816. Out of that, there is a legal and professional fee. The first one, that is legal fee on defense against alleged breach of trade contract. When you have legal fee on defense against alleged breach of contract, those should be allowable. Those are allowable expenses. The next is legal fee on tax appeal. That is a non-allowable, so that needs to be added back. That is a non-allowable expense, which is in the P&L. We need to adjust it by adding it back. We have legal land conveyance fee. Land conveyance fee is also what we call non-allowable expense, so we need to add it back. Stamp duty is also non-allowable legal fee. We also need to add it back. Then negotiating a business loan. When we have legal costs that we incur to negotiate a business loan, that we also say that is also non-allowable legal cost. Then we have recovery of bad debts. Legal fee that relate to customers and debtors, that is allowable. That is an okay expense. Then we have signing 100 years lease agreement. When you talk about lease agreements, renewal and signing of leases, if leases are below 99, then those ones should be allowable. However, if leases are above 99 years, like the one we have in this particular question, that says 100 years, then that should be a non-allowable. Then we have purchase of private or partner's private vehicle. That is a private expenditure. So purchase of a partner's private vehicle as a legal cost, that should be non-allowable expense. Then the last one of the legal fee, we have what we call legal fee on renewal of patent. Renewal of patents, that should also be non-allowable expense. So done on additional information 1. So additional information 2, we have repairs expenses comprised of the following. The first expense that relates to repair, we have the purchase of furniture. When you talk about the purchase of furnitures, those should be non-allowable expense. when you talk about the purchase of furnitures, those ones should also be non-allowable expense. We have what called designing and partitioning of a new block. Designing and partitioning of a new block, that's also a capital expenditure, so that is a non-allowable expense. Then lastly, we have what we call repainting of an old office block. That should be allowable. So that one we don't adjust by adding back. So we move to the to additional information number 3. Additional information 3. So we are told that impairment, one is impairment of patent, general expense. Impairment of patent, that should be non-allowable expense. The impairment of patents, that should be non-allowable expense. Then we have provision for general bad debts. Provision for general bad debts, that's a non-allowable expense too. We add it back. Then we have drawing of goods by partners. Drawing of goods by partners, we know for sure that those are non-allowable expense. So additional information number 4, that gives us to our working one. We can call it working 1. So on the working one, we're being told that purchases and sales were inclusive of VAT at the rate of 16%. Taxes paid or taxes refunded. Taxes paid are not expenses. That one we need to understand. The taxes paid are not basically expenses. So tax paid are not expenses. Again, we need to understand that tax refunds or tax that are basically on incomes, those are non-allowable. And we need to adjust the taxes on sales by lessing, the taxes on expenses by adding back. So we say that purchase and sales were inclusive of VAT at the rate of 16%. So we have the first one, that is purchase. The figure for the purchase is 3,706,000 was inclusive of VAT. So that implies that this was 116%. So what is the VAT that we need to add back that were on purchases that understated the profit? Remember the VAT, we say VAT on purchases understates the profit. So correction is correction, add back. So we get that VAT. So say 16 over 116 times 3,706,000. 3,706,000. If you look at that, we have 16. We have 16 over 116 times 3,706,000. So we have the figure is 511,172. 511,172.4. We round it to all numbers. So with this one, we are going to add back. So then we have VAT on sales, just on that VAT on sales. So we have the figure for the sales. If you look at the figure for the sales in this particular question, the figure for the sales is 5780. That inclusive of sales, that should be 116%. So what is the VAT on sales? We know that the VAT on sales basically overstate. VAT on sales, we know that VAT on sales overstates the taxable income. The VAT on sales basically overstates the taxable income. So we need to understand that the correction is to deduct. The correction is basically to deduct. So if you say that 5,580,000 is equals to 116%. What about that VAT that we need to deduct? VAT, which is 16%. So that should be 16 over 116 times 5,780,000. 5,780,000. So we have this. So that is 16 over 116, then times 578. So that should be that VAT that we need to deduct. That is 797,241. 797,241. 797,241. 797 241. So then we get to the next additional information. Working to. We're being told the closing inventory was valued at 120. So 1.2, sorry, closing inventory, inventory value. So the closing inventory value is 1.2. The figure is 1.2. That is the closing inventory value. The figure is basically 1.2, while the opening inventory was valued at 10% of the net sales. At 10% of the net sales. So we can get the value of opening stock. The value of opening stock. So the value of the opening stock was valued by 10% of the net sales. Net sales basically means net of value added. So the sales we have, if you look at the sales is 5,780,000. This is 116. So net of sales, that should be 100%. So net of VAT, sorry, net of VAT. So net of VAT, that should be 100 over 116 times 5780,000. So sales net of VAT, we have our calc, and we say that 100 over 116 times 5780. So what do we have? We have a figure that's 4,982,000, 982,000, and then we have 982,000, then we have 759, 982,759, rounding it to all numbers. So with that we have the net sales. So the opening stock was basically, we were told that the opening stock is basically 10% of the net sales. So opening inventory, we have the opening inventory in that particular question, 10% of the net sales. That's 4,982,759. When you get 10%, there should be 498,275.9. So the opening inventory rounded off to all numbers should be 498,276. That is basically the opening stock. So we're being told that opening stock and the closing stock were both undervalued. Opening stock and closing stock. We say undervalued at 10%. So we start with the opening stock. So this figure, 498,276, is undervalued by 10%, meaning it is 100 less 10. So this is 90%. So what is the undervalue, which is 10%? This is what you call the undervalue. So the undervalue that is 10% should be 10 over 90 times 498,276. For 498,276. So we get the undervalue, which is 10 over 90 times 498,276. So the figure is rounded to all number, that should be 55,364. So when you have 55,364, when an opening stock is basically undervalued, what is the correction? When an opening stock is basically undervalued. Let's have a practical example. We have SP sales, we just say sales 2,000. A practical example, sales 2,000. We have purchases 1,000. We have opening stock 400. and then we have the closing stock 500. So to get GP in this, to get GP, particularly on this, to get GP, so we have this and this. So we have sales, that should be 2,000. Opening stock, 400. Purchases, 1,000. Then we have closing stock. Closing stock, 500. So when that happens, we have 900. And so we know that when you have 900 there, the gross profit in that case should be 1,100. So if the opening stock in this case is undervalued, let's say we undervalue by 100, 300. What is the implication? What is the effect of undervalue of 100? So that would be now 300 plus 1,000 minus 300 plus 1,000, that is 1,300, minus 500, that is 800 now here. So we have the gross profit rising. The gross profit rising. So when an opening stock is basically undervalued, the correction is to deduct. It overstates, deduct, since it overstates profit. Deduct since it overstates the profits. So basically the correction is to deduct since that basically overstates the profit. So the opening stock that is undervalued of 55,364, that should basically be deducted. Then closing stock, we can have the closing stock here. Closing stock at this point. So the closing stock is a figure of 1.2. A figure of 1.2. That was also undervalued by 10, so that's 90%. So the undervalue is 10%. So that should be 10 over 90 times 1.2 times 1.2. When you do that, when we basically do that, so we have 10 over 90 times 1.2. So the figure should be 133,333. So 133, we have 333, two whole numbers. So when closing stock is undervalued, the effect is that it understates. The effect that is it understates, so we add it back. So it understates the profit, so the correction is to add back. So the correction is basically to add back. So we read the last additional information. Interest include, so the interest, we have a figure of 160 in the paper. The figure is interest. When you talk about interest expense, 166. Interest expense include interest on partner's capital of 120, which was shared according to the ratio. So interest on partner's capital is a non-allowable expense. So we need to note on that additional information, number 6, that 120 is a non-allowable expense that needs to be added back. But you're saying that under what we're going to take under partner's allocation, income allocation schedule, we are going to share this interest on capital based on the ratios. So we can have this working as sharing of interest. Sharing of interest. Interest on partner's capital. Partner's capital. So that's as we call it, we're working through there. So we have worker. That should be, worker is 5 over 8 times 120. Then we have Baraka. Baraka should be 3 over 8 times 120. 3 over 8 times 120. So we get those figures. So 5 over 8 times 120. So that should be 75. And we are taking them to income allocation schedule. So the other one will be 3 over 8 times 120. So we have 45. That's okay. We have that as 45. So that marks the end of those additional information. So required. We are told that compute the adjusted taxable profit of partnership for the year ended 31st December 2023. So that is the first Roman A, B Roman A. So say you Waka and Baraka partnership, Waka and Baraka partnership. Taxable, what do you call adjusted taxable profit? What do you call adjusted taxable profit for 2023. And we need to understand, because we've been provided with accounting profit, we need to understand that we are going to use the net profit. So we'll say we have this shillings on this. Then we know that in this particular question, we have been provided with an accounting profit. So we use what you call the net profit method. So say accounting loss stroke profit provided. So based on what was done by accountant, it basically said that this business made a loss of 2,750,000. So then we say add back non-allowable expenses in P and L, non-allowable expenses in P and L, non-allowable expenses in P and L. Then taxable, we say taxable incomes not in P and L, and taxable income not in the P and L. So when you look at this, when you look at basically what you have, so we start with the P and L, that is on the expenses. So we have the non-taxable, non-allowable expense that we have for the first one in the P and L, less expenses. We have purchase. We have what we call purchase of computers. We have the purchase of computers. So that's a figure of 216 that needs to be added back. 216. Then we have the next on that P and L. We look at the repairs, no legal fee. Just on that computer softwares and programs. We have computer softwares and programs. So that should be 1.2. Computer softwares and basically programs, that is 1.2. So then we have the first additional information that we have on legal. So we say that legal fee on defense against alleged breach, that is allowable. Then legal fee on tax appeal. We have legal fee on tax appeal. Legal fee on tax appeal, that should be 64,800. Then we have land conveyancy fee, what we call the land conveyancy fee. So the land conveyancy fee, that is 72,400. We also had stamp duty. We also say that stamp duty, that should be 36,600. That is a stamp duty. We can have the last one. Negotiating a business loan. What do you call negotiating on this? Negotiating a business loan. That's also non-allowable. Negotiating a business loan, that should be 25,400. That should be basically 25,400. So I hope this is able. This is very visible as we look at that. So because of some entries that we need to have there, and then we have that. This entry we can wrap, that we need to add back, that is VAT on purchases. That is basically VAT on purchases, 511. We need, as we wrap it, we need to put it there. So we have VAT Another item, VAT on purchases. On the purchases, that is 1,511,172. So we go on with where we had signing 100 years lease agreement. So say signing 100 years lease agreement. Signing 100 years, that is more than 99. That should be 128. So we have 128,400. So then we have the next, that is purchase of partners. That is a private purchase of partners. We call it partners private vehicle. Private vehicle. Purchase of partners private vehicle. That is a private expenditure. That is 137,400. We have that. Then the last one, we know that legal fee on renewal of patent. Legal fee on renewal, what they call renewal of patents. Legal fee on renewal of patents. So the legal fee basically on renewal of patent. Legal fee on renewal of patent. On renewal of patent, we have a figure of 126. That's a figure of 126. We can clear what you have. We know that we have that figure at the back of our mind. 7. We need to understand that we have it as 797, 241, so that we don't go doing the working again. So then we proceed to additional information number 2. We knew that the purchase of furniture, is also non-allowable. That should be 260. Purchase of furniture. Then you have designing and partitioning. What you call designing and partitioning. What you call partitioning of new office. Designing and partitioning of a new office. That's also capital expenditure. That should be 341. So that is also added back. That is also added back. And that is okay. So we move to the third. Impairment of patent rights. That's non-allowable. What you call impairment. Impairment of patent. What you call patent right. Impairment of the patent right. We have a figure of 120. That's also need to be added back. Impairment of patent right. Impairment of patent right. Then provision of general bad debt, also non-allowable. Provision of general, what you call general bad debt. Bad debt. That should be a figure of 208,000. We add that back too. Then we have the last one, drawing of goods by partners. We have drawing of goods, also non-allowable, goods by partners. Drawing of goods by partners. So that should be equivalent to 314. 314. Having a figure of 314. 314. Then purchases, we knew that we needed to add back VAT on purchase because that's understated the profit. On the sales, we are going to less. So we're still looking at what items that we need to add back. So we proceed to opening and closing stock that were understated. We know that what we need to add back is closing stock understated. So we say closing stock understated. We say understated. The closing stock that is understated, that should be 133,333. 133,333. Then we have the last one, that is interest on partners' capital. We call it interest. Interest on partners. We call it partners' capital. Interest on partners' capital. The figure is 120. Interest on partners' capital. The figure is basically 120. So these are the items that we need to add back. What is the total of those items that are needed to be added back? We have 216. We had it 216,000 plus 1.2 down there plus 64,800 plus 72,400 plus 36,600 plus 25,400. We have that. Then plus 511,172. 511,172 plus 128,400 plus 137, 400, plus 126, plus 126, plus 260, plus 260, plus 341, plus 120,000, plus 208,000, plus 314,000, plus 133,33. Then lastly, plus 120. So the figure is 4 million. The items that we need to add back, 014,505. That is 4,014,000 and 14,505. So we go to less. Less, we know that we less non-taxable, taxable operating incomes in P&L, comma, investment incomes in P&L, investment income basically in P&L, and what to call and allowable expenses not in the P&L, not in P&L, and allowable expenses not in P&L. So what are we lessing? Non-taxable operating incomes in P&L, investment income in P&L, and allowable expenses not in P&L. And when you talk about allowable expenses not in P&L, this is basically the investment allowance, because we do not have deposition in taxation. So we move to those items. We look at the incomes. So the first one is general bad debt recovery. So we have general bad debt recovery, general bad debt recovery, general bad debt recovery. So that should be 75, the item that we need to less. Then we have anticipated, what we call anticipated foreign exchange gain. Anticipated foreign exchange gain, 180. Anticipated foreign exchange gain. Anticipated foreign exchange gain. So we looked at that as we rotate that camera to that very hand, because of we have that. So then on those incomes, we also have capital gain on sale of land. What do you call capital gain on sale of land? Capital gain basically on the sale of land. That should be 352,000. Capital gain on the sale of land. That is a figure of 352,000. Then insurance recovery on stolen vehicle. This is recovery on fixed assets, so that's also non-taxable. That is 320. An item that we also need to less. We have release of liability is taxable. We have now interest on from Ulinzi, what we call Ulinzi Sacco. Interest from Ulinzi Sacco. Interest from Ulinzi Sacco. So Ulinzi Sacco, we know that that's a figure of 34, and that is qualifying interest. So we don't subject it. We do not take it to the income allocation schedule. So then we move on those incomes. We are sorted, but we know that VAT on sales, that was basically overstating profit. VAT on sales we had 797,241. We noted it up there. Then we have the next item, that is opening stock understated. What we call opening stock understated. So the opening stock that was basically understated, that is 55,364. Then we wrap this and move to the investment allowance. Opening stock understated. So as we wrap that, we now move to allowable expenses that are not in the P&L. So that is basically investment allowance. And this is, to be precise, wear and tear. So we can have the first one. We know that we have computers, We have computers. Those that should be under investment allowance at the rate of 25. So that times 25% times 216. The investment allowance on that, 25% times 216. 25% times 216. 25% times 216 times 216. So that should be 54. Then we have the next. On the next was computer softwares. We have computer software. That's also 25% at the rate of 25%. That is 1.2. 1.2. That should be 300,000. That should be 300,000. 1.2. That should be 300,000. And then we have what we have furnitures. Furnitures, we know 10%. Furnitures, we know that should be 10%. So furniture, we had on the furniture that was 260. If you look at that furniture was 260. So that is 10%. Furniture times 260 times 260,000. That should be 26. The investment allowance. Then we have partitioning. The partitioning figure was 341. We know that partitioning is also 10%. So times 10%, that should be 34, 100. So these are the items that we need to less. So we can get the summation of items that we need to less so that we get the adjusted taxable profit or a loss. So I have 75 plus 180 then plus 352 plus 320 plus 34 plus 797 241 plus 55 364 then plus 54 plus 300,000 plus 26 plus 34,100. So this gives us what we have as 2 million. So we have 2,227,705 as items that we need to less. So we have the adjusted, what we call the adjusted, but A adjusted taxable profit or loss for the business. Adjusted taxable profit or loss for the business. So we have a loss, a negative of a negative 2, a loss which is that is a negative. So that is negative 2,750,000 plus 4,014,505. So when you had that, then we less 2,227,705. So what do you have? Adjusted taxable loss of 963,200. That is adjusted taxable loss of 963,200. So when you adjust it, they got it, accountant got it at this, but as we adjust it, we know that the loss was basically 963,200 using the principles of tax. Adjusting that, we have a figure of 963,200. So then we can proceed to the next part. The next part we've been told, allocation of profit or loss. So that is B. We can have that B here. What we call allocation of profit or loss. We stretch as we rotate the camera. We stretch as we rotate to have it on a clean slate. That is basically on this other end, to have it on a clean slate. We have it on the clean slate, but we can just have it on that end. We can just have it on this end. We know that this can be enough. So we have Waka, we have Baraka, we have Baraka, and then we have totals here, and then we have totals on that end. So what do we start with? We start with items that we need to add: interest on capital. So interest on capital, there was a 120 that we were able to divide. The 120 that we were able to divide, as we rotate that camera, we can look at where we did the division or working. That interest on capital was basically 75 for Waka, and Baraka was 45. So we get back and have 75 on this. We have 45 on this. So then now we have a figure of 120. And then we have a figure of 120. Then we have a figure of 120. So then we proceed to the next. Is there salaries to partners? There's no salaries to partners. Is there interest on drawing? There's no interest on drawing. Is there bonuses to partners? We do not have that. So we have a column here. We call it the share of profit. We hold it. Share of profit. Share of profit. We hold it. Share of profits stock loss. Stock the loss. Share of profit stock the loss. We have taxable. Taxable. Operating profit or loss for business. Taxable operating profit or loss for the business that we got from our working. That is basically 963, 200. So we have that. So we look there keenly. So this one we call it A. We call this one B, sorry. This one we call B, and this one we call A. And sometimes for this particular question, we were simply having one item, that is the interest on capital. So how do you get the profit of share, which is C? C should be B minus A. So the taxable operating loss. So if you have a loss of 963, 200, and then you minus 120. You minus 120. So when you minus 120, we mean that there's a loss that needs to be shared. That loss is 1,083,200. How are they sharing it? As I do the working here, how are they sharing? I do the working here as the camera is being rotated. The ratio is still the same. Even that loss is supposed to be shared. So we have Waka, and then we have Baraka. Waka is having 5/8, and the total loss, as we rotate that, the total loss is 10,83,200. So how much loss goes to Waka? Then Baraka is 3/8, 10,083,200. How much loss goes to that? So we get that. So times 5/8. So the loss that goes to Waka, that should be 677. The loss that goes to Baraka, that is 10,083,200 times 3/8. So the loss that goes there, that should be 406. This should be 406,200. So we have that loss that basically goes to this. So this should be 677. Then we have 406,200. So what is the taxable operating income that goes to Waka? We remember, under partnership, we do not tax partnership, but we tax basically individuals that are in partnership. So 75, which is a positive, minus a loss that is 677. So what do we have? We have a loss that is 6. That should be 602. that is, and that we also have a loss. The loss is bigger than the positive value. So if we take 45, so the loss basically decreased to 361, 200. So add, we just say add other taxable investment income. We do not have those investment income. There's none. So then we just wrap this again. We get the total taxable. We wrap that to get the total taxable income. Total taxable income. So we have worker, baraka, and then we have the total. The figure remains the same. So that is 602. That is a loss. That should be 361, 200, which is a loss. So the total loss we know is 963, 200. When that is added, 963, 200. So we cannot, in the first place, we cannot tax even these persons because they're making a loss. They're making a loss. In the first place, we cannot tax partners. The partners, we say we do not tax partnership, but we tax individuals that are basically in partnership. That is how we basically tackle that question. That is question 4. But again, a point of essence, when you're doing these particular questions on calculation, remember it's the entries that count. So a student needs to be very careful and make majorities of entry. I always say that if you can make 75 to around 100% of the entries, you stand a better chance of doing very well in this calculation. And also just to encourage that these calculations are doable and that the perfect way is that students can basically score marks. That is how we basically sort that question 4, and that marks the end of the session that we have. See you in the next session.
Welcome, candidates. Today we are going to answer question 2. The subject, Advanced Financial Management, November 2020. Question 2. In our last session, we answered question 1. Question 2A, I read, the following information relates to 2 mutual funds operating in your country. Omega Mutual Fund and Beta Mutual Fund. The realized return, 13% Omega Mutual Fund, 18% Beta Mutual Fund. Beta, 1 for Omega Mutual Fund, 2 Beta Mutual Fund. Standard deviation, 19% Omega Mutual Fund, 15% Beta Mutual Fund. Additional information, number 1, the return on the market index is 12%. Number 2, the risk-free rate is 8%. Required for each of the above mutual funds, compute the following performance index scores. Roman 1, Jason's Alpha, 2 marks. Roman 2, Trenos Alpha, 2 marks. Roman 3, Sharp Index for the funds and the market, 3 marks. This is question 2A. You have to compute for each mutual fund, Jensen Alpha, Trenos Alpha, and Sharp Index. Roman 1. So candidates, as usual, it's important to put down the formula. The formula for Jensen's Alpha. The first one, Jensen's Alpha. The formula is R, the return of portfolio, minus R risk-free, this is risk-free, plus beta RM minus R F minus R F. Jensen's alpha. Now, candidates, Jensen's alpha was developed by Michael Jensen. That's where we get the word Jensen. Jensen is a person whose other name is Michael. It was developed in 1968, and the purpose was to measure the difference between a portfolio's actual return and its expected return according to the CPA. According to the CPA. So that's the formula. So let's work out the Jensen's alpha for the first company here is Omega. 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 Omega's return on portfolio is return on portfolio. Realized return is 13%. 13% minus Omega's, this is Omega's risk-free, Omega's risk-free, and that the risk-free is just the treasury bill is 8%, that is 8% plus beta omega beta is just 1, substituting the values in the formula candidates, 1 into the market return. The market return is 12% minus 8%. Minus 8%. That will give us the Jensen's alpha for Omega fund. Then we do the same for the next fund, which is beta. Beta. The risk-free, the return on beta mutual fund return is 18%. 18% minus risk-free remains 8% plus beta 2 times the market return 12% minus the risk-free 8%. That will give us the Jensen's alpha for Omega and beta. These are fund, beta fund. Then the next candidate is Trenos alpha. Trenos alpha candidates. The formula is the portfolio return minus risk-free rate divide the portfolio beta. Going to the question, the return Omega realized return is 13%. 13% minus risk-free 8% divided by beta of 1. How about beta fund? Beta fund return is 18%. 18% minus risk-free 8% divided by 2. Then I'm going to calculate the other measure, which is Sharpe's index. Sharpe index. We know the formula candidates is equal to the portfolio return minus the risk-free divided by the standard deviation of the portfolio. For the return on Omega Fund is 13% minus risk-free 8% divided by standard deviation. The standard deviation Omega 19%. Next we have, that will give us the answer here. Then we have Sharpes for Omega Beta Fund. Beta Fund, the return 18% minus 8% divided by the standard deviation 15%. 15%. Then lastly, candidates, is the market. Sharpes index for the funds and the market. The Sharpes index for the market, Sharpes index, Sharp index for the market, will have, this will be equal to Sharpes index for the market is just the market return. The market return will be equal to the market return on the market minus the risk-free. Then we divide the market standard deviation for the market. So candidates, is important you have the formula in your head so that you can retrieve it anytime. So when faced with such a question, first of all, you put down the formula, then you check the inputs from the question and insert in the formula, then the rest is the work of the machine. The machine will do the rest of the work. For example, here we want to calculate the Jensen's alpha for Omega Fund. That will be equal to one. Beta Fund, this is equal to 2. Trenos alpha is 5. This is 18 minus 8, 10 divided by 2, 5. Then Sharp for Omega Fund, Sharp index Omega Fund, 0.263. Then here we have it's equal to 0.666. For Sharp index candidates, we have the market return. Sharp index for the market, we'll have the market return. The market return is 12% minus risk-free of 8% divided by the standard deviation for the market. Now, candidates, the question did not provide the standard deviation for the market, and that seems to be an error of omission. So we are going to assume a standard deviation of 25% for the market. Okay, 25% for the market. 25% for the market, that is 12 minus 8 divide 25. This is 0.16. So we have assumed a standard deviation for the market is 25%. This is not provided in the question yet, candidates. For you to calculate the Sharp index for the market, you require the market return, you require the risk-free rate and the standard deviation for the market. So candidates, that is part A Part A, how many marks are this? Part A, we have Jensen's alpha, 2 marks, 1 mark, 1 mark. Trenor's alpha, 1 mark, 1 mark. Then Sharp, 3 marks, 1 mark, 1 mark, 1 mark. Total, these are 7 marks. 7 marks. 7 marks. 7 easy marks. 7 easy marks. The marks are easy if you have the formula. And you can see if student who had the formula, then it becomes easy to calculate these measures. Jensen measure, I said earlier, is a measure that we get after, is a measure to calculate the difference. It's a measure to calculate the difference between the portfolio actual return and its expected return according to CPA. Now, Trenor's alpha, on the other hand, provides a measure of performance adjusted for market risk. That means it shows the return earned over the risk-free return per unit of market risk. And candidates, the higher the Trenor's ratio, the better the performance of the fund. And you can see these funds have equal performance. They are performing equally because both have a ratio of 5:5. Now, candidates, the Sharp's index measures how much a fund has returned for each unit of risk taken. Sharp's index measures how much a fund has returned for each unit of risk that is taken. Now we are going to answer part B, which says the estimated factor sensitivities of Diamond Limited to farmer fringe factors and the Pastor-Stamber model factors and the risk premium associated with those factors are given in the table below. It's a table, there is a column on factor sensitivity and risk premium in percentage. The first one is a market factor, then there is a size factor, the value factor, liquidity factor, and the treasury bills rate is 5%. Required, Roman 1, the required rate using the farmer fringe model, 3 marks. Roman 2, the required rate of return using the Pastor-Stamber model, 3 marks. 3 marks. This is part B. Farmer fringe return. We need to calculate farmer fringe, the required rate of return using the farmer fringe model. Now, candidates, this farmer fringe model is a work of Eugene Farmer and Kenneth French. Eugene Farmer and Kenneth French. That this model addresses the perceived weaknesses of the CPA. And there are 3 main factors in the farmer fringe model. And these factors are abbreviated as RM, RF, let me just do some small introduction to this model. RM, RF. This is the first factor. The next factor is the SMB factor. Then there is a HML factor. There are 3 factors. Okay. this researcher, they were researchers, these two researchers, in not quite long ago, in about 1990 or 1993, thereabout, the Eugene Farmer and Kenneth French addressed the perceived weaknesses of the CPA model with three factors, which are known as the Farmer-French model. RMRF is one of the factors, and RM stands for the return on market. RF stands for risk-free. Okay? The risk-free, or the 3 months treasury bill. The is a 3 month treasury bill, and is one of the equity risk premium that can be presented, and is a factor that is shared with the CPA. Okay, the premium, we know candidates in CPA, we know that premium is equal to the return on the market minus the risk-free rate. That's the first factor. Then SMB candidates, small minus big, or a size, or what we call market capitalization factor. It is the average return on 3 small cap portfolios minus the average return on 3 large cap portfolios. So the SMB represents a small cap return premium, a small cap return premium. How about the HML? The HML candidates is a high minus low. That is the average return on 2 high book to market portfolios minus the average return on 2 low book to market portfolios. All right. Now, if you are to put this in a formula, candidates, the Farmer-French return, can be calculated as follows. The Farmer-French return will be equal to the risk-free rate plus sensitivity plus sensitivity to equity market factor times the equity risk premium, plus sensitivity to size factor times the size risk premium, plus candidates sensitivity to value times value risk premium. That's the formula to calculate the return based on the Farmer-French model. You can see we have risk-free plus, these are 5 things. 1, 2, 3, 4. There are 4. 1, 2, 3, 4. 4 inputs. Number 1 is the risk-free rate. Then there is sensitivity to equity market factor. Equity market factor times equity risk premium. Equity, equity, equity. That's how you relate these things, candidates. Then there is plus sensitivity to size factor. Size. The premium here is the size risk premium plus sensitivity to value factor. We have value times value risk factor. Value. So we have equity, size, value. So let us now get these inputs from the question. Get the inputs from the question. First of all, we have the risk-free rate. 5%. That is the treasury bill rate, is the risk-free rate. We add sensitivity to equity market factor. Sensitivity to equity market factor is 1.05 times its premium, 1.05. The premium is on the right hand side of the third column of 5% plus the sensitivity to size. Size is the next factor. Sensitivity to size factor, that is negative 0.65 times the factor, size factor 2.5 plus the sensitivity to value. The next one is value negative 0.2 times the value premium 4.5. That will give us the return based on the Farmer French model. Next step is to use the machine. That is equal to 7.725. 7.725. That is the return. 7.72%. 7.725%. Now, candidates, you can see there are 3 main steps here when calculating this kind of a question, when finding the return based on the Farmer French model. The first step, put down the formula. That's the formula. Put down the formula. Then the next step is to insert the inputs from the question. Okay? From the question we substituted these values from the figures in the question. So that's step number 1, then step number 2. The third step is to use the machine. You are allowed to use a calculator in your exam. Use a machine and then just get the marks. These are how many marks? 3 marks. These are 3 marks. 3 marks. 3 marks. It's a mark for that step. Formula, it's a mark for the formula. Then there's a mark for identifying the right inputs, then calculation. We are now going to answer the second part of B. We've done the Farmer French, the required rate of return using the Farmer French. In part B, we are going to calculate the required rate of return using the Pastor-Stumble model. Pastor-Stumble model, Roman 2. Now, what is this model all about? Candidates, the Pastor and Stumble, these are again 2 persons, researchers. Pastor and Stumble, which is a more recent model. The other one, this French model, I said it was about 1993. This one is about the year 2003. In the year 2003, Pastor and Stumble extended the farmer fringe model to encompass compensation for the degree of liquidity of equity investment. And this model is mostly applied to the public security investment as well as certain private security investments. So the Pastor-Stumble model adds to the farmer fringe model a fourth factor. These are three main factors. This is the market factor. We have the size factor. Then there is the value factor. This model adds the fourth factor, which is the liquidity factor. That's why in this question, the fourth factor there is the liquidity factor. So the model is just the same, apart from the fact that the Pastor-Stumble model adds the fourth factor, which is the liquidity factor. So the return based on the Pastor-Stumble model will be equal to risk-free. Let me use my blue pen, or let me just use my black pen. The risk-free will be equal to the risk-free rate plus sensitivity to equity market times equity risk premium, plus sensitivity to size factor times size risk factor plus this is 1, 2, plus the third one is the sensitivity to value factor times value risk factor plus the fourth factor, which is in this table here, the liquidity factor, sensitivity to liquidity factor times the liquidity risk factor, That will give us the return based on the Pastor-Stumble model. So you have the return is equal to the risk-free rate plus sensitivity to equity market times equity risk premium plus sensitivity to size factor times size risk factor plus sensitivity value factor times value risk factor plus sensitivity to liquidity factor times liquidity risk factor That is the formula. You can see here we have equity market factor, then we have equity risk premium. Then here we have size factor. We multiply by the size risk factor. The other factor is the value factor. We multiply with the value risk factor plus sensitivity liquidity factor times the liquidity risk factor. Liquidity risk factor. So we are going to go to the next step, which is to insert the values. And candidates, we saw the first four values. We have just said that the Pastor-Stamble model introduces the liquidity factor to the Farmer-French model, the FFM model. This is the FFM model. This model introduces an additional factor, the liquidity factor. So in part 1, we had determined the Farmer-French factor, and the Farmer-French factor we've seen is 7.725%. That's the return. So we are introducing another addition to this, which is an improvement, okay? Is an extension. The extension, this is the Farmer-French model. An extension is the liquidity factor. So we read from the question, the liquidity factor is 0.2 times the liquidity risk factor. The liquidity risk factor is 4.5. 4.5. This 0.2 positive. So that will give us the answer. This is 7.725 plus 0.2 times 4.5. I'm getting here 8.625%. So that is the Pastor and Stamble return, the return based on the Pastor and Stamble model. Is that clear, candidates? That should be clear because I've explained the two models. I've shown you how to derive how to come up with the formula. I've shown you how to insert the values, and then the rest is the work of the calculator. So candidates, this again 3 marks. There is a mark for the formula. There is a mark for inserting the right values, then calculation. 3 marks. 3 marks. 3 marks. You are now going to answer part C, which reads, part C reads, you have recently been hired as a financial manager at Block Limited, a locally incorporated company that deals in important building materials from the United States of America. As the person in charge of negotiating the exchange rates, you have noted the following indicative exchange rates and interest rates. 3 months forward exchange rate, there is a spot exchange rate of 100 Kenya shillings per US dollar. 3 months interest rate in Kenya is 8% per annum. 3 months interest rate in US is 5.8% per annum. The 3 months forward exchange rate is 100 shillings per US dollar. Assume that Block Limited can borrow as much as 1 million Kenya shillings required. Determine Roman 1 whether the interest rate parity is currently holding, 2 marks. Roman 2, demonstrate how you could undertake a covered interest arbitrage assuming that the IRP is not holding, 4 marks. Roman 3, determine the arbitrage profit, 1 mark. That is part C of question number 2, November 2020, Advanced Financial Management. Part C, Roman 1. Demonstrate that the interest rate parity is currently holding. Candidates, what is this thing known as interest rate parity? Now, candidates, when the market forces cause interest rates and exchange rates to adjust such that the covered interest arbitrage is no longer feasible, the result is what we call an equilibrium state that is known as the interest rate parity. And if the interest rate parity exists, then the rate of return that is achieved from the covered interest arbitrage should be equal to the interest rate of the home country. Should be equal to what? The interest rate of the home country. The return should be equal to the interest rate of the home country. That's a very important statement to enable us answer this part. It says, determine whether the interest rate parity is currently holding. At what point does the interest rate parity hold? The answer is, candidates, it holds when the return from the covered interest rate arbitrage is equal to the interest of the home country. And for those who didn't attend the class lessons, I know some of you just joined the block revision sessions. For those of you who may not have covered the area, arbitrage can loosely be defined as capitalizing on a discrepancy in the quoted prices by making a riskless profit. And the covered interest arbitrage is a process of capitalizing on the differences in interest rates between two countries while covering your exchange rate risk with a forward contract. And the logic, candidates, of the term covered interest arbitrage becomes clear when it is broken down into, say, arbitrage. Interest arbitrage, okay? Interest arbitrage. So what is interest arbitrage? Interest arbitrage refers to the process of capitalizing on the differences between interest rates between countries. And covered means hedging your position against exchange rate risk. So covered interest arbitrage is sometimes interpreted to mean that the funds to be invested are borrowed locally. And in that case, the investors are not tying up any of their own funds. And it is a strategy, candidates, whereby an investor capitalizes on the interest rate differentials between countries by using a forward contract to cover exchange risks. That's an important definition for those who had not covered the syllabus, candidates. I'm defining covered interest rate arbitrage. I'm saying is the process of using favorable interest rate differentials to invest in a higher yielding currency and hedging the exchange risk through a forward currency contract. In this question, we've been provided with the 3 months forward exchange rate, and we see here is the exchange rate is 105 Kenya shillings per dollar per US dollar. Then the spot exchange rate is 100 Kenya shillings per US dollar. The 3 month interest rate in Kenya is 8% per annum. The 3-month interest rate in the USA is 5.5% per annum. Assume that Pan Block Limited can borrow as much as 1 million Kenya shillings. Required, determine whether the interest rate parity is currently holding. And I've said the interest rate is holding where the return is equal to the return from arbitrage is equal to the interest rate of the home country. But candidates, another important point to note is we need to calculate the return as a result of arbitrage, and that return should be equal to the interest of the home country, which we also need to calculate because the interest of the home country has not been provided. The interest of the home country has not been provided in this question. So we are going to first of all calculate the interest on the home country. We are going to calculate the interest of the home country, and we've seen, candidates, the interest there is 3 months interest rate is 8% per annum. Therefore, the interest in the home country is going to be 8% times 3/12. We're going to apportion it. We apportion this to get the interest of the home country because the 8% is per annum. So what will be the interest for the 3 months? So that's going to be 24 divide 1200. The interest here is 0.02, which is equal to 2%. And now you calculate this one for home country. We will then calculate the interest for the foreign country, USA. And the USA interest is going to be 5.8%. This is 5.8% times 3/12. That will be equal to, this is equal to 0.0145, which is equivalent to 1.45%. These are important interest rates that will help us answer the question. We want to demonstrate if the IRP is currently holding. And I've said the formula is, we need to calculate the return. Firstly, I've said that the interest rate exists when the rate of return is equal to the interest rate in the home country. So we've calculated the interest rate in the home country, that is 2%. So we are going to calculate the interest, the return as a result of the arbitrage process. What is the return? The return, candidates, is calculated as follows. R is equal to 1 plus interest in the foreign country, 1 plus premium minus 1. Okay, this formula is going to give us the rate of return on investment. There are two important inputs: the interest rate in the foreign country, which you have calculated here. Then we have the premium. We need to calculate the premium, candidates. I'm going to have a working. Going to have working for the premium. Candidates, we know that the premium is equal to premium or discount is equal to 1 plus interest in the home country over 1 plus interest in foreign country minus 1. The interest home country we calculated here is 0.02 over interest in the foreign country 1.45%, converted into decimal 0.0145 minus 1. That will give us the premium, and that will be equal to 1.02 divide 1.0145 minus 1. The premium is equal to 0.00542. That is the premium. So candidates coming here, we will substitute. We have 1 plus interest foreign country, the USA, 0.0145 times 1 plus the premium, 0.0542 minus 1. So candidates, the rate of return on investment is 1.0145 times 1.00542 minus 1. This gives me 0.02. Candidates, you can see that the rate of return on investment, when converted into percentage, this is 2%. You can see, candidates, the rate of return here, this rate of return is equal to the interest in the home country of 2%. 2%. Therefore, the IRP is currently holding, because initially we sought to find out if the IRP is currently holding. That is the question. Determine whether the interest rate parity is currently holding. And I say that if IRP exists, then the rate of return that is achieved from the covered interest arbitrage should be equal to the interest available in the home country. So you see, the interest available in the home country is equal to the rate of return. That is the answer. How many marks? 2 marks. 2 marks. 1, 2. 2 marks. Then moving on to part 3, demonstrate how you could undertake a covered interest arbitrage assuming that IRP is not holding. In part 2, we are going to demonstrate how one can undertake a covered interest arbitrage assuming that IRP is not holding. Now, candidates, assuming that IRP is not holding, first of all, Roman 2, first of all, it should be noted that this company, Pan Block Limited, can borrow 1 million Kenya shillings. Can borrow 1 million Kenya shillings today. So, to demonstrate how one could undertake a covered interest arbitrage, assuming that IRB is not holding, step number 1 is to convert the 1 million Kenya shillings. First of all is to borrow. Let me start there. Borrow Kenya shillings 1 million. 1 million Kenya shillings. Candidates, the interest rate in Kenya is 2%. So this money will be repaid. Repayment after 3 months will be 1 million times the factor 1.02, which is equal to 1020. So this money that was borrowed will be repaid with an interest of 20,000. Now, the next step, candidates, is to use the 1 million that is borrowed, candidates, and convert the 1 million to US dollars. Convert 1 million Kenya shillings that is borrowed now to US dollars using the spot exchange rate. Using the spot exchange rate of 100 shillings per dollar. 100 shillings per dollar, and this will be equal to 10,000 US dollars. 10,000 US dollars. The next step, candidates, is to invest the 10,000 US dollars. Invest the 10,000 US dollars in the US. Using the foreign exchange rate of 1.45% at 1.45%. 1.45%. And that will be equal to, this will be equal to dollars 10,145. And this I got it, candidates, by multiplying $10,000 times 1.0145. So invest the $10,000 in the US to earn an interest of 1.45 after 3 months. Then we'll then convert this amount, convert the 10,000 US dollars, 10,145 US dollars to Kenya shillings using the forward exchange rate of shillings 105. This is 105 shillings per dollar. 105 shillings per dollar. Therefore, the amount to be received, the receipt at the end of the 3rd month will be equal to $10,145 times 105 Kenya shillings. These are dollars, these are shillings. This will be equal to 10,145 times 105. 105, I'm getting here shillings 1,665,225. This is the receipt the company will have after a period of 3 months. So we have demonstrated how you could undertake a covered interest arbitrage, assuming that the IRP is not holding. IRP is not holding. That is part 2. Then part 3, candidates were to calculate the arbitrage process, arbitrage profit, arbitrage, the arbitrage profit will be equal to this receipt minus the repayment we calculated at start here. The repayment, this is the repayment. This is the amount that this company was expected to pay were it not to invest in the US. If the company did not invest in the US, the company was to pay 1,020,000 shillings. But the company decided to borrow, then the company bought dollars, then invested the dollars in the US at an interest rate of 1.45%. Then the amount, the dollars that were received at the end of the third month were converted back into Kenya shillings to earn a receipt of 1,065,000 shillings 225. So the difference will be the arbitrage profit, the difference of 1065 225 minus 1020. The arbitrage profit here is the arbitrage profit 45,225. 225. The arbitrage profit is just a mark. This is 1 mark. 1 mark. The demonstration on how you could undertake covered interest arbitrage assuming that IRP is not holding is 4 marks. 4 marks. 1, 2, 3, 4. 4 marks. 4 marks. So candidates, that is the solution to question number 2 that was tested in November 2020. Thank you for attending our today's session. I urge you to continue revising. Before you attend our next session, please try and answer question number 3, which A and part B. Part A, I see students were to explain certain terms there, like the primary mortgage market and secondary mortgage market, 2 marks. Roman 2, fixed rate mortgage and adjustable rate mortgage. 3, the lien and the recourse. Then part B, I see a question where students were required to calculate the expected return, correlation, coefficient, and standard deviation. Candidates were also to calculate the mean variance of a project. So please try and answer question 3 before coming in to the next lesson where we are going to answer the next question. November 2020 question number 3. Thank you. God bless you. Bye-bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri and today let's talk about the business and data analytics April 2023 question 22. It reads as follows. You work as a management accountant for Majani Limited, which deals in tea production and export. Before embarking on next year's budgeting, you are tasked with analyzing past revenue and price trends. As a starting point, your supervisor has provided you with historical price and production data as shown in the worksheet. So you can see the dates have been given to you, the production, millions of kilograms, prices per kilogram. we move down and see what we are required to do. A, plot a line graph for price against time or dates. Insert a linear trend line displaying the equation and R squared on the chart. Briefly discuss your results. So we go back up here and pick the relevant data. We start with the dates, move down like so. Then we go back up again and pick the prices. But before we pick the prices, we need to press Control so that now it can jointly pick the dates and the prices at the same time. So you can see as I press Control. Then you hover around Insert, click on Insert. Then you come to Line Chart. This is what to say, it's a line chart. So you click on it. Then you proceed on to click whichever chart pleases you amongst this list of for line charts. So let me click on the first one. So as you click on the first one there, we just need to just be patient a bit so that now the output like so can actually come out. So what we do, we just place this where it's supposed to actually be, next to the solution, ladies and gentlemen, there. And moving like so would mean that we would be able just to place the data where it is actually supposed to be, which is right over here. So what are we told? We are told that we need then to plot the line graph. That's okay, we've done that. Insert a linear trend line displaying the equation and R squared. So we need to display the equation and R squared. R squared represents the coefficient of determination. Coefficient of determination assists the investment expert or the accountant to identify whether the regression is reliable. So we go back up here and we just right click on the graph. We add a trend line right here, and when we click on this like that, the trend line should be able to appear. As you can see, moving towards the right here, the trend line appears. We can then now display the equation. So you can see all of these inputs over here. There's either exponential, there's linear. Linear is what we've been told that we need to do. The trend name, we just say it is the linear price per kg, which is okay. Then we move ahead and say that we need to display the equation, which is there, we tick that. And then we also display the R squared over here. So we tick that. That's what we've been told by the examiner. And then we can close this part here, close it. And for a clearer picture, we can place the equation just above there like that. And then also what is going to appear is going to be the R squared. Now that's much clearer as compared to where it was initially placed right there. So this is our part A. We can then move ahead and try and identify what we've been asked for part B. For part B, we are told, using a suitable MS Excel function, show that the coefficients shown in the trend line in A above are in fact a result of a linear estimation between historical prices and time. So what we do is that there is what is called a leanest function over here. So we move this over here like this. Say this is part A. Like that. So we can put over here part B. And we now use the leanest function plus leanest. So what is leanest? We are saying that the leanest represents linear estimation in full, and this value returns the statistic as it's shown over here. It returns the statistics that describe a linear trend matching known data points by fit straight line using least squares method. So what we do is that we then now need to identify what our Y value is. Our Y value represents the prices per kg. So come over here and highlight everything there for known Ys, that. And then we go back up. Our known X's. Our X's are influenced, are the, what we call the independent variables. They're the ones that influence the Y's, saying that the dates and the production in kgs, we highlight both of them together like so. And then clicking on this part over here called constant here, it represents a logical value. And we say true over here. True. That. And we say okay. So we are told that an unexpected error occurred. So we just click OK here, because we are saying that we are getting negative 0.74. And this is the formula for the linear estimation. So linear estimation right here. And we say leanest. Like so. Leanest. And we can be able to put it like so. And put it in form of, maybe say, perhaps we can be able to just highlight maybe in a different color, and maybe, you know, just for presentation purposes there. So you can put it like so. Then maybe you can proceed on to put it in form of a thick square outside there. So we expect that this 0.7412 should actually be the same as the value right over there from the equation. So moving on, we can then move on to part C. Part C, you can see that you know that prices are affected by production. Because of this, you would like to run a regression between price, production, and time. Use data analysis toolpack to run the regression analysis, interpret your results. Be sure to discuss the coefficients and the parameters. So what we do is that we run a regression, part C here. Like so. And then we pick the dependent and the independent variable. So the data analysis toolpack is under the data tab here. Click on data. Then on the far right, you can see data analysis. Click on data analysis. And then you search for regression right here. You can see regression is right there. Click OK. What is our Y input range? The prices. So we click the prices like so. And then our X input, click there. We go back up again, and we can see that both the dates, this is a multiple linear regression, the dates and the production levels are the ones that influence prices. That. So if perhaps you would want the labels, be able to put in labels over there like that, and then we click OK. So we have this output. So you can copy this output right over here and place it as appropriate on question 22 right under part C here. Control V. And we are saying that we can be able to see these regression statistics, R squared, which represents coefficient of determination. The standard error has also been given. We also have number of observations, so 100. And here is what we have as the intercept right here. We have the intercepts right over here. Then we have the dates over here. So you can change this to dates. And here you can be able to say production and millions per kgs production. kgs. That. When x is 0, what is the value of y? Then that's what is represented by the intercept there. The dates are coefficients that influence the prices, the dates as well as the production in terms of kg. So we are saying that you can see this is the intercept and the date and the production per kg. That. Notice that under leanest over here, we expect negative 0.074. That. So 0.074 should be the part of the intercept right there. We can now move on and understand or analyze the p-values here. Come to home and we come like so, we do like so. We are saying that low p-values less than 0.05 means that the coefficient is likely not to equal 0. But if we have high p-values greater than 0.05, then we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. In terms of the F statistic over here, we need to look at the F statistic in collaboration with the p-values. The F statistic, or rather, when you're saying that because the p-values over here are greater than 0.05, with the exception of this production of kgs, then the model might not be reliable for analysis, or might not be used for analysis. When we look at the R squared, our R squared is given to us right over here. You can highlight that over there. And we're saying that we want our R squared. If R squared is greater than 0.95, then the regression should actually be reliable. In our case over here, it is not greater than 0.95. And hence the model is not reliable for analysis. It cannot be used to predict the future production levels. So what can we conclude from that analysis? We can conclude that the model is not good, because we are saying that the R squared is not greater than 0.95. Secondly, we are also saying that the p-values right over here, because most of them are actually greater than, all of them are actually greater than 0.05, all of them 0.05, we are saying that we cannot conclude that the explanatory variables actually affect the dependent variable. We can also conclude that innovations can be, for example, to remove this constant value over here, to try and evaluate and estimate if the value is okay, or we can be able to use other metrics or other time series data to analyze or make inferences of this data that we're analyzing towards our left. So that is it for question 22. We hope that you have enjoyed it and you've understood how to run a regression. Thank you for being with Manifested Publishers. Be blessed.
Welcome to Manifested Publishers. My names are Mr. Bernard Mariga. We can start with a question in August of 2022. Let's start with a question in August 2022. 2022, question 3B. August 2022, question 3B is a question I want us to deal with. Question 3B of August 2022. And this question states, A hotel with 50 single rooms is recording 80% occupancy in a normal season of 8 months and 50% occupancy in off-season of 4 months in a year. The following information is provided. You have annual fixed expenses, staff salaries excluding room attendants of 7.5, repairs and maintenance of 2.6 million, depreciation on buildings and furniture of 2.4 million, other fixed expenses like dusting and sweeping is 3.25 million. So that your total fixed cost is 15,750. Variable expenses per guest per day. Linen and laundry is 300. Electricity and other facilities 200. Miscellaneous expenses 250. Then the management wishes to realize a profit of 25% on total cost. 25% on total cost. Required. Number 1, the required tariff rate per room. Number 2, the break-even occupancy in normal season assuming 50% occupancy in off-season. Number 3, the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season respectively. Advice on the appropriateness or otherwise of the above proposal. So let's analyze what we have been given in this question. One of the items you have been given is the fixed costs. And your fixed cost in total is how much? 15,750,000. 15,750,000. Then you also have another cost that is known as a variable cost. And the variable cost, remember, is a cost that increases with output. It also decreases with output. A good example of a variable cost is direct material, direct labor, direct expenses. Variable overheads should also be added to those costs I have mentioned above to determine your variable costs. So your variable cost here, they have said there is a linen and laundry of 300 plus electricity and other facilities of 200 plus miscellaneous expenses of 200 and what? 50. Of 250. So that 300 plus 200 plus 250, 300 plus 200 plus 250 should be 700 and what? 50. 750. Then we can then answer, go back to what we require, what the question is asking. They want the required tariff rate per who? Per room. The required tariff rate per who? Per room. So the required tariff rate per room. So in this question, what they are simply asking you to do is to determine your selling price P. That is what they want you to determine. That is what they want you to determine, okay? Or your revenues, So we are going to take our annual fixed costs. We are going to take our revenues as your fixed costs plus your variable costs. Let me say fixed costs. Let me just write it in full. Fixed costs plus variable costs plus your profit. So your sales revenue is simply the cost. Remember, these are the costs, total costs, plus your profit, okay? We already have the fixed costs, which we have seen as 15,750. The variable cost here is 750, but it is per who? Per guest per day. So we need to determine our total variable cost. Our total variable costs. How do you do that? You determine your total variable cost by taking the variable cost per unit, you multiply that by your units. And in this case, you want to multiply that by the number of guests you have in an organization, in this organization. So let's determine the number of guests you have, where Q, in this case, is your number of who? Guests. Q is your number of who? Guests. Let's determine the number of guests. The first paragraph on us, they're saying a hotel with 50 single rooms is recording 80% occupancy in normal season of 8 months and 50% occupancy in off season of how many months? 4 months in a year. Then assume a 30-day month in all cases. So let's determine, we write there, determination of the number of guests. Or the occupancy. We are going to take that by taking during peak season, you had 80% occupancy. You multiply that by the 50 rooms that organization has. They are occupied for how many months? 8 months. 8 months. Then you multiply by the number of days. Number of days, that is during peak season. Plus, you also do the same for what? Off peak season. And how will you do that? You're going to take 50% occupancy. The rooms that are being occupied are 50 rooms. The off-peak season lasts for 4 months. But each month has how many days? 30 days. 30 days. So let's identify the occupancy level. Let's identify the occupancy level. During peak season, you expect 9,600 as the number of what? Guests that will occupy that. Then during off-peak, you expect 3,000 guests. So that in total, you're going to have how many guests? 12,600 guests. You're going to have 12,600 what? Guests. The reason we are determining the number of guests, remember, is so that we can be able to determine our total variable costs, which will be the product of a variable cost per unit that already we have of 750. Then by the number of units, which are your guests, which are how much? 12,600. So therefore, your total variable costs will be your variable cost per unit of 750. You multiply by 12,600. 750 times 12,600. So therefore, your total variable cost is 9.4 million. 9.45 million. Once we have determined our variable cost, we then will add our fixed cost to determine our total costs. Then our what? Profit. So let's come here and say that your total fixed costs, your total fixed cost is how much? 15,750,000 plus your variable cost will give you your total costs. And how much is your total cost in this case, class? $25,200,000. That is your total what? costs. But remember, to get our revenue, we simply take our total cost plus our what? Profit. So then we need to add our profit. We need to add our profit. And they were saying that profit is 25% on what? Cost. So this is known as profit markup. So you're going to say 25% of 25, 200 what? 1,000. That will give you 6.3 million. 6.3 million. So to get our revenue, you then add, which is 31,500 what? 1,000. 31,500,000. You refer to that as your total revenue. As your total revenue. When we have our total revenue, we can now determine our what? Selling price per unit. We can determine our selling price per who? Per unit. So let me do away with this. You know that to get your revenue, you simply take your selling price per unit, you multiply by your units. Therefore, our revenue can be used to determine your what? Selling price per unit by simply taking your total revenue, you divide by what? Your units. Your total revenue is how much? 31,500,000 divide by 31,500,000 divide by your total number of what? Guests. In this case, we are dealing with a hotel, so we normally have got what? Guests. So therefore, divide by the total number of guests, which are 12,600. So please confirm that that is 2,500 per who? Per guests. 2,500 per who? Per guests. So each guest will be charged how much? 2,500. So that's the first part of that question. The required tariff rate per who? Per room, eh? All right. Then note number 2. Note, and that should be per room. Note number 2. The break, or rather, required note 2. The break-even occupancy in normal sales, assuming occupancy is 50% of season. Eh? So the break-even point. Break-even point. All right. So we can have this in what? In units, which in this case is in your what? Guests. Your guests are the measure of what the company is producing. Eh? To determine your break-even point in units, you simply take your fixed costs, divide by your contribution margin. Divide by your contribution margin. Your contribution margin, we've said, is the difference between your selling price and your variable cost per unit. Your selling price, we've just determined it as 2,500. Your variable cost per unit was 750. So therefore, to determine the contribution margin from the above, you will take 2,500 divided by minus 750 to get a contribution margin of 1,750. So your break-even point in units will be a fixed cost. Your fixed cost was 750,000. divide by 1750. Divide by 1750. So for that organization to be able to cover its cost, they need to have to occupy 99 rooms or what? Guests. Right. In shillings, what sometimes they refer to as break-even point revenue. Revenue, shillings, or sales. If you see break-even point revenue or sales, it basically means break-even point in what? Shillings. It is determined by taking your fixed cost, divide by contribution margin sales ratio. Divide by contribution margin sales ratio. Your contribution margin sales ratio is given by contribution margin divided by selling price. Contribution margin divided by selling price. Your contribution margin is 1750 with a selling price of 2500. With a selling price of 2500. So your contribution margin sales ratio is 0.7. So therefore, your break-even point will be 15,750,000 divided by 0.7. Divide by 0.7. So for that company to be able to break even, they need to sell 22,500,000. They need to sell 22,500,000, which could also be obtained, by taking your break-even points in units, you multiply by your selling price. You multiply by your selling price. So these two answers should be the same. Those two answers, indeed, they are the same. So those two answers, indeed, they are what? The same. All right. Part 3 of that question. Part 3 of that question. They are saying the management is proposing a 20% decrease in tariff to improve occupancy at 100% and 70% in normal season and off-season respectively. Advice on the proposal above. So part 3. Decrease selling price by what? By 20%. Decrease the selling price by 20%. Now, to analyze this question, to analyze this particular question, there are two ways we can do that. Number one, we can determine the profit of that company after they have dropped the selling price by 20%. Number two, we can determine the contribution as a result of dropping the what? The selling price by 20%. Once we have done that, we then compare with our current what? Selling price. So when you're making decisions here, you normally make decisions considering by taking the contribution or the profit. The contribution or the what? Profit. So let me see. Let us do this together. Let's do this together. Your new selling price P. The decrease by 20%, it means your new selling price will be 80% of the current selling price, and the current selling price is what? 2,500. So that's your new selling price. The variable cost is not changing. It is still going to be 750, which is 300 plus who? 200 plus 250 to give you how much? 750. So that now your contribution margin will be 2000 minus what? 750. It will be 1250. 1250. Your contribution margin sales ratio, is your contribution margin divided by what? Divide by P. 1250 divided by 0.625. That is your new what? Contribution margin sales ratio. To determine your profit, you know, you simply take your contribution margin, you multiply by your units minus your fixed costs. Alternatively, you can take your contribution margin sales ratio, you multiply by your revenue in shillings minus your fixed cost, minus your revenue times your revenue minus your fixed cost. Let's determine the units as a result of what? The drop in what? Selling price. They're saying that if you decrease the selling price by 20%, you're going to improve occupancy at 100% and 70% in the normal what? Season. So we need to get our new the number of guests that are going to occupy that. So you're going to say it is 50 what? Rooms that are being occupied what percent? 100%. They are being occupied for how many months? 8 months during peak season. And you know each month is having how many days? 30 days plus there are 50 rooms that will be occupied 70% of the time. The occupancy during off-peak is how many months? 4 months. Then per day is how much? 30 days. 30 days. So this means that is 1200 guests. That is 4200 guests. Right, so that the total here will be 16,200 guests. So when the company reduces the selling price by what? By 20%, your occupancy will increase or will come to what? 16,200. Let's get now the profit. Let's get the profit. You're going to say your profit here is your contribution margin. Your contribution margin was 1250. You multiply by how many guests? 16,200 minus a fixed cost of 15,750,000 or 15,750. So therefore, your profit should be 4,500,000. Now, then let's advise them. Remember, they are saying we advise them. We want to advise them on whether they should drop the selling price by 20% or they should continue selling and continue with the selling price of how much? 2,500. Now, when your selling price is how much? 2,500. Your profit is how much? Your profit in shillings, and your selling price is 2,500. Your profit is 6,300. 6.3 million. When you drop your selling price by 20% to how much? To 2,000. Your profit is how much? 4,500,000. 4.5 million. So there is a decline in profit by what? By 1,800 or 1.8 million. So therefore, what will you advise them? You're going to tell them to continue with selling price of how much? Of 2,500. Why is that so? Because the profits have dropped to 4,500 when you have done what? When you have dropped your selling price with an intention of increasing your occupancy. So kindly tell that organization not to drop its what? Selling price, not to drop its selling price. All right. Now that we have understood a single product, CVP, in your own free time, you can look at April 2023, question 4C.
Welcome to Manifested Publishers. We offer Kasneb study materials and video lectures.
Candidates, here I am again to continue revising the paper that was tested in May 2019, that is Advanced Financial Management. Having done question 1, 2, 3, and 4, in our today's lesson we are going to tackle question number 5. And this question 5 is in two parts, part A and part B. Part A is a question that tests a candidate's knowledge in capital budgeting decision. Part B is a question from the topic mergers and acquisitions. I will read question 5A first, then I'll answer it here on the board. And as we answer these questions, candidates, I need to remind you that the objective of the Advanced Financial Management paper is to enable you that at the end of these sessions, you should be able to apply advanced financial management techniques in business. That is why you can see some of these questions are practical questions. These are problems that businesses face which call for techniques in advanced financial management. And as an accountant who is training, it should not also be lost on you that the purpose of studying advanced financial management is more than just passing the paper. As you study this paper, make sure you are gaining the skills, the knowledge, and the expertise that is required of you to solve problems that organizations face. Now, question 5A is a problem that requires the knowledge in capital budgeting, techniques in capital budgeting. So let me read the question. It says that Jeza Tours and Travel is a private limited company in the tourism industry. In order to improve customer service and provide the management with timely and quality information, the company is contemplating to purchase 8 microcomputers at a cost of 100,000 shillings each. Installation costs for all the computers will amount to 80,000 shillings. It is estimated that once installed, the computers will increase the company's earnings before depreciation and tax from 12 million shillings to 12,500,000 shillings annually. The computers are expected to last for 10 years, after which they will be obsolete with no resale value. The operations manager proposes that the computers will be useful for 15 years with no resale value. The marketing manager, on the other hand, argues that the company needs the computers for only 5 years, after which they can be disposed of at 50,000 shillings each. The probability distribution of the useful life of the computers is given as follows. The probability that the computers will be useful for 5 years is 0.2. Probability the computers will be useful for 10 years is 0.5. Probability that the computers will be useful in 15 years is 0.3. The company is in the 30% tax bracket. The company's cost of capital is 24% and uses the straight line method of depreciation. Required, Roman 1, the expected net present value of the project, 4 marks. Roman 2, the standard deviation of the expected net present value, 3 marks. Roman 3, if the net present value of the project is less than 200,000 shillings, the firm will be exposed to financial distress. Determine the probability that the firm will avoid financial distress. Assume normal distribution, 3 marks. Candidates, here is a problem, okay, that we need to solve. This is a past paper question that was tested in May 2019. The candidates who appeared in that exam were expected to answer this question so as to earn how many marks? These are 10 marks. 10 marks. So candidates, this again I repeat is a problem, and just like any other problem, this problem requires a formula. Every problem has a formula which has to be applied in solving it. So this is a problem that we need to solve, and the past paper question, this is May 2019. This is advanced financial management, question number 5. All right, May 2019, the advanced financial management paper. Part A, we are required to calculate the expected net present value. Okay, we are required to calculate the expected net present value. Expected net present value. Expected. We've been given the cash flows, all right, because we know for you to calculate the NPV of a project, then it's the difference between the NPV or the present value of cash inflows minus the present value of cash outflows. That is the general formula for calculation of NPV. So this is question 5A, Roman 1, expected NPV. Here is the formula, expected NPV.